Preface to the 4th edition, by Warren E. Buffett. I read the first edition of this book early in 1950, when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions, and the ability to keep emotions from corroding that framework. This audiobook precisely and clearly prescribes the proper framework. You must supply the emotional discipline. If you follow the behavioral and business principles that Graham advocates, and if you pay special attention to the invaluable advice in chapters 8 and 20, you will not get a poor result from your investments. That represents more of an accomplishment than you might think. Whether you achieve outstanding results will depend on the effort and intellect you apply to your investments, as well as on the amplitudes of stock market folly that prevailed during your investing career. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham, and you will profit from folly rather than participate in it. To me, Ben Graham was far more than an author or a teacher. More than any other man except my father, he influenced my life. Shortly after Ben's death in 1976, I wrote the following short remembrance about him in the Financial Analyst Journal. As you listen to this audiobook, I believe you'll perceive some of the qualities I mentioned in this tribute. Benjamin Graham, 1894 through 1976. Several years ago, Ben Graham, then almost 80, expressed to a friend the thought that he hoped every day to do something foolish, something creative, and something generous. The inclusion of that first whimsical goal reflected his knack for packaging ideas in a form that avoided any overtones of sermonizing or self-importance. Although his ideas were powerful, their delivery was unfailingly gentle. Readers of this magazine need no elaboration of his achievements as measured by the standard of creativity. It is rare that the founder of a discipline does not find his work eclipsed in rather short order by successors. But over 40 years after publication of the book that brought structure and logic to a disorderly and confused activity, it is difficult to think of possible candidates for even the runner-up position in the field of security analysis. In an area where much looks foolish within weeks or months after publication, Ben's principles have remained sound, their value often enhanced and better understood in the wake of financial storms that demolished flimsier intellectual structures. His counsel of soundness brought unfailing rewards to his followers, even to those with natural abilities inferior to more gifted practitioners who stumbled while following counsels of brilliance or fashion. A remarkable aspect of Ben's dominance of his professional field was that he achieved it without that narrowness of mental activity that concentrates all effort on a single end. It was, rather, the incidental byproduct of an intellect whose breadth almost exceeded definition. Certainly, I've never met anyone with a mind of similar scope. Virtually total recall, unending fascination with new knowledge, and an ability to recast it in a form applicable to seemingly unrelated problems made exposure to his thinking in any field a delight. But his third imperative, generosity, was where he succeeded beyond all others. I knew Ben as my teacher, my employer, and my friend. In each relationship, just as with all his students, employees, and friends, there was an absolutely open-ended, no-scores-kept generosity of ideas, time, and spirit. If clarity of thinking was required, there was no better place to go, and if encouragement or counsel was needed, Ben was there. Walter Lippmann spoke of men who plant trees that other men will sit under. Ben Graham was such a man. A note about Benjamin Graham, by Jason Zweig. Who was Benjamin Graham, and why should you listen to him? Graham was not only one of the best investors who ever lived, he was also the greatest practical investment thinker of all time. Before Graham, money managers behaved much like a medieval guild, guided largely by superstition, guesswork, and arcane rituals. Graham's security analysis was the textbook that transformed this musty circle into a modern profession. And The Intelligent Investor is the first book ever to describe, for individual investors, the emotional framework and analytical tools that are essential to financial success. It remains the single best book on investing ever written for the general public. The Intelligent Investor was the first book I read when I joined Forbes magazine as a cub reporter in 1987, and I was struck by Graham's certainty that sooner or later all bull markets must end badly. That October, U.S. stocks suffered their worst one-day crash in history, and I was hooked. Today, after the wild bull market of the late 1990s and the brutal bear market that began in early 2000, The Intelligent Investor reads more prophetically than ever. Graham came by his insights the hard way, by feeling firsthand the anguish of financial loss, and by studying for decades the history and psychology of the markets. He was born Benjamin Grossbaum on May 9, 1894, in London. His father was a dealer in china dishes and figurines. The family moved to New York when Ben was a year old. At first, they lived the good life, with a maid, a cook, and a French governess on Upper Fifth Avenue. But Ben's father died in 1903. The porcelain business faltered, and the family slid haltingly into poverty. Ben's mother turned their home into a boarding house. Then, borrowing money to trade stocks on margin, she was wiped out in the crash of 1907. For the rest of his life, Ben would recall the humiliation of cashing a check for his mother and hearing the bank teller ask, "Is Dorothy Grossbaum good for $5? Fortunately, Graham won a scholarship at Columbia, where his brilliance burst into full flower. He graduated in 1914, second in his class. Before the end of Graham's final semester, 3 departments, English, philosophy, and mathematics, asked him to join the faculty. He was all of 20 years old. Instead of academia, Graham decided to give Wall Street a shot. He started as a clerk at a bond trading firm, soon became an analyst, then a partner, and before long was running his own investment partnership. The internet boom and bust would not have surprised Graham. In April 1919, he earned a 250% return on the first day of trading for Savold Tire, a new offering in the booming automotive business. By October, the company had been exposed as a fraud, and the stock was worthless. Graham became a master at researching stocks in microscopic, almost molecular detail. In 1925, plowing through the obscure reports filed by oil pipelines with the U.S. Interstate Commerce Commission, he learned that Northern Pipeline Company, then trading at $65 per share, held at least $80 per share in high-quality bonds. He bought the stock, pestered its managers into raising the dividend, and came away with $110 per share 3 years later. Despite a harrowing loss of nearly 70% during the Great Crash of 1929 through 1932, Graham survived and thrived in its aftermath, harvesting bargains from the wreckage of the bull market. There is no exact record of Graham's earliest returns, but from 1936 until he retired in 1956, his Graham-Newman Corporation gained at least 14.7% annually versus 12.2% for the stock market as a whole, one of the best long-term track records on Wall Street history. How did Graham do it? Combining his extraordinary intellectual powers with profound common sense and vast experience, Graham developed his core principles, which are at least as valid today as they were during his lifetime. A stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. No matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. The secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith, and you invest with patient confidence, you can take steady advantage of even the worst bear markets. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. The goal of this revised edition of The Intelligent Investor is to apply Graham's ideas to today's financial markets while leaving his text entirely intact, with the exception of footnotes for clarification. After each of Graham's chapters, you'll find a new commentary. In these reader's guides, I've added recent examples that should show you just how relevant and how liberating Graham's principles remain today. I envy you the excitement and enlightenment of listening to Graham's masterpiece for the first time, or even the third or fourth time. Like all classics, it alters how we view the world and renews itself by educating us. And the more you listen to it, the better it gets. With Graham as your guide, you are guaranteed to become a vastly more intelligent investor. Introduction. What this audiobook expects to accomplish. The purpose of this audiobook is to supply, in a form suitable for laymen, guidance in the adoption and execution of an investment policy. Comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes. We shall, however, provide a number of condensed comparisons of specific securities, chiefly in pairs appearing side by side in the New York Stock Exchange list, in order to bring home in concrete fashion the important elements involved in specific choices of common stocks. But much of our space will be devoted to the historical patterns of financial markets, in some cases running back over many decades. To invest intelligently in securities, one should be forearmed with an adequate knowledge of how the various types of bonds and stocks have actually behaved under varying conditions, some of which, at least, one is likely to meet again in one's own experience. No statement is more true and better applicable to Wall Street than the famous warning of Santayana: those who do not remember the past are condemned to repeat it. Our text is directed to investors as distinguished from speculators, And our first task will be to clarify and emphasize this now all but forgotten distinction. We may say at the outset that this is not a how to make a million book. There are no sure and easy paths to riches on Wall Street, or anywhere else. It may be well to point up what we have just said by a bit of financial history, especially since there's more than one moral to be drawn from it. In the climactic year 1929, John J. Raskob, the most important figure nationally as well as on Wall Street, extolled the blessings of capitalism in an article in the Ladies' Home Journal entitled, "Everybody Ought to Be Rich." His thesis was that savings of only $15 per month invested in good common stocks, with dividends reinvested, would produce an estate of $80,000 in 20 years, against total contributions of only $3,600. If the General Motors tycoon was right, this was indeed a simple road to riches. How nearly right was he? Our rough calculation, based on assumed investment in the 30 stocks making up the Dow Jones Industrial Average, DJIA, indicates that if Raskob's prescription had been followed during 1929 through 1948, the investor's holdings at the beginning of 1949 would have been worth about $8,500. This is a far cry from the great man's promise of $80,000, and it shows how little reliance can be placed on such optimistic forecasts and assurances. But as an aside, we should remark that the return actually realized by the 20-year operation would have been better than 8% compounded annually, and this despite the fact that the investor would have begun his purchases with the DJIA at 300 and ended with a valuation based on the 1948 closing level of 177. This record may be regarded as a persuasive argument for the principle of regular monthly purchases of strong common stocks through thick and thin, a program known as dollar cost averaging. Since our audiobook is not addressed to speculators, it is not meant for those who trade in the market. Most of these people are guided by charts or other largely mechanical means of determining the right moments to buy and sell. The one principle that applies to nearly all these so-called technical approaches is that one should buy because a stock or the market has gone up, and one should sell because it has declined. This is the exact opposite of sound business sense everywhere else, and it is most unlikely that it can lead to lasting success on Wall Street. In our own stock market experience and observation, extending over 50 years, we have not known a single person who has consistently or lastingly made money by thus following the market. We do not hesitate to declare that this approach is as fallacious as it is popular. We shall illustrate what we've just said, though of course this should not be taken as proof, by a later brief discussion of the famous Dow theory for trading in the stock market. Since its first publication in 1949, revisions of The Intelligent Investor have appeared at intervals of approximately 5 years. In updating the current version, we shall have to deal with quite a number of new developments since the 1965 edition was written. These include 1. An unprecedented advance in the interest rate on high-grade bonds. 2. A fall of about 35% in the price level of leading common stocks, ending in May 1970. This was the highest percentage decline in some 30 years. Countless issues of lower quality had a much larger shrinkage. 3. A persistent inflation of wholesale and consumers' prices, which gained momentum even in the face of a decline of general business in 1970. 4. The rapid development of conglomerate companies, franchise operations, and other relative novelties in business and finance. These include a number of tricky devices such as letter stock, proliferation of stock option warrants, misleading names, use of foreign banks, and others. 5. Bankruptcy of our largest railroad, excessive short and long-term debt of many formerly strongly entrenched companies, and even a disturbing problem of solvency among Wall Street houses. 6. The advent of the performance vogue in the management of investment funds, including some bank-operated trust funds, with disquieting results. These phenomena will have our careful consideration, and some will require changes in conclusions and emphasis from our previous edition. The underlying principles of sound investment should not alter from decade to decade, but the application of these principles must be adapted to significant changes in the financial mechanisms and climate. The last statement was put to the test during the writing of the present edition, the first draft of which was finished in January 1971. At that time, the DJIA was in a strong recovery from its 1970 low of 632 and was advancing toward a 1971 high of 951 with attendant general optimism. As the last draft was finished in November 1971, the market was in the throes of a new decline, carrying it down to 797, with renewed general uneasiness about its future. We have not allowed these fluctuations to affect our general attitude towards sound investment policy, which remains substantially unchanged since the first edition of this book in 1949. The extent of the market shrinkage in 1969 through 70 should have served to dispel an illusion that had been gaining ground during the past 2 decades. This was that leading common stocks could be bought at any time and at any price, with the assurance not only of ultimate profit, but also that any intervening loss would soon be recouped by a renewed advance of the market to new, high levels. That was too good to be true. At long last, the stock market has returned to normal, in the sense that both speculators and stock investors must again be prepared to experience significant and perhaps protracted falls, as well as rises in the value of their holdings. In the area of many secondary and third-line common stocks, especially recently floated enterprises, the havoc wrought by the last market break was catastrophic. This was nothing new in itself. It had happened to a similar degree in 1961 through 62. But there was now a novel element in the fact that some of the investment funds had large commitments in highly speculative and obviously overvalued issues of this type. Evidently, it is not only the tyro who needs to be warned that while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. The major question we shall have to deal with grows out of the huge rise in the rate of interest on first-quality bonds. Since late 1967, the investor has been able to obtain more than twice as much income from such bonds as he could from dividends on representative common stocks. At the beginning of 1972, the return was 7.19% on highest-grade bonds, versus only 2.76% on industrial stocks. This compares with 4.4% and 2.92%, respectively, at the end of 1964. It is hard to realize that when we first wrote this book in 1949, the figures were almost the exact opposite. The bonds returned only 2.66%, and the stocks yielded 6.82%. In previous editions, we have consistently urged that at least 25% of the conservative investor's portfolio be held in common stocks, and we've favored, in general, a 50-50 division between the two media. We must now consider whether the current great advantage of bond yields over stock yields would justify an all-bond policy until a more sensible relationship returns, as we expect it will. Naturally, the question of continued inflation will be of great importance in reaching our decision here. A chapter will be devoted to this discussion. In the past, we've made a basic distinction between 2 kinds of investors to whom this audiobook was addressed: the defensive and the enterprising. The defensive, or passive, investor will place his chief emphasis on the avoidance of serious mistakes or losses. His second aim will be freedom from effort, annoyance, and the need for making frequent decisions. The determining trait of the enterprising, or active, or aggressive investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort, in the form of a better average return than that realized by the passive investor. We have some doubt whether a really substantial extra recompense is promised to the active investor under today's conditions. But next year, or the years after, may well be different. We shall, accordingly, continue to devote attention to the possibilities for enterprising investment, as they existed in former periods, and may return. It has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. For example, smart investors, or their smart advisors, would long ago have recognized the great growth possibilities of the computer industry as a whole, and of international business machines in particular. And similarly for a number of other growth industries and growth companies. But this is not as easy as it always looks in retrospect. To bring this point home at the outset, let us add here a paragraph that we included first in the 1949 edition of this book. Such an investor may, for example, be a buyer of air transport stocks, because he believes their future is even more brilliant than the trend the market already reflects. For this class of investor, the value of our audiobook will lie more in its warnings against the pitfalls lurking in this favorite investment approach than in any positive technique that will help him along his path. The pitfalls have proved particularly dangerous in the industry we mentioned. It was, of course, easy to forecast that the volume of air traffic would grow spectacularly over the years. Because of this factor, their shares became a favorite choice of the investment funds. But despite the expansion of revenues, at a pace even greater than in the computer industry, a combination of technological problems and overexpansion of capacity made for fluctuating and even disastrous profit figures. In the year 1970, despite a new high in traffic figures, the airlines sustained a loss of some $200 million for their shareholders. They had shown losses also in 1945 and 1961. The stocks of these companies once again showed a greater decline in 1969 through 70 than did the general market. The record shows that even the highly paid full-time experts of the mutual funds were completely wrong about the fairly short-term future of a major and non-esoteric industry. On the other hand, while the investment funds had substantial investments and substantial gains in IBM, the combination of its apparently high price and the impossibility of being certain about its rate of growth prevented them from having more than, say, 3% of their funds in this wonderful performer. Hence, the effect of this excellent choice on their overall results was by no means decisive. Furthermore, many, if not most, of their investments in computer industry companies other than IBM appear to have been unprofitable. From these two broad examples, we draw two morals for our listeners. 1. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. 2. The experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. The author did not follow this approach in his financial career as fund manager, and he cannot offer either specific counsel or much encouragement to those who may wish to try it. What then will we aim to accomplish in this audiobook? Our main objective will be to guide the listener against the areas of possible substantial error, and to develop policies with which he will be comfortable. We shall say quite a bit about the psychology of investors, for indeed the investor's chief problem, and even his worst enemy, is likely to be himself. The fault, dear investor, is not in our stars, and not in our stocks, but in ourselves. This has proved the more true over recent decades, as it has become more necessary for conservative investors to acquire common stocks, and thus to expose themselves willy-nilly to the excitement and the temptations of the stock market. By argument, examples, and exhortation, we hope to aid our listeners to establish the proper mental and emotional attitudes toward their investment decisions. We have seen much more money made and kept by ordinary people who are temperamentally well-suited for the investment process than by those who lacked this quality, even though they had an extensive knowledge of finance, accounting, and stock market lore. Additionally, we hope to implant in the listener a tendency to measure or quantify. For 99 issues out of 100, we could say that at some price they are cheap enough to buy, and at some other price they would be so dear that they should be sold. The habit of relating what is paid to what is being offered is an invaluable trait in investment. In an article in a women's magazine many years ago, we advised the readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask how much. In June 1970, the question how much could be answered by the magic figure 9.4%, the yield obtainable on new offerings of high-grade public utility bonds. This has now dropped to about 7.3%, but even that return tempts us to ask, why give any other answer? But there are other possible answers, and these must be carefully considered. Besides which, we repeat that both we and our listeners must be prepared in advance for the possibly quite different conditions of, say, 1973 through 1977. We shall therefore present in some detail a positive program for common stock investment, part of which is within the purview of both classes of investors, and part is intended mainly for the enterprising group. Strangely enough, we shall suggest as one of our chief requirements here that our readers limit themselves to issues selling not far above their tangible asset value. The reason for this seemingly outmoded counsel is both practical and psychological. Experience has taught us that while there are many good growth companies worth several times net assets, the buyer of such shares will be too dependent on the vagaries and fluctuations of the stock market. By contrast, the investor in shares, say, of public utility companies at about their net asset value, can always consider himself the owner of an interest in sound and expanding businesses, acquired at a rational price, regardless of what the stock market might say to the contrary. The ultimate result of such a conservative policy is likely to work out better than exciting adventures into the glamorous and dangerous fields of anticipated growth. The art of investment has one characteristic that is not generally appreciated. A credible, if unspectacular result can be achieved by the lay investor with a minimum of effort and capability. But to improve this easily attainable standard requires much application and more than a trace of wisdom. If you merely try to bring just a little extra knowledge and cleverness to bear upon your investment program, instead of realizing a little better than normal results, you may well find that you've done worse. Since anyone, by just buying and holding a representative list, can equal the performance of the market averages, it would seem a comparatively simple matter to beat the averages. But as a matter of fact, the proportion of smart people who try this and fail is surprisingly large. Even the majority of the investment funds, with all their experienced personnel, have not performed so well over the years, as has the general market. Allied to the foregoing is the record of the published stock market predictions of the brokerage houses, for there's strong evidence that their calculated forecasts have been somewhat less reliable than the simple tossing of a coin. In writing this audiobook, we've tried to keep this basic pitfall of investment in mind. The virtues of a simple portfolio policy have been emphasized, the purchase of high-grade bonds, plus a diversified list of leading common stocks, which any investor can carry out with a little expert assistance. The adventure beyond this safe and sound territory has been presented as fraught with challenging difficulties, especially in the area of temperament. Before attempting such a venture, the investor should feel sure of himself and of his advisors, particularly as to whether they have a clear concept of the differences between investment and speculation, and between market price and underlying value. A strong-minded approach to investment, firmly based on the margin of safety principle, can yield handsome rewards. But a decision to try for these emoluments, rather than for the assured fruits of defensive investment, should not be made without much self-examination. A final retrospective thought. When the young author entered Wall Street in June 1914, no one had any inkling of what the next half-century had in store. The stock market did not even suspect that a world war was to break out in 2 months, and close down the New York Stock Exchange. Now, in 1972, we find ourselves the richest and most powerful country on earth, but beset by all sorts of major problems, and more apprehensive than confident of the future. Yet if we confine our attention to American investment experience, there is some comfort to be gleaned from the last 57 years. Through all their vicissitudes and casualties, as earth-shaking as they were unforeseen, it remained true that sound investment principles produced generally sound results. We must act on the assumption that they will continue to do so. Note to the listener. This audiobook does not address itself to the overall financial policy of savers and investors. It deals only with that portion of their funds which they are prepared to place in marketable or redeemable securities, that is, in bonds and stocks. Consequently, we do not discuss such important media as savings and time deposits, savings and loan association accounts, life insurance, annuities, and real estate mortgages or equity ownership. The listener should bear in mind that when he finds the word now, or the equivalent in the text, it refers to late 1971 or early 1972. Commentary on the introduction. If you have built castles in the air, your work need not be lost. That is where they should be. Now, put the foundations under them. Henry David Thoreau, Walden. Notice that Graham announces from the start that this book will not tell you how to beat the market. No truthful book can. Instead, this book will teach you 3 powerful lessons. How you can minimize the odds of suffering irreversible losses. How you can maximize the chances of achieving sustainable gains. How you can control the self-defeating behavior that keeps most investors from reaching their full potential. Back in the boom years of the late 1990s, when technology stocks seemed to be doubling in value every day, the notion that you could lose almost all your money seemed absurd. But by the end of 2002, many of the dot-com and telecom stocks had lost 95% of their value, or more. Once you lose 95% of your money, you have to gain 1,900% just to get back to where you started. Taking a foolish risk can put you so deep in the hole that it's virtually impossible to get out. That's why Graham constantly emphasizes the importance of avoiding losses, not just in chapters 6, 14, and 20, but in the threads of warning that he has woven throughout his entire text. But no matter how careful you are, the price of your investments will go down from time to time. While no one can eliminate that risk, Graham will show you how to manage it, and how to get your fears under control. Are you an intelligent investor? Now let's answer a vitally important question. What exactly does Graham mean by an intelligent investor? Back in the first edition of this book, Graham defines the term, and he makes it clear that this kind of intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. This kind of intelligence, explains Graham, is a trait more of the character than of the brain. There's proof that high IQ and higher education are not enough to make an investor intelligent. In 1998, Long-Term Capital Management LP, a hedge fund run by a battalion of mathematicians, computer scientists, and 2 Nobel Prize-winning economists, lost more than $2 billion in a matter of weeks on a huge bet that the bond market would return to normal. But the bond market kept right on becoming more and more abnormal, and LTCM had borrowed so much money that its collapse nearly capsized the global financial system. And back in the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company, the hottest stock in England. Sensing that the market was getting out of hand, the great physicist muttered that he could calculate the motions of the heavenly bodies, but not the madness of the people. Newton dumped his South Sea shares, pocketing 100% profit, totaling £7,000. But just months later, swept up in the wild enthusiasm of the market, Newton jumped back in at a much higher price and lost £20,000, or more than $3 million in today's money. For the rest of his life, he forbade anyone to speak the words South Sea in his presence. Sir Isaac Newton was one of the most intelligent people who ever lived, as most of us would define intelligence. But in Graham's terms, Newton was far from an intelligent investor. By letting the roar of the crowd override his own judgment, the world's greatest scientist acted like a fool. In short, if you failed at investing so far, it's not because you're stupid. It's because, like Sir Isaac Newton, you haven't developed the emotional discipline that successful investing requires. In Chapter 8, Graham describes how to enhance your intelligence by harnessing your emotions and refusing to stoop to the market's level of irrationality. There, you can master his lesson that being an intelligent investor is more a matter of character than brain. A Chronicle of Calamity. Now let's take a moment to look at some of the major financial developments of the past few years. 1. The worst market crash since the Great Depression, with U.S. stocks losing 50.2% of their value, or $7.4 trillion, between March 2000 and October 2002. 2. Far deeper drops in the share prices of the hottest companies of the 1990s, including AOL, Cisco, JDS Uniphase, Lucent, and Qualcomm, plus the utter destruction of hundreds of internet stocks. 3. Accusations of massive financial fraud at some of the largest and most respected corporations in America, including Enron, Tyco, and Xerox. 4. The bankruptcies of such once glistening companies as Conseco, Global Crossing, and WorldCom. 5. Allegations that accounting firms cooked the books and even destroyed records to help their clients mislead the investing public. 6. Charges that top executives at leading companies siphoned off hundreds of millions of dollars for their own personal gain. 7. Proof that security analysts on Wall Street praised stocks publicly, but admitted privately that they were garbage. 8. A stock market that even after its blood-curdling decline seems overvalued by historical measures, suggesting to many experts that stocks have further yet to fall. 9. A relentless decline in interest rates that has left investors with no attractive alternative to stocks. 10. An investing environment bristling with the unpredictable menace of global terrorism and war in the Middle East. Much of this damage could have been and was avoided by investors who learned and lived by Graham's principles. As Graham puts it, while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. By letting themselves get carried away on internet stocks, on big growth stocks, on stocks as a whole, many people made the same stupid mistakes as Sir Isaac Newton. They let other investors' judgments determine their own. They ignored Graham's warning that the really dreadful losses always occur after the buyer forgot to ask how much. Most painfully of all, by losing their self-control just when they needed it the most, these people proved Graham's assertion that the investor's chief problem, and even his worst enemy, is likely to be himself. The sure thing that wasn't. Many of those people got especially carried away on technology and internet stocks, believing the high-tech hype that this industry would keep outgrowing every other for years to come, if not forever. In mid-1999, after earning a 117.3% return in just the first 5 months of the year, Monument Internet Fund portfolio manager Alexander Chung predicted that his fund would gain 50% a year over the next 3 to 5 years, and an annual average of 35% over the next 20 years. After his Amerinido Technology Fund rose an incredible 248.9% in 1999, portfolio manager Alberto Villar ridiculed anyone who dared to doubt that the internet was a perpetual money-making machine. If you're out of this sector, you're going to underperform. You're in a horse and buggy, and I'm in a Porsche. You don't like tenfold growth opportunities? Then go with someone else. In February 2000, hedge fund manager James J. Cramer proclaimed that internet-related companies are the only ones worth owning right now. These winners of the new world, as he called them, are the only ones that are going higher consistently in good days and bad. Cramer even took a pot shot at Graham. You have to throw out all of the matrices and formulas and texts that existed before the web. If we used any of what Graham and Dodd teach us, we wouldn't have a dime under management. All these so-called experts ignored Graham's sober words of warning. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. While it seems easy to foresee which industry will grow the fastest, that foresight has no real value if most other investors are already expecting the same thing. By the time everyone decides that a given industry is obviously the best one to invest in, the prices of its stocks have been bid up so high that its future returns have nowhere to go but down. For now, at least, no one has the gall to try claiming that technology will still be the world's greatest growth industry. But make sure you remember this. The people who now claim that the next sure thing will be healthcare or energy or real estate or gold are no more likely to be right in the end than the hypesters of high-tech turned out to be. The silver lining. If no price seemed too high for stocks in the 1990s, in 2003, we've reached the point at which no price appears to be low enough. The pendulum is swung, as Graham knew it always does, from irrational exuberance to unjustifiable pessimism. In 2002, investors yanked $27 billion out of stock mutual funds, and a survey conducted by the Securities Industry Association found that 1 out of 10 investors had cut back on stocks by at least 25%. The same people who were eager to buy stocks in the late 1990s, when they were going up in price and therefore becoming expensive, sold stocks as they went down in price, and by definition became cheaper. As Graham shows so brilliantly in Chapter 8, this is exactly backwards. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market, since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market, since it puts stocks back on sale. So take heart. The death of the bull market is not the bad news everyone believes it to be. Thanks to the decline in stock prices, now is a considerably safer and saner time to be building wealth. Listen on, and let Graham show you how. Chapter 1. Investment versus speculation. Results to be expected by the intelligent investor. This chapter will outline the viewpoints that will be set forth in the remainder of the audiobook. In particular, we wish to develop at the outset our concept of appropriate portfolio policy for the individual, non-professional investor. Investment versus speculation. What do we mean by investor? Throughout this audiobook, the term will be used in contradistinction to speculator. As far back as 1934, in our textbook Security Analysis, we attempted a precise formulation of the difference between the two, as follows. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we've clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of the term investor during this period. After the great market decline of 1929 through 1932, all common stocks were widely regarded as speculative by nature. A leading authority stated flatly that only bonds could be bought for investment. Thus, we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our listeners from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In our last edition, we cited the following headline of a front-page article of our leading financial journal in June 1962. Small investors bearish. They are selling odd lots short. In October 1970, the same journal had an editorial critical of what it called reckless investors, who this time were rushing in on the buying side. These quotations well illustrate the confusion that has been dominant for many years in the use of the words investment and speculation. Think of our suggested definition of investment given before, and compare it with the sale of a few shares of stock by an inexperienced member of the public, who does not even own what he is selling, and has some largely emotional conviction that he will be able to buy them back at a much lower price. It is not irrelevant to point out that when the 1962 article appeared, the market had already experienced a decline of major size, and was now getting ready for an even greater upswing. It was about as poor a time as possible for selling short. In a more general sense, the later used phrase reckless investors could be regarded as a laughable contradiction in terms, something like spendthrift misers. Were this misuse of language not so mischievous? The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys or for what purpose, or at what price, or whether for cash or on margin. Compare this with the attitude of the public toward common stocks in 1948. when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. About half gave as their reason not safe, a gamble, and about half the reason not familiar with. It is indeed ironical, though not surprising, that common stock purchases of all kinds were quite generally regarded as highly speculative or risky, at a time when they were selling on a most attractive basis, and due soon to begin their greatest advance in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels, as judged by past experience, later transformed them into investments, and the entire stock-buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street as an institution would be well advised to reinstate this distinction, and to emphasize it in all its dealings with the public. Otherwise, the stock exchanges may someday be blamed for heavy speculative losses, which those who suffered them had not been properly warned against. Ironically, once more, much of the recent financial embarrassment of some stock exchange firms seems to have come from the inclusion of speculative common stocks in their own capital funds. We trust that the listener of this audiobook will gain a reasonably clear idea of the risks that are inherent in common stock commitments, risks which are inseparable from the opportunities of profit that they offer, and both of which must be allowed for in the investor's calculations. What we've just said indicates that there may no longer be such a thing as a Simon Pure investment policy comprising representative common stocks, in the sense that one can always wait to buy them at a price that involves no risk of a market or quotational loss large enough to be disquieting. In most periods, the investor must recognize the existence of a speculative factor in his common stock holdings. It is his task to keep this component within minor limits, and to be prepared financially and psychologically for adverse results that may be of short or long duration. 2 paragraphs should be added about stock speculation per se, as distinguished from the speculative component now inherent in most representative common stocks. Outright speculation is neither illegal, immoral, nor, for most people, fattening to the pocketbook. More than that, some speculation is necessary and unavoidable, for in many common stock situations, there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. There is intelligent speculation, as there is intelligent investing, but there are many ways in which speculation may be unintelligent. Of these, the foremost are 1. Speculating when you think you are investing, 2. Speculating seriously instead of as a pastime when you lack proper knowledge and skill for it, and 3. Risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin plus should recognize that he is, ipso facto, speculating, and it is his broker's duty so to advise him. And everyone who buys a so-called hot common stock issue, or makes a purchase in any way similar thereto, is either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you're ahead of the game. If you want to try your luck at it, put aside a portion, the smaller the better, of your capital in a separate fund for this purpose. Never add more money to this account just because the market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Results to be expected by the defensive investor. We've already defined the defensive investor as one interested chiefly in safety plus freedom from bother. In general, what course should he follow, and what return can he expect under average normal conditions, if such conditions really exist? To answer these questions, we shall consider first what we wrote on the subject 7 years ago. Next, what significant changes have occurred since then in the underlying factors governing the investor's expectable return. And finally, what he should do and what he should expect under present-day, early 1972 conditions. 1. What we said 6 years ago. We recommended that the investor divide his holdings between high-grade bonds and leading common stocks, that the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component. That his simplest choice would be to maintain a 50-50 proportion between the two, with adjustments to restore the equality when market developments had disturbed it by as much as, say, 5%. As an alternative policy, he might choose to reduce his common stock component to 25%, if he felt the market was dangerously high, and, conversely, to advance it toward the maximum of 75% if he felt that a decline in stock prices was making them increasingly attractive. In 1965, the investor could obtain about 4.5% on high-grade taxable bonds, and 3.25% on good tax-free bonds. The dividend return on leading common stocks, with the DJIA at 892, was only about 3.2%. This fact, and others, suggested caution. We implied that at normal levels of the market, the investor should be able to obtain an initial dividend return of between 3.5% and 4.5% on his stock purchases, to which should be added a steady increase in underlying value, and in the normal market price of a representative stock list of about the same amount, giving a return from dividends and appreciation combined of about 7.5% per year. The half-and-half division between bonds and stocks would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against the loss of purchasing power caused by large-scale inflation. It should be pointed out that this arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. That rate had averaged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results since 1949 would imply not very good but bad results for the future. 2. What has happened since 1964? The major change since 1964 has been the rise in interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 7.5%, and even more against 4.5% in 1964. In the meantime, the dividend return on DJIA-type stocks had a fair advance also during the market decline of 1969 through 70. But as we write, with the Dow at 900, it is less than 3.5% against 3.2% at the end of 1964. The change in going interest rates produced a maximum decline of about 38% in the market price of medium-term, say 20-year bonds, during this period. There is a paradoxical aspect to these developments. In 1964, we discussed at length the possibility that the price of stocks might be too high and subject ultimately to a serious decline. But we did not consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn that a long-term bond may vary widely in price in response to changes in interest rates. In the light of what has since happened, we think that this warning, with attendant examples, was insufficiently stressed. For the fact is that if the investor had a given sum in the DJIA at its closing price of $874 in 1964, he would have had a small profit thereon in late 1971. Even at the lowest level, $631 in 1970, his indicated loss would have been less than that shown on good long-term bonds. On the other hand, if he had confined his bond-type investments to U.S. savings bonds, short-term corporate issues, or savings accounts, he would have had no loss in market value of his principal during this period, and he would have enjoyed a higher income return than was offered by good stocks. It turned out, therefore, that true cash equivalents proved to be better investments in 1964 than common stocks, in spite of the inflation experience that, in theory, should have favored stocks over cash. The decline in quoted principal value of good, longer-term bonds was due to developments in the money market, an abstruse area which ordinarily does not have an important bearing on the investment policy of individuals. This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always, bonds have fluctuated much less than stock prices, and investors generally could buy bonds of any maturity without having to worry about changes in their market value. There were a few exceptions to this rule, and the period after 1964 proved to be one of them. We shall have more to say about change in bond prices in a later chapter. 3. Expectations and policy in late 1971 and early 1972. Toward the end of 1971, it was possible to obtain 8% taxable interest on good medium-term corporate bonds, and 5.7% tax-free on good state or municipal securities. In the shorter-term field, the investor could realize about 6% on U.S. government issues due in 5 years. In the latter case, the buyer need not be concerned about a possible loss in market value, since he is sure of full repayment, including the 6% interest return, at the end of a comparatively short holding period. The DJIA, at its recurrent price level of 900 in 1971, yields only 3.5%. Let us assume that now, as in the past, the basic policy decision to be made is how to divide the fund between high-grade bonds, or other so-called cash equivalents, and leading DJIA-type stocks. What course should the investor follow under present conditions, if we have no strong reason to predict either a significant upward or a significant downward movement for some time in the future? First, let us point out that if there is no serious adverse change, the defensive investor should be able to count on the current 3.5% dividend return on his stocks, and also on an average annual appreciation of about 4%. As we shall explain later, this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually out of undistributed profits. On a before-tax basis, the combined return of his stocks would then average, say, 7.5%, somewhat less than his interest on high-grade bonds. On an after-tax basis, the average return on stocks would work out at some 5.3%. This would be about the same as is now obtainable on good tax-free medium-term bonds. These expectations are much less favorable for stocks against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight of the fact that the interest and principal payments on good bonds are much better protected and therefore more certain than the dividends and price appreciation on stocks. Consequently, we're forced to the conclusion that now, toward the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changes significantly in favor of stocks. But of course, we cannot be certain that bonds will work out better than stocks from today's levels. The listener will immediately think of the inflation factor as a potent reason on the other side. In the next chapter, we shall argue that our considerable experience with inflation in the United States during this century would not support the choice of stocks against bonds at present differentials in yield. But there's always the possibility, though we consider it remote, of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable without stepped-up inflation as to justify a large increase in common stock values in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of these reasons, and perhaps others we haven't thought of, might cause the investor to regret a 100% concentration on bonds, even at their more favorable yield levels. Hence, after this foreshortened discussion of the major considerations, we once again enunciate the same basic compromise policy for defensive investors, namely, that at all times they have a significant part of their funds in bond-type holdings, and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components, or a ratio, dependent on their judgment, varying between a minimum of 25% and a maximum of 75% of either. We shall give our more detailed view of these alternative policies in a later chapter. Since at present the overall return envisaged from common stocks is nearly the same as that from bonds, the presently expectable return, including growth of stock values, for the investor would change little regardless of how he divides his fund between the two components. As calculated before, the aggregate return from both parts should be about 7.8% before taxes, or 5.5% on a tax-free or estimated tax-paid basis. A return of this order is appreciably higher than that realized by the typical conservative investor over most of the long-term past. It may not seem attractive in relation to the 14% or so return shown by common stocks during the 20 years of the predominantly bull market after 1949. But it should be remembered that between 1949 and 1969, the price of the DJIA had advanced more than five-fold, while its earnings and dividends had about doubled. Hence, the greater part of the impressive market record for that period was based on a change in investors' and speculators' attitudes, rather than in underlying corporate values. To that extent, it might well be called a bootstrap operation. In discussing the common stock portfolio of the defensive investor, we have spoken only of leading issues of the type included in the 30 components of the Dow Jones Industrial Average. We've done this for convenience, and not to imply that these 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list. These would include a host of public utilities, which have a separate Dow Jones average to represent them. But the major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified or representative list than from another, or more accurately, that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970, The DJIA advanced from 616 to 839, or 36%. But in the same period, the much larger Standard & Poor's weighted index of 500 stocks rose from 58.11 to 92.15, or 58%. Obviously, the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often, that the investor cannot hope for better than average results by buying new offerings, or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such a list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis, as established by intelligent analysis. To conclude this section, let us mention briefly 3 supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds or commingled funds operated by trust companies and banks in many states. Or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it is high, and he is likely to end up with a satisfactory overall price for all his holdings. Strictly speaking, this method is an application of a broader approach, known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum, in inverse relationship to the action of the market. These ideas have merit for the defensive investor, and they will be discussed more aptly in later chapters. Results to be expected by the aggressive investor. Our enterprising security buyer, of course, will desire and expect to attain better overall results than his defensive or passive companion. But first he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study, and native ability into Wall Street and to end up with losses instead of profits. These virtues, if channeled in the wrong directions, become indistinguishable from handicaps. Thus, it is most essential that the enterprising investor start with a clear conception as to which courses of action offer reasonable chances of success, and which do not. First, let us consider several ways in which investors and speculators generally have endeavored to obtain better than average results. These include 1. Trading in the market. This usually means buying stocks when the market has been advancing, and selling them after it has turned downward. The stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Here, they will sell issues they do not own, but borrow through the established mechanism of the stock exchanges. Their object is to benefit from a subsequent decline in the price of these issues by buying them back at a price lower than they sold them for. As our quotation from the Wall Street Journal indicates, even small investors, perish the term, sometimes try their unskilled hand at short selling. 2. Short-term selectivity. This means buying stocks of companies which are reporting or expected to report increased earnings, or for which some other favorable development is anticipated. 3. Long-term selectivity. Here the usual emphasis is on an excellent record of past growth, which is considered likely to continue in the future. In some cases, also the investor may choose companies which have not yet shown impressive results, but are expected to establish a high earning power later. Such companies belong frequently in some technological area, for example, computers, drugs, electronics, and they often are developing new processes or products that are deemed to be especially promising. We have already expressed a negative view about the investor's overall chances of success in these areas of activity. The first we've ruled out on both theoretical and realistic grounds from the domain of investment. Stock trading is not an operation which on thorough analysis offers safety of principle and a satisfactory return. More will be said on stock trading in a later chapter. In his endeavor to select the most promising stocks either for the near term or the longer future, the investor faces obstacles of 2 kinds. The first stemming from human fallibility, and the second from the nature of his competition. He may be wrong in his estimate of the future, or even if he is right, the current market price may already fully reflect what he is anticipating. In the area of near-term selectivity, the current year's results of the company are generally common property on Wall Street. Next year's results, to the extent they are predictable, are already being carefully considered. Hence, the investor who selects issues chiefly on the basis of this year's superior results, or on what he is told he may expect for next year, is likely to find that others have done the same thing for the same reason. In choosing stocks for their long-term prospects, the investor's handicaps are basically the same. The possibility of outright error in the prediction, which we illustrated in our airline example, is no doubt greater than when dealing with near-term earnings. Because the experts frequently go astray in such forecasts, it is theoretically possible for an investor to benefit greatly by making correct predictions, when Wall Street as a whole is making incorrect ones. But that is only theoretical. How many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game of estimating long-term future earnings? We are thus led to the following logical, if disconcerting, conclusion. To enjoy a reasonable chance for continued better-than-average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. Are there any such policies available for the enterprising investor? In theory, once again, the answer should be yes, and there are broad reasons to think that the answer should be affirmative in practice as well. Everyone knows that speculative stock movements are carried too far in both directions, frequently in the general market and at all times in at least some of the individual issues. Furthermore, a common stock may be undervalued because of lack of interest or unjustified popular prejudice. We can go further and assert that in an astonishingly large portion of the trading in common stocks, those engaged therein don't appear to know, in polite terms, one part of their anatomy from another. In this audiobook, we shall point out numerous examples of past discrepancies between price and value. Thus it seems that any intelligent person with a good head for figures should have a veritable picnic on Wall Street, battening off other people's foolishness. So it seems. But somehow it doesn't work out that simply. Buying a neglected and therefore undervalued issue for profit generally proves a protracted and patience-trying experience. And selling short a too popular and therefore overvalued issue is apt to be a test not only of one's courage and stamina, but also of the depth of one's pocketbook. The principle is sound. Its successful application is not impossible, but it is distinctly not an easy art to master. There is also a fairly wide group of special situations, which over many years could be counted on to bring a nice annual return of 20% or better, with a minimum of overall risk to those who knew their way around in this field. They include intersecurity arbitrages, payouts or workouts in liquidations, protected hedges of certain kinds. The most typical case is a projected merger or acquisition, which offers a substantially higher value for certain shares than their price on the date of the announcement. The number of such deals increased greatly in recent years, and it should have been a highly profitable period for the cognoscenti. But with the multiplication of merger announcements came a multiplication of obstacles to mergers, and of deals that didn't go through. Quite a few individual losses were thus realized in these once reliable operations. Perhaps, too, the overall rate of profit was diminished by too much competition. The lessened profitability of these special situations appears one manifestation of a kind of self-destructive process, akin to the law of diminishing returns, which is developed during the lifetime of this book. In 1949, we could present a study of stock market fluctuations over the preceding 75 years, which supported a formula, based on earnings and current interest rates, for determining a level to buy the DJIA below its central or intrinsic value, and to sell out above such value. It was an application of the governing maxim of the Rothschilds, buy cheap and sell dear, and it had the advantage of running directly counter to the ingrained and pernicious maxim of Wall Street that stocks should be bought because they've gone up and sold because they've gone down. Alas, after 1949, this formula no longer worked. A second illustration is provided by the famous Dow theory of stock market movements, in a comparison of its indicated splendid results for 1897 through 1933, and its much more questionable performance since 1934. A third and final example of the golden opportunities not recently available. A good part of our own operations on Wall Street had been concentrated on the purchase of bargain issues, easily identified as such by the fact that they were selling at less than their share in the net current assets, working capital alone, not counting the plant account and other assets, and after deducting all liabilities ahead of the stock. It is clear that these issues were selling at a price well below the value of the enterprise as a private business. No proprietor or majority holder would think of selling what he owned at so ridiculously low a figure. Strangely enough, such anomalies were not hard to find. In 1957, a list was published showing nearly 200 issues of this type available in the market. In various ways, practically all these bargain issues turned out to be profitable, and the average annual result proved much more remunerative than most other investments. But they too virtually disappeared from the stock market in the next decade, and with them a dependable area for shrewd and successful operation by the enterprising investor. However, at the low prices of 1970, there again appeared a considerable number of such sub-working capital issues, and despite the strong recovery of the market, enough of them remained at the end of the year to make up a full-sized portfolio. The enterprising investor, under today's conditions, still has various possibilities of achieving better-than-average results. The huge list of marketable securities must include a fair number that can be identified as undervalued by logical and reasonably dependable standards. These should yield more satisfactory results on the average than will the DJIA or any similarly representative list. In our view, the search for these would not be worth the investor's effort, unless he could hope to add, say, 5% before taxes to the average annual return from the stock portion of his portfolio. We shall try to develop one or more such approaches to stock selection for use by the active investor. Commentary on Chapter 1. All of human unhappiness comes from one single thing, not knowing how to remain at rest in a room. Blaise Pascal. Why do you suppose the brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell, no matter what the market did that day? Because whenever you trade, they make money, whether you did or not. By speculating instead of investing, you lower your own odds of building wealth and raise someone else's. Graham's definition of investing could not be clearer. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Note that investing, according to Graham, consists equally of three elements. You must thoroughly analyze a company and the soundness of its underlying businesses before you buy its stock. You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary performance. An investor calculates what a stock is worth, based on the value of its businesses. A speculator gambles that a stock will go up in price because somebody else will pay even more for it. As Graham once put it, investors judge the market price by established standards of value, while speculators base their standards of value upon the market price. For a speculator, the incessant stream of stock quotes is like oxygen. Cut it off, and he dies. For an investor, what Graham called quotational values matter much less. Graham urges you to invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. Like casino gambling or betting on the horses, speculating in the market can be exciting, or even rewarding, if you happen to get lucky. But it's the worst imaginable way to build your wealth. That's because Wall Street, like Las Vegas or the racetrack, has calibrated the odds so that the house always prevails, in the end, against everyone who tries to beat the house at its own speculative game. On the other hand, investing is a unique kind of casino, one where you cannot lose in the end, so long as you play only by the rules that put the odds squarely in your favor. People who invest make money for themselves. People who speculate make money for their brokers. And that, in turn, is why Wall Street perennially downplays the durable virtues of investing and hypes the gaudy appeal of speculation. Unsafe at high speed. Confusing speculation with investment, Graham warns, is always a mistake. In the 1990s, that confusion led to mass destruction. Almost everyone, it seems, ran out of patience at once, and America became the speculation nation, populated with traders who went shooting from stock to stock like grasshoppers whizzing around in an August hayfield. People began believing that the test of an investment technique was simply whether it worked. If they beat the market over any period, no matter how dangerous or dumb their tactics, people boasted that they were right. But the intelligent investor has no interest in being temporarily right. To reach your long-term financial goals, you must be sustainably and reliably right. The techniques that became so trendy in the 1990s, day trading, ignoring diversification, flipping hot mutual funds, following stock-picking systems, seemed to work. But they had no chance of prevailing in the long run, because they failed to meet all three of Graham's criteria for investing. To see why temporarily high returns don't prove anything, imagine that two places are 130 miles apart. If I observe the 65-mile-per-hour speed limit, I can drive that distance in 2 hours. But if I drive 130 miles per hour, I can get there in 1 hour. If I try this and survive, am I right? Should you be tempted to try it too, because you hear me bragging that it worked? Flashy gimmicks for beating the market are much the same. In short streaks, So long as your luck holds out, they work. Over time, they will get you killed. In 1973, when Graham last revised The Intelligent Investor, the annual turnover rate on the New York Stock Exchange was 20%, meaning that the typical shareholder held a stock for 5 years before selling it. By 2002, the turnover rate had hit 105%, a holding period of only 11.4 months. Back in 1973, the average mutual fund held on to a stock for nearly 3 years. By 2002, that ownership period had shrunk to just 10.9 months. It's as if mutual fund managers were studying their stocks just long enough to learn they shouldn't have bought them in the first place, then promptly dumping them and starting all over. Even the most respected money management firms got antsy. In early 1995, Jeffrey Vinnick, manager of Fidelity Magellan, then the world's largest mutual fund, had 42.5% of its assets in technology stocks. Vinnick proclaimed that most of his shareholders have invested in the fund for goals that are years away. I think their objectives are the same as mine, and that they believe, as I do, that a long-term approach is best. But 6 months after he wrote those high-minded words, Vinnick sold off almost all his technology shares, unloading nearly $19 billion worth in 8 frenzied weeks. So much for the long term. And by 1999, Fidelity's discount brokerage division was egging on its clients to trade anywhere, anytime, using a Palm handheld computer, which was perfectly in tune with the firm's new slogan, "Every second counts." And on the NASDAQ exchange, turnover hit warp speed, as figure 11 on the enhancement shows. In 1999, shares in Puma Technology, for instance, changed hands on average of once every 5.7 days. Despite NASDAQ's grandiose motto, the stock market for the next 100 years, many of its customers could barely hold on to a stock for 100 hours. The financial video game. Wall Street made online trading sound like an instant way to mint money. Discover Brokerage, the online arm of the venerable firm of Morgan Stanley, ran a TV commercial in which a scruffy tow truck driver picks up a prosperous-looking executive. Spotting a photo of a tropical beachfront posted on the dashboard, the executive asks, "Vacation?" "Actually," replies the driver, "that's my home." Taken aback, the suit says, "Looks like an island." With quiet triumph, the driver answers, "Technically, it's a country." The propaganda went further. Online trading would take no work and require no thought. A television ad from Ameritrade, the online broker, showed 2 housewives just back from jogging. One logs onto her computer, clicks the mouse a few times, and exults, "I think I just made about $1,700. In a TV commercial for the Waterhouse brokerage firm, someone asked basketball coach Phil Jackson, "You know anything about the trade?" His answer, "I'm gonna make it right now." How many games would Jackson's NBA teams have won if he had brought that philosophy to courtside? Somehow, knowing nothing about the other team but saying, "I'm ready to play them right now," doesn't sound like a championship formula. By 1999, at least 6 million people were trading online, and roughly a tenth of them were day trading, using the internet to buy and sell stocks at lightning speed. Everyone from showbiz diva Barbra Streisand to Nicholas Burbis, a 25-year-old former waiter in Queens, New York, was flinging stocks around like live coals. "Before," scoffed Burbis, "I was investing for the long term, and I found out that it was not smart." Now, Burbis traded stocks up to 10 times a day and expected to earn $100,000 in a year. "I can't stand to see red in my profit or loss column." Streisand shuddered in an interview with Fortune. "I'm Taurus the bull, so I react to red. If I see red, I sell my stocks quickly." By pouring continuous data about stocks into bars and barbershops, kitchens and cafes, taxicabs and truck stops, financial websites and financial TV turned the stock market into a non-stop national video game. The public felt more knowledgeable about the markets than ever before. Unfortunately, while people were drowning in data, knowledge was nowhere to be found. Stocks became entirely decoupled from the companies that had issued them. Pure abstractions, just blips moving across a TV or computer screen. If the blips were moving up, nothing else mattered. On December 20th, 1999, Juno Online Services unveiled a trailblazing business plan: to lose as much money as possible, on purpose. Juno announced that it would henceforth offer all its retail services for free. No charge for email, no charge for internet access, and that it would spend millions of dollars more on advertising over the next year. On this declaration of corporate harakiri, Juno's stock roared up from $16.357 to $66.75 in 2 days. Why bother learning whether a business was profitable, or what goods or services a company produced? or who its management was, or even what the company's name was. All you needed to know about stocks was the catchy code of their ticker symbols: CBLT, INKT, PCLN, TGLO, VRSN, WBVN. That way you could buy them even faster, without the pesky 2-second delay of looking them up on an internet search engine. In late 1998, the stock of a tiny, rarely traded building maintenance company, Temco Services, nearly tripled in a matter of minutes on record-high volume. Why? In a bizarre form of financial dyslexia, thousands of traders bought Temco after mistaking its ticker symbol, TMCO, for that of Ticketmaster Online, TMCS, an internet darling whose stock began trading publicly for the first time that day. Oscar Wilde joked that a cynic knows the price of everything and the value of nothing. Under that definition, the stock market is always cynical. But by the late 1990s, it would have shocked Oscar himself. A single half-baked opinion on price could double a company's stock, even as its value went entirely unexamined. In late 1998, Henry Blodgett, an analyst at CIBC Oppenheimer, warned that, as with all internet stocks, evaluation is clearly more art than science. Then, citing only the possibility of future growth, he jacked up his price target on Amazon.com from $150 to $400 in one fell swoop. Amazon.com shot up 19% that day. And, despite Blodgett's protest that his price target was a one-year forecast, soared past $400 in just 3 weeks. A year later, Paine-Webber analyst Walter Piecyk predicted that Qualcomm stock would hit $1,000 a share over the next 12 months. The stock, already up 1,842% that year, soared another 31% that day, hitting $659 a share. From formula to fiasco. But trading as if your underpants are on fire is not the only form of speculation. Throughout the past decade or so, one speculative formula after another was promoted, popularized, and then thrown aside. All of them shared a few traits. This is quick, this is easy, and it won't hurt a bit. And all of them violated at least one of Graham's distinctions between investing and speculating. Here are a few of the trendy formulas that fell flat. Cash in on the calendar. The January effect, the tendency of small stocks to produce big gains around the turn of the year, was widely promoted in scholarly articles and popular books published in the 1980s. These studies showed that if you piled into small stocks in the second half of December and held them into January, you would beat the market by 5 to 10 percentage points. That amazed many experts. After all, if it were this easy, surely everyone would hear about it. Lots of people would do it, and the opportunity would wither away. What caused the January jolt? First of all, many investors sell their crummiest stocks late in the year to lock in losses that can cut their tax bills. Second, professional money managers grow more cautious as the year draws to a close, seeking to preserve their outperformance or minimize their underperformance. That makes them reluctant to buy, or even to hang on to a falling stock. And if an underperforming stock is also small and obscure, a money manager will even be less eager to show it in his year-end list of holdings. All these factors turn small stocks into momentary bargains. When the tax-driven selling ceases in January, they typically bounce back, producing a robust and rapid gain. The January effect is not withered away, but it has weakened. According to finance professor William Schwert of the University of Rochester, if you had bought small stocks in late December and sold them in early January, you would have beaten the market by 8.5 percentage points from 1962 through 1979, by 4.4 points from 1980 through 1989, and by 5.8 points from 1990 through 2001. As more people learned about the January effect, more traders bought small stocks in December, making them less of a bargain, and thus reducing their returns. Also, the January effect is biggest among the smallest stocks. But according to Plexus Group, the leading authority on brokerage expenses, the total cost of buying and selling such tiny stocks can run up to 8% of your investment. Sadly, by the time you're done paying your broker, all your gains on the January effect will melt away. Just do what works. In 1996, an obscure money manager named James O'Shaughnessy published a book called What Works on Wall Street. In it, he argued that investors can do much better than the market. O'Shaughnessy made a stunning claim. From 1954 through 1994, you could have turned $10,000 into $8,074,504, beating the market by more than tenfold, a towering 18.2% average annual return. How? By buying a basket of 50 stocks with the highest one-year returns, 5 straight years of rising earnings, and share prices less than 1.5 times their corporate revenues. As if he were the Edison of Wall Street, O'Shaughnessy obtained U.S. patent number 5,978,778 for his automated strategies and launched a group of 4 mutual funds based on his findings. By late 1999, the funds had sucked in more than $175 million from the public. And in his annual letter to shareholders, O'Shaughnessy stated grandly, "As always, I hope that together we can reach our long-term goals by staying the course and sticking with our time-tested investment strategies." But what works on Wall Street stopped working right after O'Shaughnessy publicized it. As Figure 1-2 on the enhancement shows, 2 of his funds stank so badly that they shut down in early 2000. And the overall stock market, as measured by the S&P 500 index, walloped every O'Shaughnessy fund almost non-stop for nearly 4 years running. In June 2000, O'Shaughnessy moved closer to his own long-term goals by turning the funds over to a new manager, leaving his customers to fend for themselves with those time-tested investment strategies. O'Shaughnessy's shareholders might have been less upset if he had given his book a more precise title. For instance, What Used to Work on Wall Street, until I wrote this book. Follow the Foolish Four. In the mid-1990s, the Motley Fool website and several books hyped the daylights out of a technique called the Foolish Four. According to the Motley Fool, you would have trashed the market averages over the last 25 years and could crush your mutual funds by spending only 15 minutes a year on planning your investments. Best of all, this technique had minimal risk. All you needed to do was this. 1. Take the 5 stocks in the Dow Jones Industrial Average with the lowest stock prices and highest dividend yields. 2. Discard the one with the lowest price. 3. Put 40% of your money in the stock with the second lowest price. 4. Put 20% in each of the 3 remaining stocks. 5. 1 year later, sort the Dow the same way and reset the portfolio according to steps 1 through 4. 6. Repeat until wealthy. Over a 25-year period, the Motley Fool claimed, this technique would have beaten the market by a remarkable 10.1 percentage points annually. Over the next 2 decades, they suggested, $20,000 invested in the Foolish Four should flower into $1,791,000. And they claimed you could do still better by picking the 5 Dow stocks with the highest ratio of dividend yield to the square root of stock price, dropping the one that scored the highest and buying the next 4. Let's consider whether this strategy could meet Graham's definitions of an investment. What kind of thorough analysis could justify discarding the stock with the single most attractive price and dividend, but keeping the 4 that score lower for those desirable qualities? How could putting 40% of your money into only one stock be a minimal risk? And how could a portfolio of only 4 stocks be diversified enough to provide safety of principle? The Foolish Four, in short, was one of the most cockamamie stock-picking formulas ever concocted. The fools made the same mistake as O'Shaughnessy. If you look at a large quantity of data long enough, a huge number of patterns will emerge, if only by chance. By random luck alone, the companies that produce above-average stock returns will have plenty of things in common. But unless those factors cause the stocks to outperform, they can't be used to predict future returns. None of the factors that the Motley Fools discovered with such fanfare, dropping the stock with the best score, doubling up on the one with the second highest score, dividing the dividend yield by the square root of stock price, could possibly cause or explain the future performance of a stock. Money Magazine found that a portfolio made up of stocks whose names contained no repeating letters would have performed nearly as well as the Foolish Four, and for the same reason, luck alone. As Graham never stops reminding us, stocks do well or poorly in the future because the businesses behind them do well or poorly. Nothing more and nothing less. Sure enough, instead of crushing the market, the Foolish Four crushed the thousands of people who were fooled into believing that it was a form of investing. In 2000 alone, the 4 foolish stocks, Caterpillar, Eastman Kodak, SPC, and General Motors, lost 14%, while the Dow dropped by just 4.7%. As these examples show, there's only one thing that never suffers a bear market on Wall Street: dopey ideas. Each of these so-called investing approaches fell prey to Graham's law. All mechanical formulas for earning higher stock performance are a kind of self-destructive process, akin to the law of diminishing returns. There are 2 reasons the returns fade away. If the formula was just based on random statistical flukes, like the Foolish Four, the mere passage of time will expose that it made no sense in the first place. On the other hand, if the formula actually did work in the past, like the January effect, Then, by publicizing it, market pundits always erode and usually eliminate its ability to do so in the future. All this reinforces Graham's warning that you must treat speculation as veteran gamblers treat their trips to the casino. You must never delude yourself into thinking that you're investing when you're speculating. Speculating becomes mortally dangerous the moment you begin to take it seriously. You must put strict limits on the amount you're willing to wager. Just as sensible gamblers take, say, $100 down to the casino floor and leave the rest of their money locked in the safe in their hotel room, the intelligent investor designates a tiny portion of her total portfolio as a mad money account. For most of us, 10% of our overall wealth is the maximum permissible amount to put at speculative risk. Never mingle the money in your speculative account with what's in your investment accounts. Never allow your speculative thinking to spill over into your investing activities. And never put more than 10% of your assets into your mad money account, no matter what happens. For better or worse, the gambling instinct is part of human nature, so it's futile for most people even to try suppressing it. But you must confine and restrain it. That's the single best way to make sure you will never fool yourself into confusing speculation with investment. Chapter 2. The Investor and Inflation. Inflation, and the fight against it, has been very much in the public's mind in recent years. The shrinkage in the purchasing power of the dollar in the past, and particularly the fear, or hope by speculators, of a serious further decline in the future, has greatly influenced the thinking of Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed amount of dollar principal. Holders of stocks, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their shares. On the basis of these undeniable facts, many financial authorities have concluded that 1. Bonds are an inherently undesirable form of investment, and 2. Consequently, common stocks are by their very nature more desirable investments than bonds. We have heard of charitable institutions being advised that their portfolios should consist 100% of stocks and 0% of bonds. This is quite a reversal from the earlier days when trust investments were restricted by law to high-grade bonds and a few choice preferred stocks. Our listeners must have enough intelligence to recognize that even high-quality stocks cannot be a better purchase than bonds under all conditions, regardless of how high the stock market may be and how low the current dividend return compared with the rates available on bonds. A statement of this kind would be as absurd as was the contrary one, too often heard years ago, that any bond is safer than any stock. In this chapter, we shall try to apply various measurements to the inflation factor, in order to reach some conclusions as to the extent to which the investor may wisely be influenced by expectations regarding future rises in the price level. In this matter, as in so many others in finance, we must base our views of future policy on a knowledge of past experience. Is inflation something new for this country? At least in the serious form it has taken since 1965. If we have seen comparable or worse inflations in living experience, what lessons can be learned from them in confronting the inflation of today? Let us start with Table 2.1, found on the enhanced portion of this audiobook, a condensed historical tabulation that contains much information about changes in the general price level and concomitant changes in the earnings and market value of common stocks. Our figures will begin with 1915, and thus cover 55 years, presented at 5-year intervals. We use 1946 instead of 1945 to avoid the last year of wartime price controls. The first thing we notice is that we have had inflation in the past, lots of it. The largest 5-year dose was between 1915 and 1920, when the cost of living nearly doubled. This compares with the advance of 15% between 1965 and 1970. In between, we have had 3 periods of declining prices, and then 6 of advances at varying rates, some rather small. On this showing, the investor should clearly allow for the probability of continuing or recurrent inflation to come. Can we tell what the rate of inflation is likely to be? No clear answer is suggested by our table. It shows variations of all sorts. It would seem sensible, however, to take our cue from the rather consistent record of the past 20 years. The average annual rise in the consumer price level for this period has been 2.5%. That for 1965 through 1970 was 4.5%. That for 1970 alone was 5.4%. Official government policy has been strongly against large-scale inflation, and there is some reasons to believe that federal policies will be more effective in the future than in recent years. We think it would be reasonable for an investor at this point to base his thinking and decisions on a probable, far from certain, rate of future inflation of, say, 3% per annum. This would compare with an annual rate of about 2.5% for the entire period 1915 through 1970. What would be the implications of such an advance? It would eat up in higher living costs, about one-half the income now obtainable on good, medium-term, tax-free bonds, or our assumed after-tax equivalent from high-grade corporate bonds. This would be a serious shrinkage, but it should not be exaggerated. It would not mean that the true value or the purchasing power of the investor's fortune need be reduced over the years. If he spent half his interest income after taxes, he would maintain this buying power intact, even against a 3% annual inflation. But the next question, naturally, is, can the investor be reasonably sure of doing better by buying and holding other things than high-grade bonds, even at the unprecedented rate of return offered in 1970 through 71? Would not, for example, an all-stock program be preferable to a part-bond, part-stock program? Do not common stocks have a built-in protection against inflation, and are they not almost certain to give a better return over the years than will bonds? Have not, in fact, stocks treated the investor far better than have bonds over the 55-year period of our study? The answer to these questions is somewhat complicated. Common stocks have indeed done better than bonds over a long period of time in the past. The rise of the DJIA from an average of 77 in 1950 to an average of 753 in 1970 works out at an annual compounded rate of just about 4%, to which we may add another 4% for average dividend return. The corresponding figures for the S&P composite are about the same. These combined figures of 8% per year are of course much better than the return enjoyed from bonds over the same 55-year period, but they do not exceed that now offered by high-grade bonds. This brings us to the next logical question. Is there a persuasive reason to believe that common stocks are likely to do much better in future years than they have in the last 5.5 decades? Our answer to this crucial question must be a flat no. Common stocks may do better in the future than in the past, but they are far from certain to do so. We must deal here with two different time elements in investment results. The first covers what is likely to occur over the long-term future, say the next 25 years. The second applies to what is likely to happen to the investor, both financially and psychologically, over short or intermediate periods, say 5 years or less. His frame of mind, his hopes and apprehensions, his satisfaction or discontent with what he has done, above all, his decisions what to do next, are all determined not in the retrospect of a lifetime of investment, but rather by his experience from year to year. On this point we can be categorical. There is no close time connection between inflationary or deflationary conditions and the movement of common stock earnings and prices. The obvious example is the recent period, 1966 through 1970. The rise in the cost of living was 22%, the largest in a 5-year period since 1946 through 1950. But both stock earnings and stock prices as a whole have declined since 1965. There are similar contradictions in both directions in the record of previous 5-year periods. Inflation and corporate earnings. Another and highly important approach to the subject is by a study of the earnings rates on capital shown by American business. This has fluctuated, of course, with the general rate of economic activity, but it has shown no general tendency to advance with wholesale prices or the cost of living. Actually, this rate has fallen rather markedly in the past 20 years, in spite of the inflation of the period. To some degree, the decline was due to the charging of more liberal depreciation rates. See Table 2.2. Our extended studies have led to the conclusion that the investor cannot count on much above the recent 5-year rate earned on the DJIA group, about 10% on net tangible assets, book value, behind the shares. Since the market value of these issues is well above their book value, say 900 market versus 560 book in mid-1971, the earnings on current market price work out only at some 6.25%. This relationship is generally expressed in the reverse, or times earnings manner. For example, that the DJIA price of 900 equals 18 times the actual earnings for the 12 months ended June 1971. Our figures gear in directly with the suggestion in the previous chapter that the investor may assume an average dividend return of about 3.5% on the market value of his stocks, plus an appreciation of, say, 4% annually resulting from reinvested profits. Note that each dollar added to book value is here assumed to increase the market price by about $1.60. The listener will object that in the end our calculations make no allowance for an increase in common stock earnings and values to result from our projected 3% annual inflation. Our justification is the absence of any sign that the inflation of a comparable amount in the past has had any direct effects on reported per-share earnings. The cold figures demonstrate that all the large gain in the earnings of the DJIA unit in the past 20 years was due to a proportionately large growth of invested capital coming from reinvested profits. If inflation had operated as a separate favorable factor, its effect would have been to increase the value of previously existing capital. This in turn should increase the rate of earnings on such old capital, and therefore on the old and new capital combined. But nothing of the kind actually happened in the past 20 years, during which the wholesale price level has advanced nearly 40%. Business earnings should be influenced more by wholesale prices than by consumer prices. The only way that inflation can add to common stock values is by raising the rate of earnings on capital investment. On the basis of the past record, this has not been the case. In the economic cycles of the past, good business was accompanied by a rising price level, and poor business by falling prices. It was generally felt that a little inflation was helpful to business profits. This view is not contradicted by the history of 1950 through 1970, which reveals a combination of generally continued prosperity and generally rising prices. But the figures indicate that the effect of all this on the earning power of common stock capital, equity capital, has been quite limited. In fact, it has not even served to maintain the rate of earnings on the investment. Clearly, there have been important offsetting influences which have prevented any increase in the real profitability of American corporations as a whole. Perhaps the most important of these have been 1. A rise in wage rates exceeding the gains in productivity, and 2. The need for huge amounts of new capital, thus holding down the ratio of sales to capital employed. Our figures in Table 2.2 indicate that so far from inflation having benefited our corporations and their shareholders, its effect has been quite the opposite. The most striking figures in our table are those for the growth of corporate debt between 1950 and 1969. It is surprising how little attention has been paid by economists and by Wall Street to this development. The debt of corporations has expanded nearly fivefold, while their profits before taxes a little more than doubled. With a great rise in interest rates during this period, it is evident that the aggregate corporate debt is now an adverse economic factor of some magnitude and a real problem for many individual enterprises. Note that in 1950, net earnings after interest but before income tax were about 30% of corporate debt, while in 1969 they were only 13.2% of debt. The 1970 ratio must have been even less satisfactory. In sum, it appears that a significant part of the 11% being earned on corporate equities as a whole is accomplished by the use of a large amount of new debt costing 4% or less after tax credit. If our corporations had maintained the debt ratio of 1950, their earnings rate on stock capital would have fallen still lower in spite of the inflation. The stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged under the regulatory process. But this may be the place to remark that the very fact that the unit costs of electricity, gas, and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. They are entitled by law to charge rates sufficient for an adequate return on their invested capital, and this will probably protect their shareholders in the future, as it has in the inflations of the past. All of this brings us back to our conclusion that the investor has no sound basis for expecting more than an average overall return of, say, 8% on a portfolio of DJIA-type common stocks purchased at the late 1971 price level. But even if these expectations should prove to be understated by a substantial amount, the case would not be made for an all-stock investment program. If there is one thing guaranteed for the future, it is that the earnings and average annual market value of a stock portfolio will not grow at the uniform rate of 4%, or any other figure. In the memorable words of the elder J.P. Morgan, they will fluctuate. This means, first, that the common stock buyer at today's prices, or tomorrow's, will be running a real risk of having unsatisfactory results therefrom over a period of years. It took 25 years for General Electric and the DJIA itself to recover the ground lost in the 1929-1932 debacle. Besides that, if the investor concentrates his portfolio on common stocks, he's very likely to be led astray either by exhilarating advances or by distressing declines. This is particularly true if his reasoning is geared closely to expectations of further inflation. For then, if another bull market comes along, he will take the big rise not as a danger signal of an inevitable fall, not as a chance to cash in on his handsome profits, but rather as a vindication of the inflation hypothesis, and as a reason to keep on buying common stocks, no matter how high the market level, nor how low the dividend return. That way lies sorrow. Alternatives to common stocks as inflation hedges. The standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935. Luckily for them. In the past 35 years, the price of gold in the open market has advanced from $35 per ounce to $48 in early 1972, a rise of only 35%. But during all this time, the holder of gold has received no income return on his capital, and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank, in spite of the rise in the general price level. The near-complete failure of gold to protect against a loss in the purchasing power of the dollar must cast grave doubt on the ability of the ordinary investor to protect himself against inflation by putting his money in things. Quite a few categories of valuable objects have had striking advances in market value over the years, such as diamonds, paintings by masters, first editions of books, rare stamps and coins, etc. But in many, perhaps most of these cases, there seems to be an element of the artificial, or the precarious, or even the unreal about the quoted prices. Somehow it is hard to think of paying $67,500 for a U.S. silver dollar dated 1804, but not even minted that year, as an investment operation. We acknowledge we're out of our depth in this area. Very few of our listeners will find the swimming safe and easy there. The outright ownership of real estate has long been considered as a sound long-term investment, carrying with it a goodly amount of protection against inflation. Unfortunately, real estate values are also subject to wide fluctuations. Serious errors can be made in location, price paid, etc. There are pitfalls in salesmen's wiles. Finally, diversification is not practical for the investor of moderate means, except by various types of participations with others and with the special hazards that attach to new flotations, not too different from common stock ownership. This too is not our field. All we should say to the investor is, be sure it's yours before you go into it. Conclusion. Naturally, we return to the policy recommended in our previous chapter. Just because of the uncertainties of the future, the investor cannot afford to put all his funds into one basket, neither in the bond basket, despite the unprecedentedly high returns that bonds have recently offered, nor in the stock basket, despite the prospect of continuing inflation. The more the investor depends on his portfolio and the income therefrom, the more necessary it is for him to guard against the unexpected and the disconcerting in this part of his life. It is axiomatic that the conservative investor should seek to minimize his risks. We think strongly that the risks involved in buying, say, a telephone company bond at yields of nearly 7.5% are much less than those involved in buying the DJIA at 900, or any stock list equivalent thereto. But the possibility of large-scale inflation remains, and the investor must carry some insurance against it. There is no certainty that a stock component will insure adequately against such inflation, but it should carry more protection than the bond component. This is what we said on the subject in our 1965 edition, and we would write the same today. It must be evident to the listeners that we have no enthusiasm for common stocks at these levels, 892 for the DJIA. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if we regard them as the lesser of two evils, the greater being the risks in an all-bond holding. Commentary on Chapter 2. Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it. Henny Youngman. Inflation? Who cares about that? After all, the annual rise in the cost of goods and services averaged less than 2.2% between 1997 and 2002, and economists believe that even that rock-bottom rate may be overstated. Think, for instance, of how the prices of computers and home electronics have plummeted, and how the quality of many goods has risen, meaning that consumers are getting better value for their money. In recent years, the true rate of inflation in the United States has probably run around 1% annually, an increase so infinitesimal that many pundits have proclaimed that inflation is dead. The money illusion. There's another reason investors overlook the importance of inflation, what psychologists call the money illusion. If you receive a 2% raise in a year when inflation runs at 4%, you will almost certainly feel better than you will if you take a 2% pay cut during a year when inflation is 0. Yet both changes in your salary leave you in a virtually identical position, 2% worse off after inflation. So long as the nominal or absolute change is positive, we view it as a good thing, even if the real or after-inflation result is negative. And any change in your own salary is more vivid and specific than the generalized change of prices in the economy as a whole. Likewise, investors were delighted to earn 11% on bank certificates of deposit, CDs, in 1980, and are bitterly disappointed to be earning only around 2% in 2003, even though they were losing money after inflation back then, but are keeping up with inflation now. The nominal rate we earn is printed in the bank's ads and posted in its window, where a high number makes us feel good. But inflation eats away at that high number in secret. Instead of taking out ads, inflation just takes away our wealth. That's why inflation is so easy to overlook, and why it's so important to measure your investing success, not just by what you make, but by how much you keep after inflation. More basically still, The intelligent investor must always be on guard against whatever is unexpected and underestimated. There are 3 good reasons to believe that inflation is not dead. As recently as 1973 through 1982, the United States went through one of the most painful bursts of inflation in our history. As measured by the Consumer Price Index, prices more than doubled over that period, rising at an annualized rate of nearly 9%. In 1979 alone, inflation raged at 13.3%, paralyzing the economy in what became known as stagflation, and leading many commentators to question whether America could compete in the global marketplace. Goods and services priced at $100 in the beginning of 1973 cost $230 by the end of 1982, shriveling the value of a dollar to less than 45 cents. No one who lived through it would scoff at such destruction of wealth. No one who is prudent can fail to protect against the risk that it might recur. Since 1960, 69% of the world's market-oriented countries have suffered at least one year in which inflation ran at an annualized rate of 25% or more. On average, those inflationary periods destroyed 53% of an investor's purchasing power. We would be crazy not to hope that America is somehow exempt from such a disaster, but we would be even crazier to conclude that it can never happen here. Rising prices allow Uncle Sam to pay off his debts with dollars that have been cheapened by inflation. Completely eradicating inflation runs against the economic self-interest of any government that regularly borrows money. Half a hedge. What then can the intelligent investor do to guard against inflation? The standard answer is buy stocks, but as common answers so often are, it's not entirely true. Figure 2.1, shown on the enhancement, shows for each year from 1926 through 2002 the relationship between inflation and stock prices. As you can see, in years when the prices of consumer goods and services fell, as on the left side of the graph, stock returns were terrible, with the market losing up to 43% of its value. When inflation shot above 6%, as in the years on the right end of the graph, stocks also stank. The stock market lost money in 8 of the 14 years in which inflation exceeded 6%. The average return for those 14 years was a measly 2.6%. While mild inflation allows companies to pass the increased costs of their own raw materials on to customers, high inflation wreaks havoc, forcing customers to slash their purchases and depressing activity throughout the economy. The historical evidence is clear. Since the advent of accurate stock market data in 1926, there have been 64 5-year periods, for example, 1926 through 1930, 1927 through 1931, 1928 through 1932, and so on through 1998 through 2002. In 50 of those 64 5-year periods, or 78% of the time, stocks outpaced inflation. That's impressive, but imperfect. It means that stocks failed to keep up with inflation about 1/5 of the time. 2 acronyms to the rescue. Fortunately, you can bolster your defenses against inflation by branching out beyond stocks. Since Graham last wrote, 2 inflation fighters have become widely available to investors. REITs, Real Estate Investment Trusts, or REITs, are companies that own and collect rent from commercial and residential properties. Bundled into real estate mutual funds, REITs do a decent job of combating inflation. The best choice is Vanguard REIT Index Fund. Other relatively low-cost choices include Cohen & Steers Realty Shares, Columbia Real Estate Equity Fund, and Fidelity Real Estate Investment Fund. While a REIT fund is unlikely to be a foolproof inflation fighter, in the long run it should give you some defense against the erosion of purchasing power without hampering your overall returns. TIPS. Treasury Inflation Protected Services, or TIPS, are U.S. government bonds, first issued in 1997, that automatically go up in value when inflation rises. Because the full faith and credit of the United States stands behind them, all Treasury bonds are safe from the risk of default, or non-payment of interest. But TIPS also guarantee that the value of your investment won't be eroded by inflation. In one easy package, you insure yourself against financial loss and the loss of purchasing power. There is one catch, however. When the value of your TIPS bond rises as inflation heats up, the Internal Revenue Service regards that increase in value as taxable income, even though it is purely a paper gain, unless you sold the bond at its newly higher price. Why does this make sense to the IRS? The intelligent investor will remember the wise words of financial analyst Mark Schwaber. The one question never to ask a bureaucrat is why. Because of this exasperating tax complication, TIPS are best suited for a tax-deferred retirement account, like an IRA, KEO, or 401k, where they will not jack up your taxable income. You can buy TIPS directly from the U.S. government at www.publicdebt.treas.gov/of/OFINFLIN.HTM. or in a low-cost mutual fund like Vanguard Inflation-Protected Securities or Fidelity Inflation-Protected Bond Fund. Either directly or through a fund, tips are the ideal substitute for the proportion of your retirement funds you would otherwise keep in cash. Do not trade them. Tips can be volatile in the short run, so they work best as a permanent, lifelong holding. For most investors, allocating at least 10% of your retirement assets to tips is an intelligent way to keep a portion of your money absolutely safe, and entirely beyond the reach of the long, invisible claws of inflation. Chapter 3. A Century of Stock Market History. The Level of Stock Prices in Early 1972. The investor's portfolio of common stocks will represent a small cross-section of that immense and formidable institution known as the stock market. Prudence suggests that he have an adequate idea of stock market history, in terms particularly of the major fluctuations in its price level, and of the varying relationships between stock prices as a whole and their earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the market as it presents itself at different times. By coincidence, useful statistical data on prices, earnings, and dividends go back just 100 years to 1871. The material is not nearly as full or dependable in the first half period as in the second, but it will serve. In this chapter we shall present the figures in highly condensed form with two objects in view. The first is to show the general manner in which stocks have made their underlying advance through the many cycles of the past century. The second is to view the picture in terms of successive 10-year averages, not only of stock prices, but of earnings and dividends as well, to bring out the varying relationship between the three important factors. With this wealth of material as a background, we shall pass to a consideration of the level of stock prices at the beginning of 1972. The long-term history of the stock market is summarized in two tables and a chart. Table 3.1, which you can view on the enhanced portion of this audiobook, sets forth the low and high points of 19 bear and bull market cycles in the past 100 years. We have used two indexes here. The first represents a combination of an early study by the Cowles Commission, going back to 1870, which has been spliced onto and continued to date in the well-known Standard & Poor's Composite Index of 500 stocks. The second is the even more celebrated Dow Jones Industrial Average, the DJIA, or the Dow, which dates back to 1897. It contains 30 companies, of which one is American Telephone and Telegraph, and the other 29 are large industrial enterprises. Chart 1, presented by courtesy of Standard & Poor's and reproduced on the enhancement, depicts the market fluctuations of its 425 industrial stock index from 1900 through 1970. A corresponding chart available for the DJIA will look very much the same. The listener will note three quite distinct patterns, each covering about a third of the 70 years. The first runs from 1900 to 1924, and shows for the most part a series of rather similar market cycles, lasting from 3 to 5 years. The annual advance in this period averaged just about 3%. We move on to the new era bull market, culminating in 1929 with its terrible aftermath of collapse, followed by quite irregular fluctuations until 1949. Comparing the average level of 1949 with that of 1924, we find the annual rate of advance to be a mere 1.5%. Hence, the close of our second period found the public with no enthusiasm at all for common stocks. By the rule of opposites, the time was ripe for the beginning of the greatest bull market in our history, presented in the last third of our chart. This phenomenon may have reached its culmination in December 1968 at 118 for Standard & Poor's 425 industrials, and 108 for its 500 stock composite. As Table 3.1 shows, there were fairly important setbacks between 1949 and 1968. Especially in 1956 through 57 and 1961 through 62. But the recoveries therefrom were so rapid that they had to be denominated in the long-accepted semantics as recessions in a single bull market, rather than as separate market cycles. Between the low level of 162 for the Dow in mid-1949 and the high of 995 in early 1966, the advance had been more than six-fold in 17 years, which is at the average compounded rate of 11% per year. Not counting dividends of, say, 3.5% per annum. The advance for the Standard & Poor's Composite Index was somewhat greater than that of the DJIA, actually from 14 to 96. These 14% and better returns were documented in 1963, and later in a much publicized study. It created a natural satisfaction on Wall Street with such fine achievements, and a quite illogical and dangerous conviction that equally marvelous results could be expected for common stocks in the future. Few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone. The subsequent decline from the 1968 high to the 1970 low was 36% for the Standard & Poor's Composite and 37% for the DJIA, the largest since the 44% suffered in 1939 through 1942, which had reflected the perils and uncertainties after Pearl Harbor. In the dramatic manner so characteristic of Wall Street, the low level of May 1970 was followed by a massive and speedy recovery of both averages, and the establishment of a new all-time high for the Standard & Poor's Industrials in early 1972. The annual rate of price advance between 1949 and 1970 works out at about 9% for the S&P Composite, or the Industrial Index, using the average figures for both years. That rate of climb was of course much greater than for any similar period before 1950. But in the last decade the rate of advance was much lower, 5.25% for the S&P Composite Index and only the once familiar 3% for the DJIA. The record of price movements should be supplemented by corresponding figures for earnings and dividends in order to provide an overall view of what has happened to our share economy over the 10 decades. We present a conspectus of this kind in our Table 3.2. It is a good deal to expect from the listener that he study all these figures with care, but for some, we hope they'll be interesting and instructive. Let us comment on them as follows. The full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Only 2 of the 9 decades after the first show a decrease in earnings and average prices, in 1891 through 1900 and 1931 through 1940. And no decade after 1900 shows a decrease in average dividends. But the rates of growth in all 3 categories are quite variable. In general, the performance since World War II has been superior to that of earlier decades, but the advance in the 1960s was less pronounced than that of the 1950s. Today's investor cannot tell from this record what percentage gain in earnings, dividends, and prices he may expect in the next 10 years, but it does supply all the encouragement he needs for a consistent policy of common stock investment. However, a point should be made here that is not disclosed in our table. The year 1970 was marked by a definite deterioration in the overall earnings posture of our corporations. The rate of profit on invested capital fell to the lowest percentage since the World War years. Equally striking is the fact that a considerable number of companies reported net losses for the year. Many became financially troubled, and for the first time in 3 decades, there were quite a few important bankruptcy proceedings. These facts, as much as any others, have promoted the statement made before, that the Great Boom era may have come to an end in 1969 through 1970. A striking feature of Table 3.2 is the change in the price-earnings ratios since World War II. Take a look at it on the enhancement. In June 1949, the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months. In March 1961, the ratio was 22.9 times. Similarly, the dividend yield on the S&P Index had fallen from over 7% in 1949 to only 3% in 1961. A contrast heightened by the fact that interest rates on high-grade bonds had meanwhile risen from 2.6% to 4.5%. This is certainly the most remarkable turnabout in the public's attitude in all stock market history. To people of long experience and innate caution, the passage from one extreme to another carried a strong warning of trouble ahead. They could not help thinking apprehensively of the 1926 through 1929 bull market and its tragic aftermath. But these fears have not been confirmed by the event. True, the closing price of the DJIA in 1970 was the same as it was 6.5 years earlier, and the much-heralded soaring 60s proved to be mainly a march up a series of high hills and then down again. But nothing has happened either to business or to stock prices that can compare with the bear market and depression of 1929 through 1932. The stock market level in early 1972. With a century-long conspectus of stock, prices, earnings, and dividends before our eyes, let us try to draw some conclusions about the level of 900 for the DJIA and 100 for the S&P Composite Index in January 1972. In each of our former editions, we've discussed the level of the stock market at the time of writing and endeavored to answer the question whether it was too high for conservative purchase. The listener may find it informing to review the conclusions we reached on these earlier occasions. This is not entirely an exercise in self-punishment. It will supply a sort of connecting tissue that links the various stages of the stock market in the past 20 years, and also a taken-from-life picture of the difficulties facing anyone who tries to reach an informed and critical judgment of current market levels. Let us first reproduce the summary of 1948, 1953, and 1959 analyses that we gave in the 1965 edition. In 1948, we applied conservative standards to the Dow Jones level of 180 and found no difficulty in reaching the conclusion that it was not too high in relation to underlying values. When we approached this problem in 1953, the average market level for that year had reached 275, a gain of over 50% in 5 years. We asked ourselves the same question, namely, whether in our opinion the level of 275 for the Dow Jones Industrials was or was not too high for sound investment. In the light of the subsequent spectacular advance, it may seem strange to have to report that it was by no means easy for us to reach a definitive conclusion as to the attractiveness of the 1953 level. We did say, positively enough, that from the standpoint of value indications, our chief investment guide, the conclusion about 1953 stock prices must be favorable. But we were concerned about the fact that in 1953, the averages had advanced for a longer period than in most bull markets of the past, and that its absolute level was historically high. Setting these factors against our favorable value judgment, we advised a cautious or compromise policy. As it turned out, this was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance an additional 100% in the next 5 years. Perhaps we should add in self-defense that few, if any, of those whose business was stock market forecasting, as ours was not, had any better inkling than we did of what lay ahead. At the beginning of 1959, we found the DJIA at an all-time high of 584. Our lengthy analysis, made from all points of view, may be summarized in the following. In sum, we feel compelled to express the conclusion that the present level of stock prices is a dangerous one. It may well be perilous because prices are already far too high. But even if this is not the case, the market's momentum is such as inevitably to carry it to unjustifiable heights. Frankly, we cannot imagine a market of the future in which there will never be any serious losses, and in which every tyro will be guaranteed a large profit on his stock purchases. The caution we expressed in 1959 was somewhat better justified by the sequel than was our corresponding attitude in 1954. Yet it was far from fully vindicated. The DJIA advanced to 685 in 1961, then fell a little below our 584 level to 566 later in the year, advanced again to 735 in late 1961, and then declined in near panic to 536 in May 1962, showing a loss of 27% within the brief period of 6 months. At the same time, there was a far more serious shrinkage in the most popular growth stocks, as evidenced by the striking fall of the indisputable leader, International Business Machines, from a high of 607 in December 1961 to a low of 300 in June 1962. This period saw a complete debacle in a host of newly launched common stocks of small enterprises, the so-called hot issues, which had been offered to the public at ridiculously high prices, and then had been further pushed up by needless speculation to levels little short of insane. Many of these lost 90% and more of the quotations in just a few months. The collapse in the first half of 1962 was disconcerting, if not disastrous, to many self-acknowledged speculators, and perhaps to many more imprudent people who called themselves investors. But the turnabout that came later that year was equally unsuspected by the financial community. The stock market averages resumed their upward course, producing the following sequence. December 1961, DJIA 735, Standard & Poor's 500 stock composite 72.64. June 1962, DJIA 536, Standard & Poor's 500 stock composite 52.32. November 1964, DJIA 892, Standard & Poor's 500 stock composite 86.28. The recovery and new ascent of common stock prices was indeed remarkable and created a corresponding revision of Wall Street sentiment. At the low level of June 1962, predictions had appeared predominantly bearish, and after the partial recovery to the end of that year, they were mixed, leaning to the skeptical side. But at the outset of 1964, the natural optimism of brokerage firms was again manifest. Nearly all the forecasts were on the bullish side, and they so continued through the 1964 advance. We then approached the task of appraising the November 1964 levels of the stock market, 892 for the DJIA. After discussing it learnedly from numerous angles, we reached 3 main conclusions. The first was that old standards of valuation appear inapplicable. New standards have not yet been tested by time. The second was that the investor must base his policy on the existence of major uncertainties. The possibilities compassed the extremes, on the one hand, of a protracted and further advance in the market's level, say by 50%, or to 1350 for the DJIA, or on the other hand, of a largely unheralded collapse of the same magnitude, bringing the average in the neighborhood of, say, 450. The third was expressed in much more definite terms. We said, speaking bluntly, if the 1964 price level is not too high, how could we say that any price level is too high? And the chapter closed as follows. What course to follow? Investors should not conclude that the 1964 market level is dangerous merely because they read it in this book. They must weigh our reasoning against the contrary reasoning they will hear from most competent and experienced people on Wall Street. In the end, each one must make his own decision and accept responsibility therefor. We suggest, however, that if the investor is in doubt as to which course to pursue, he should choose the path of caution. The principles of investment, as set forth herein, would call for the following policy under 1964 conditions, in order of urgency. 1. No borrowing to buy or hold securities. 2. No increase in the proportion of funds held in common stocks. 3. A reduction in common stock holdings where needed, to bring it down to a maximum of 50% of the total portfolio. The capital gains tax must be paid with as good grace as possible, and the proceeds invested in first-quality bonds or held as a savings deposit. Investors who for some time have been following a bona fide dollar-cost averaging plan can in logic elect either to continue their periodic purchases unchanged or to suspend them until they feel the market level is no longer dangerous. We should advise rather strongly against the initiation of a new dollar averaging plan at the late 1964 levels, since many investors would not have the stamina to pursue such a scheme if the results soon after initiation should appear highly unfavorable. This time we can say that our caution was vindicated. The DJIA advanced about 11% further to 995, but then fell irregularly to a low of 632 in 1970, and finished that year at 839. The same kind of debacle took place in the price of hot issues, for example, with declines running as much as 90%, as had happened in the 1961 through 1962 setback. And, as pointed out in the introduction, the whole financial picture appeared to have changed in the direction of less enthusiasm and greater doubts. A single fact may summarize the story. The DJIA closed 1970 at a level lower than 6 years before, the first time such a thing had happened since 1944. Such were our efforts to evaluate former stock market levels. Is there anything we and our listeners can learn from them? We considered the market level favorable for investment in 1948 and 1953, but too cautiously in the latter year. Dangerous in 1959 at 584 for DJIA, and too high at 892 in 1964. All of these judgments could be defended even today by adroit arguments, but it is doubtful if they've been as useful as our more pedestrian counsels, in favor of a consistent and controlled common stock policy on the one hand, and discouraging endeavors to beat the market or to pick the winners on the other. Nonetheless, we think our listeners may derive some benefit from a renewed consideration of the level of the stock market, this time as of late 1971. Even if what we have to say will prove more interesting than practically useful, or more indicative than conclusive. There is a fine passage near the beginning of Aristotle's Ethics that goes, "It is the mark of an educated mind to expect that amount of exactness which the nature of the particular subject admits. It is equally unreasonable to accept merely probable conclusions from a mathematician, and to demand strict demonstration from an orator. The work of a financial analyst falls somewhere in the middle between that of a mathematician and of an orator." At various times in 1971, the Dow Jones Industrial Average stood at the 892 level of November 1964 that we considered in our previous edition. But in the present statistical study, we've decided to use the price level and the related data for the Standard & Poor's Composite Index, or S&P 500, because it is more comprehensive and representative of the general market than the 30-stock DJIA. We shall concentrate on a comparison of this material near the 4 dates of our former editions, namely the year-ends of 1948, 1953, 1958, and 1963, plus 1968. For the current price level, we shall take the convenient figure of 100, which was registered at various times in 1971 and in early 1972. The salient data are set forth in Table 3.3, found on the enhancement. For our earnings figures, we present both the last year's showing and the average of 3 calendar years. For 1971 dividends, we use the last 12 months figures, and for 1971 bond interest and wholesale prices, those of August 1971. The 3-year price-earnings ratio for the market was lower in October 1971 than at year-end 1963 and 1968. It was about the same as in 1958, but much higher than in the early years of the long bull market. This important indicator, taken by itself, could not be construed to indicate that the market was especially high in January 1972. But when the interest yield on high-grade bonds is brought into the picture, the implications become much less favorable. The listener will note from our table that the ratio of stock returns, earnings over price, to bond returns has grown worse during the entire period, so that the January 1972 figure was less favorable to stocks by this criterion than in any of the previous years examined. When dividend yields are compared with bond yields, we find that the relationship was completely reversed between 1948 and 1972. In the early years, stocks yielded twice as much as bonds. Now, bonds yield twice as much and more than stocks. Our final judgment is that the adverse change in the bond yield-stock yield ratio fully offsets the better price-earnings ratio for late 1971, based on the 3-year earnings figures. Hence, our view of the early 1972 market level would tend to be the same as it was some 7 years ago. For example, that it is an unattractive one from the standpoint of conservative investment. This would apply to most of the 1971 price range of the DJIA, between, say, 800 and 950. In terms of historical market swings, the 1971 picture would still appear to be one of irregular recovery from the bad setbacks suffered in 1969 through 1970. In the past, such recoveries have ushered in a new stage of the recurrent and persistent bull market that began in 1949. This was the expectation of Wall Street generally during 1971, after the terrible experience suffered by the public buyers of low-grade common stock offerings in the 1968 through 1970 cycle. It is too early in 1971 for another twirl of the new issue merry-go-round. Hence, that dependable sign of imminent danger in the market is lacking now, as it was at the 892 level of the DJIA in November 1964, considered in our previous edition. Technically, then, the outlook would appear to favor another substantial rise, far beyond the 900 DJIA level, before the next serious setback or collapse. But we cannot quite leave the matter there, as perhaps we should. To us, the early 1971 market's disregard of the harrowing experiences of less than a year before is a disquieting sign. Can such heedlessness go unpunished? We think the investor must be prepared for difficult times ahead, perhaps in the form of a fairly quick replay of the 1969 through 1970 decline, or perhaps in the form of another bull market fling, to be followed by a more catastrophic collapse. What course to follow? Turn back to what we said in the last edition. This is our view at the same price level, say 900 for the DJIA in early 1972, as it was in late 1964. Commentary on Chapter 3. You've got to be careful if you don't know where you're going, because you might not get there. Yogi Berra. Bull Market Baloney. In this chapter, Graham shows how prophetic he can be. He looks 2 years ahead, foreseeing the catastrophic bear market of 1973 through 1974, in which U.S. stocks lost 37% of their value. He also looks more than 2 decades into the future, eviscerating the logic of market gurus and best-selling books that were not even on the horizon in his lifetime. The heart of Graham's argument is that the intelligent investor must never forecast the future exclusively by extrapolating the past. Unfortunately, that's exactly the mistake that one pundit after another made in the 1990s. A stream of bullish books followed Wharton finance professor Jeremy Siegel's Stocks for the Long Run, 1994, culminating in a wild crescendo with James Glassman and Kevin Hassett's Dow 36,000, David Elias's Dow 40,000, and Charles Cadleck's Dow 100,000, all published in 1999. Forecasters argued that stocks had returned an annual average of 7% after inflation ever since 1802. Therefore, they concluded, that's what investors should expect in the future. Some bulls went further. Since stocks had always beaten bonds over any period of at least 30 years, stocks must be less risky than bonds, or even cash in the bank. And if you can eliminate all the risk of owning stocks simply by hanging on to them long enough, then why quibble over how much you pay for them in the first place? In 1999 and early 2000, bull market baloney was everywhere. On December 7, 1999, Kevin Landis, portfolio manager of the first-hand mutual funds, appeared on CNN's Moneyline telecast. Asked if wireless telecommunication stocks were overvalued, with many trading at infinite multiples of their earnings, Landis had a ready answer. It's not a mania, he shot back. Look at the outright growth, the absolute value of the growth, it's big. On January 18, 2000, Robert Freilich, chief investment strategist at the Kemper Funds, declared in the Wall Street Journal, it's a new world order. We see people discard all the right companies with all the right people with the right vision because their stock price is too high. That's the worst mistake an investor can make. In the April 10, 2000 issue of Business Week, Jeffrey M. Applegate, then the chief investment strategist at Lehman Brothers, asked rhetorically, Is the stock market riskier today than 2 years ago simply because prices are higher? The answer is no. But the answer is yes. It always has been. It always will be. And when Graham asked, can such heedlessness go unpunished, he knew that the eternal answer to that question is no. Like an enraged Greek god, the stock market crushed everyone who had come to believe that the high returns of the late 1990s were some kind of divine right. Just look at how those forecasts by Landis, Freilich, and Applegate held up. From 2000 through 2002, the most stable of Landis's pet wireless stocks, Nokia, lost only 67%, while the worst, Windstar Communications, lost 99.9%. Freilich's favorite stocks, Cisco Systems and Motorola, fell more than 70% by late 2002. Investors lost over $400 billion on Cisco alone, more than the annual economic output of Hong Kong, Israel, Kuwait, and Singapore combined. In April 2000, when Applegate asked his rhetorical question, the Dow Jones Industrials stood at 11,187. The Nasdaq Composite Index was at 4,446. By the end of 2002, the Dow was hobbling around the 8,300 level, while Nasdaq had withered to roughly 1,300, eradicating all its gains over the previous 6 years. Survival of the fattest. There was a fatal flaw in the argument that stocks have always beaten bonds in the long run. Reliable figures before 1871 do not exist. The indexes used to represent the U.S. stock market's earliest returns contain as few as 7 stocks. By 1800, however, there were some 300 companies in America, many in the Jeffersonian equivalents of the Internet, wooden turnpikes and canals. Most went bankrupt, and their investors lost their knickers. But the stock indexes ignore all the companies that went bust in those early years, a problem technically known as survivorship bias. Thus, these indexes wildly overstate the results earned by real-life investors, who lack the 20/20 hindsight necessary to know exactly which 7 stocks to buy. A lonely handful of companies, including Bank of New York and J.P. Morgan Chase, have prospered continuously since the 1790s. But for every such miraculous survivor, there were thousands of financial disasters, like the Dismal Swamp Canal Company, the Pennsylvania Cultivation of Vines Company, and the Snickers Gap Turnpike Company, all omitted from the historical stock indexes. Jeremy Siegel's data show that after inflation from 1802 through 1870, stocks gained 7% per year, bonds 4.8%, and cash 5.1%. But Elroy Dimson and his colleagues at London Business School estimate that the pre-1871 stock returns are overstated by at least 2 percentage points per year. In the real world, then, stocks did no better than cash and bonds, and perhaps a bit worse. Anyone who claims that the long-term record proves that stocks are guaranteed to outperform bonds or cash is an ignoramus. The higher they go, the harder they fall. As the enduring antidote to this kind of bull market baloney, Graham urges the intelligent investor to ask some simple, skeptical questions. Why should the future returns of stocks always be the same as their past returns? When every investor comes to believe that stocks are guaranteed to make money in the long run, won't the market end up being wildly overpriced? And once that happens, how can future returns possibly be high? Graham's answers, as always, are rooted in logic and common sense. The value of any investment is and always must be a function of the price you pay for it. By the late 1990s, inflation was withering away. Corporate profits appeared to be booming, and most of the world was at peace. But that did not mean, nor could it ever mean, that stocks were worth buying at any price. Since the profits that companies can earn are finite, the price that investors should be willing to pay for stocks must also be finite. Think of it this way. Michael Jordan may well have been the greatest basketball player of all time, and he pulled fans into Chicago Stadium like a giant electromagnet. The Chicago Bulls got a bargain by paying Jordan up to $34 million a year to bounce a big leather ball around a wooden floor. But that does not mean the Bulls would have been justified paying him $340 million, or $3.4 billion, or $34 billion per season. The limits of optimism. Focusing on the market's recent returns when they've been rosy, warns Graham, will lead to a quite illogical and dangerous conclusion that equally marvelous results could be expected for common stocks in the future. From 1995 through 1999, as the market rose by at least 20% each year, a surge unprecedented in American history, stock buyers became ever more optimistic. In mid-1998, investors surveyed by the Gallup organization for the Payne-Weber brokerage firm expected their portfolios to earn an average of roughly 13% over the year to come. By early 2000, their average expected return had jumped to more than 18%. Sophisticated professionals were just as bullish, jacking up their own assumptions of future returns. In 2001, for instance, SBC Communications raised the projected return on its pension plan from 8.5% to 9.5%. By 2002, the average assumed rate of return on the pension plans of companies in the Standard & Poor's 500 stock index had swollen to a record-high 9.2%. A quick follow-up shows the awful aftermath of excess enthusiasm. Gallup found in 2001 and 2002 that the average expectation of one-year returns on stocks had slumped to 7%, even though investors could now buy at prices nearly 50% lower than in 2000. Those gung-ho assumptions about the returns on their pension plans will cost the companies in the S&P 500 a bare minimum of $32 billion between 2002 and 2004, according to recent Wall Street estimates. Even though investors all know they're supposed to buy low and sell high, in practice they often end up getting it backwards. Graham's warning in this chapter is simple. By the rule of opposites, the more enthusiastic investors become about the stock market in the long run, the more certain they are to be proved wrong in the short run. On March 24, 2000, the total value of the U.S. stock market peaked at $14.75 trillion. By October 9, 2002, just 30 months later, the total U.S. stock market was worth $7.34 trillion, or 50.2% less, a loss of $7.41 trillion. Meanwhile, many market pundits turned sourly bearish, predicting flat or even negative market returns for years, even decades to come. At this point, Graham would ask one simple question. Considering how calamitously wrong the experts were the last time they agreed on something, why on earth should the intelligent investor believe them now? What's next? Instead, let's tune out the noise and think about future returns, as Graham might. The stock market's performance depends on three factors: real growth, the rise of companies' earnings and dividends; inflationary growth, the general rise of prices throughout the economy; speculative growth, or decline, any increase or decrease in the investing public's appetite for stocks. In the long run, the yearly growth in corporate earnings per share has averaged 1.5% to 2%, not counting inflation. As of early 2003, inflation was running around 2.4% annually. The dividend yield on stocks was 1.9%. So, 1.5% to 2%, plus 2.4%, plus 1.9% equals 5.8% to 6.3%. In the long run, that means you can reasonably expect stocks to average roughly a 6% return, or 4% after inflation. If the investing public gets greedy again and sends stocks back into orbit, then that speculative fever will temporarily drive returns higher. If instead investors are full of fear, as they were in the 1930s and 1970s, the returns on stocks will go temporarily lower. That's where we are in 2003. Robert Shiller, a finance professor at Yale University, says Graham inspired his valuation approach. Shiller compares the current price of the Standard & Poor's 500 stock index against average corporate profits over the past 10 years, after inflation. By scanning the historical record, Shiller has shown that when his ratio goes well above 20, the market usually delivers poor returns afterward. When it drops well below 10, stocks typically produce handsome gains down the road. In early 2003, by Shiller's math, stocks were priced at about 22.8 times the average inflation-adjusted earnings of the past decade, still in the danger zone, but way down from their demented level of 44.2 times earnings in December 1999. How is the market done in the past when it was priced around today's levels? Figure 3.1, which you can view on the enhanced portion of this audiobook, shows the previous periods when stocks were at similar highs, and how they fared over the 10-year stretches that followed. So, from valuation levels similar to those of early 2003, the stock market has sometimes done very well in the ensuing 10 years, sometimes poorly, and muddled along the rest of the time. I think Graham, ever the conservative, would split the difference between the lowest and highest past returns, and project that over the next decade, stocks will earn roughly 6% annually, or 4% after inflation. Interestingly, that projection matches the estimate we got earlier when we added together real growth, inflationary growth, and speculative growth. Compared to the 1990s, 6% is chicken feed. But it's a whisker better than the gains that bonds are likely to produce, and reason enough for most investors to hang on to stocks as part of a diversified portfolio. But there is a second lesson in Graham's approach. The only thing you can be confident of while forecasting future stock returns is that you will probably turn out to be wrong. The only indisputable truth that the past teaches us is that the future will always surprise us. Always. And the corollary to that law of financial history is that the markets will most brutally surprise the very people who are most certain that their views about the future are right. Staying humble about your forecasting powers, as Graham did, will keep you from risking too much on a view of the future that may well turn out to be wrong. So by all means, you should lower your expectations, but take care not to depress your spirit. For the intelligent investor, hope always springs eternal, because it should. In the financial markets, the worse the future looks, the better it usually turns out to be. A cynic once told G.K. Chesterton, the British novelist and essayist, "Blessed is he who expecteth nothing, for he shall not be disappointed." Chesterton's rejoinder, "Blessed is he who expecteth nothing, for he shall enjoy everything." Chapter 4. General Portfolio Policy. The Defensive Investor. The basic characteristics of an investment portfolio are usually determined by the position and characteristics of the owner or owners. At one extreme we have had savings banks, life insurance companies, and so-called legal trust funds. A generation ago their investments were limited by law in many states to high-grade bonds, and in some cases high-grade preferred stocks. At the other extreme we have the well-to-do and experienced businessman, who will include any kind of bond or stock in his security list, provided he considers it an attractive purchase. It has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this, there is developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he's ready to run. Our view is different. The rate of return sought should be dependent, rather, on the amount of intelligent effort the investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor, who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor, who exercises maximum intelligence and skill. In 1965, we added, in many cases there may be less real risk associated with buying a bargain issue, offering the chance of a large profit, than with a conventional bond purchase yielding about 4.5%. This statement had more truth in it than we ourselves suspected, since in subsequent years, even the best long-term bonds lost a substantial part of their market value because of the rise in interest rates. The basic problem of bond-stock allocation. We've already outlined in briefest form the portfolio policy of the defensive investor. He should divide his funds between high-grade bonds and high-grade common stocks. We have suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his funds in common stocks, with a consequent inverse range of between 75% and 25% in bonds. There is an implication here that the standard division should be an equal one, or 50-50, between the two major investment mediums. According to tradition, the sound reason for increasing the percentage in common stocks would be the appearance of the bargain price levels created in a protracted bear market. Conversely, sound procedure would call for reducing the common stock component below 50%, when in the judgment of the investor the market level has become dangerously high. These copybook maxims have always been easy to enunciate, and always difficult to follow, because they go against that very human nature which produces that excesses of bull and bear markets. It is almost a contradiction in terms to suggest as a feasible policy for the average stock owner that he lighten his holdings when the market advances beyond a certain point, and add to them after a corresponding decline. It is because the average man operates, and apparently must operate, in opposite fashion that we have had the great advances and collapses of the past. And, this writer believes, we are likely to have them in the future. If the division between investment and speculative operations were as clear now as once it was, we might be able to envisage investors as a shrewd, experienced group who sell out to the heedless, hapless speculators at high prices and buy back from them at depressed levels. This picture may have had some verisimilitude in bygone days, but it is hard to identify it with financial developments since 1949. There is no indication that such professional operations as those of the mutual funds have been conducted in this fashion. The percentage of the portfolio held in equities by the two major types of funds, balanced and common stock, has changed very little from year to year. Their selling activities have been largely related to endeavors to switch from less to more promising holdings. If, as we have long believed, the stock market has lost contact with its old bounds, and if new ones have not yet been established, then we can give the investor no reliable rules by which to reduce his common stock holdings toward the 25% minimum and rebuild them later to the 75% maximum. We can urge that in general the investor should not have more than one half in equities unless he has strong confidence in the soundness of his stock position, and is sure that he could view a market decline of the 1969 through 70 type with equanimity. It is hard for us to see how such strong confidence can be justified at the levels existing in early 1972. Thus, we would counsel against a greater than 50% apportionment to common stocks at this time. But, for complementary reasons, it is almost equally difficult to advise a reduction of the figure well below 50%, unless the investor is disquieted in his own mind about the current market level, and will be satisfied also to limit his participation in any further rise to, say, 25% of his total funds. We are thus led to put forward for most of our listeners what may appear to be an oversimplified 50-50 formula. Under this plan, the guiding rule is to maintain as nearly as practicable an equal division between bond and stock holdings. When changes in the market level have raised the common stock component to, say, 55%, the balance would be restored by a sale of 1/11th of the stock portfolio and the transfer of the proceeds to bonds. Conversely, a fall in the common stock proportion to 45% would call for the use of 1/11th of the bond fund to buy additional equities. Yale University followed a somewhat similar plan for a number of years after 1937, but it was geared around a 35% normal holding in common stocks. In the early 1950s, however, Yale seems to have given up its once famous formula, and in 1969 held 61% of its portfolio in equities, including some convertibles. At that time, the endowment funds of 71 such institutions, totaling $7.6 billion, held 60.3% in common stocks. The Yale example illustrates the almost lethal effect of the great market advance upon the once popular formula approach to investment. Nonetheless, we're convinced that our 50-50 version of this approach makes good sense for the defensive investor. It is extremely simple. It aims unquestionably in the right direction. It gives the follower the feeling that he is at least making some moves in response to market developments. Most important of all, it will restrain him from being drawn more and more heavily into common stocks as the market rises to more and more dangerous heights. Furthermore, a truly conservative investor will be satisfied with the gains shown on half his portfolio in a rising market, while in a severe decline, he may derive much solace from reflecting how much better off he is than many of his more venturesome friends. While our proposed 50-50 division is undoubtedly the simplest all-purpose program devisable, it may not turn out to be the best in terms of results achieved. Of course, no approach, mechanical or otherwise, can be advanced with any assurance that it will work out better than another. The much larger income return now offered by good bonds than by representative stocks is a potent argument for favoring the bond component. The investor's choice between 50% or a lower figure in stocks may well rest mainly on his own temperament and attitude. If he can act as a cold-blooded weigher of the odds, he would be likely to favor the low 25% stock component at this time, with the idea of waiting until the DJIA dividend yield was, say, 2/3 of the bond yield before he would establish his median 50-50 division between bonds and stocks. Starting from $900 for the DJIA and dividends of $36 on the unit, this would require either a fall in taxable bond yields from 7.5% to about 5.5% without any change in the present return on leading stocks, or a fall in the DJIA to as low as $660 if there's no reduction in bond yields and no increase in dividends. A combination of intermediate changes could produce the same buying point. A program of that kind is not especially complicated. The hard part is to adopt it and to stick to it, not to mention the possibility that it may turn out to have been much too conservative. The bond component. The choice of issues in the bond component of the investor's portfolio will turn about two main questions. Should he buy taxable or tax-free bonds? And should he buy shorter or longer-term maturities? The tax decision should be mainly a matter of arithmetic, turning on the difference in yields as compared with the investor's tax bracket. In January 1972, the choice in 20-year maturities was between obtaining, say, 7.5% on grade AA corporate bonds and 5.3% on prime tax-free issues. The term municipals is generally applied to all species of tax-exempt bonds, including state obligations. There was thus for this maturity a loss in income of some 30% in passing from the corporate to the municipal field. Hence, if the investor was in a maximum tax bracket higher than 30%, he would have a net saving after taxes by choosing the municipal bonds. The opposite if his maximum tax was less than 30%. A single person starts paying a 30% rate when his income after deductions passes $10,000. For a married couple, the rate applies when combined taxable income passes $20,000. It is evident that a large proportion of individual investors would obtain a higher return after taxes from good municipals than from good corporate bonds. The choice of longer versus shorter maturities involves quite a different question. Viz., does the investor want to assure himself against a decline in the price of his bonds, but at the cost of 1. A lower annual yield, and 2. loss of the possibility of an appreciable gain in principal value. We think it best to discuss this question in Chapter 8, the investor and market fluctuations. For a period of many years in the past, the only sensible bond purchases for individuals were the U.S. savings issues. Their safety was, and is, unquestioned. They gave a higher return than other bond investments of first quality. They had a money-back option and other privileges which added greatly to their attractiveness. In our earlier editions, we had an entire chapter entitled U.S. Savings Bonds, a Boon to Investors. As we shall point out, U.S. savings bonds still possess certain unique merits that make them a suitable purchase by any individual investor. For the man of modest capital, with say not more than $10,000 to put into bonds, we think they're still the easiest and the best choice. But those with larger funds may find other mediums more desirable. Let us list a few major types of bonds that deserve investor consideration, and discuss them briefly with respect to general description, safety, yield, market price, risk, income tax status, and other features. 1. U.S. Savings Bonds, Series E and Series H. We shall first summarize their important provisions, and then discuss briefly the numerous advantages of these unique, attractive, and exceedingly convenient investments. The Series H bonds pay interest semi-annually, as do other bonds. The rate is 4.29% for the first year, and then a flat 5.10% for the next 9 years to maturity. Interest on the Series E bonds is not paid out, but accrues to the holder through increase in redemption value. The bonds are sold at 75% of their face value and mature at 100% in 5 years, 10 months after purchase. If held to maturity, the yield works out at 5%, compounded semi-annually. If redeemed earlier, the yield moves up from a minimum of 4.01% in the first year to an average of 5.2% in the next 4 and 5/6 years. Interest on the bonds is subject to federal income tax, but is exempt from state income tax. However, federal income tax on the Series E bonds may be paid at the holder's option either annually, as the interest accrues, through higher redemption value, or not until the bond is actually disposed of. Owners of Series E bonds may cash them in at any time, shortly after purchase, at their current redemption value. Holders of Series H bonds have similar rights to cash them in at par value, cost. Series E bonds are exchangeable for Series H bonds, with certain tax advantages. Bonds lost, destroyed, or stolen may be replaced without cost. There are limitations on annual purchases, but liberal provisions for co-ownership by family members make it possible for most investors to buy as many as they can afford. Comment: there is no other investment that combines 1. Absolute assurance of principal and interest payments, 2. The right to demand full money back at any time, and 3. Guarantee of at least a 5% interest rate for at least 10 years. Holders of the earlier issues of Series E bonds have had the right to extend their bonds at maturity, and thus to continue to accumulate annual values at successively higher rates. The deferral of income tax payments over these long periods has been of great dollar advantage. We calculate it has increased the effective net after-tax rate received by as much as a third in typical cases. Conversely, the right to cash in the bonds at cost price, or better, has given the purchasers in former years of low interest rates complete protection against the shrinkage in principal value that befell many bond investors. Otherwise stated, it gave them the possibility of benefiting from the rise in interest rates by switching their low-interest holdings into very high coupon issues on an even money basis. In our view, the special advantages enjoyed by owners of savings bonds now will more than compensate for their lower current return as compared with other direct government obligations. 2. Other United States bonds. A profusion of these issues exists, covering a wide variety of coupon rates and maturity dates. All of them are completely safe with respect to payment of interest and principal. They are subject to federal income taxes, but free from state income tax. In late 1971, the long-term issues, over 10 years, showed an average yield of 6.09%. Intermediate issues, 3 to 5 years, returned 6.35%, and short issues returned 6.03%. In 1970, it was possible to buy a number of old issues at large discounts. Some of these are accepted at par in settlement of estate taxes. Example, the U.S. Treasury 3.5s due 1990 are in this category. They sold at 60 in 1970, but closed 1970 above 77. It is interesting to note also that in many cases the indirect obligations of the U.S. government yield appreciably more than its direct obligations of the same maturity. As we write, an offering appears of 7.05% of certificates fully guaranteed by the Secretary of Transportation of the Department of Transportation of the United States. The yield was fully 1% more than that on direct obligations of the U.S., maturing the same year, 1986. The certificates were actually issued in the name of the trustees of the Penn Central Transportation Company, but they were sold on the basis of a statement by the U.S. Attorney General that the guarantee brings into being a general obligation of the United States, backed by its full faith and credit. Quite a number of indirect obligations of this sort have been assumed by the U.S. government in the past, and all of them have been scrupulously honored. The listener may wonder why all this hocus-pocus, involving an apparently personal guarantee by our Secretary of Transportation, and a higher cost to the taxpayer in the end. The chief reason for the indirection has been the debt limit imposed on government borrowing by the Congress. Apparently, guarantees by the government are not regarded as debts, a semantic windfall for shrewder investors. Perhaps the chief impact of this situation has been the creation of tax-free housing authority bonds, enjoying the equivalent of a U.S. guarantee and virtually the only tax-exempt issues that are equivalent to government bonds. Another type of government-backed issues is the recently created New Community Debentures, offered to yield 7.6% in September 1971. 3. State and municipal bonds. These enjoy exemption from federal income tax. They are also ordinarily free of income tax in the state of issue, but not elsewhere. They are either direct obligations of a state or subdivision, or revenue bonds dependent for interest payments on receipts from a toll road, bridge, building lease, etc. Not all tax-free bonds are strongly enough protected to justify their purchase by a defensive investor. He may be guided in his selection by the rating given to each issue by Moody's or Standard & Poor's. One of three highest ratings by both services, A, AAA, AAA, AA, AA, or A, should constitute a sufficient indication of adequate safety. The yield on these bonds will vary both with the quality and the maturity, with the shorter maturities giving the lower return. In late 1971, the issues represented in Standard & Poor's Municipal Bond Index averaged AA in quality rating, 20 years in maturity, and 5.78% in yield. A typical offering of Vineland, New Jersey bonds rated AA for A and gave a yield of only 3% on the 1-year maturity, rising to 5.8% to the 1995 and 1996 maturities. 4. Corporation bonds. These bonds are subject to both federal and state tax. In early 1972, those of highest quality yielded 7.19% for a 25-year maturity, as reflected in the published yield of Moody's AAA Corporate Bond Index. The so-called lower medium-grade issues, rated BAA, returned 8.23% for long maturities. In each class, shorter-term issues would yield somewhat less than longer-term obligations. Comment. These summaries indicate that the average investor has several choices among high-grade bonds. Those in high income tax brackets can undoubtedly obtain a better net yield from good tax-free issues than from taxable ones. For others, the early 1972 range of taxable yield would seem to be from 5% on U.S. savings bonds with their special options to about 7.5% on high-grade corporate issues. Higher-yielding bond investments. By sacrificing quality, an investor can obtain a higher income return from his bonds. Long experience has demonstrated that the ordinary investor is wiser to keep away from such high-yield bonds. While taken as a whole, they may work out somewhat better in terms of overall return than the first quality issues. They expose the owner to too many individual risks of untoward developments, ranging from disquieting price declines to actual default. It is true that bargain opportunities occur fairly often in lower-grade bonds, but these require special study and skill to exploit successfully. Perhaps we should add here that the limits imposed by Congress on direct bond issues of the United States have produced at least two sorts of bargain opportunities for investors in the purchase of government-backed obligations. One is provided by the tax-exempt new housing issues, and the other by the recently created taxable New Community Debentures. An offering of new housing issues in July 1971 yielded as high as 5.8%, free from both federal and state taxes, while an issue of taxable New Community Debentures sold in September 1971 yielded 7.6%. Both obligations have the full faith and credit of the United States government behind them, and hence are safe without question. And, on a net basis, they yield considerably more than ordinary United States bonds. Savings deposits in lieu of bonds. An investor may now obtain as high an interest rate from a savings deposit in a commercial or savings bank, or from a bank certificate of deposit, as he can from a first-grade bond of short maturity. The interest rate on bank savings accounts may be lowered in the future, but under present conditions they are a suitable substitute for short-term bond investment by the individual. Convertible issues. These are discussed in Chapter 16. The price variability of bonds in general is treated in Chapter 8, the investor and market fluctuations. Call provisions. In previous editions, we had a fairly long discussion of this aspect of bond financing because it involved a serious but little-noticed injustice to the investor. In the typical case, bonds were callable fairly soon after insurance, and at modest premiums, say 5% above the issue price. This meant that during a period of wide fluctuations in the underlying interest rates, the investor had to bear the full brunt of unfavorable changes and was deprived of all but a meager participation in favorable ones. Example. Our standard example has been the issue of American Gas and Electric 100-year 5% debentures, sold to the public at 101 in 1928. 4 years later, under near-panic conditions, the price of these good bonds fell to 62.5, yielding 8%. By 1946, in a great reversal, bonds of this type could be sold to yield only 3%, and the 5% issue should have been quoted at close to 160. But at that point, the company took advantage of the call provision and redeemed the issue at a mere 106. The call feature in these bond contracts was a thinly disguised instance of heads I win, tails you lose. At long last, the bond-buying institutions refused to accept this unfair arrangement. In recent years, most long-term, high-coupon issues have been protected against redemption for 10 years or more after issuance. This still limits their possible price rise, but not inequitably. In practical terms, we advise the investor in long-term issues to sacrifice a small amount of yield to obtain the assurance of non-callability, say for 20 or 25 years. Similarly, there is an advantage in buying a low-coupon bond at a discount rather than a high-coupon bond selling at about par and callable in a few years. For the discount, for example, of a 3.5% bond at 63.5%, yielding 7.85%, carries full protection against adverse call action. Straight, for example, non-convertible preferred stocks. Certain general observations should be made here on the subject of preferred stocks. Really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred shareholder is dependent for his safety on the ability and desire of the company to pay dividends on its common stock. Once the common dividends are omitted, or even in danger, his own position becomes precarious, for the directors are under no obligation to continue paying him unless they also pay on the common. On the other hand, the typical preferred stock carries no share in the company's profits beyond the fixed dividend rate. Thus, the preferred holder lacks both the legal claim of the bondholder, or creditor, and the profit possibilities of a common shareholder, or partner. These weaknesses in the legal position of preferred stocks tend to come to the fore recurrently in periods of depression. Only a small percentage of all preferred issues are so strongly entrenched as to maintain an unquestioned investment status through all vicissitudes. Experience teaches that the time to buy preferred stocks is when their price is unduly depressed by temporary adversity. At such times, they may well be suited to the aggressive investor, but too unconventional for the defensive investor. In other words, they should be bought on a bargain basis, or not at all. We shall refer later to convertible and similarly privileged issues, which carry some special possibilities of profits. These are not ordinarily selected for a conservative portfolio. Another peculiarity in the general position of preferred stocks deserves mention. They have a much better tax status for corporation buyers than for individual investors. Corporations pay income tax on only 15% of the income they receive in dividends, but on the full amount of their ordinary interest income. Since the 1972 corporate rate is 48%, this means that $100 received as preferred stock dividends is taxed only $7.20, whereas $100 received as bond interest is taxed $48. On the other hand, individual investors pay exactly the same tax on preferred stock investments as on bond interest, except for a recent minor exemption. Thus, in strict logic, all investment-grade preferred stocks should be bought by corporations, just as all tax-exempt bonds should be bought by investors who pay income tax. Security forms. The bond form and the preferred stock form, as hitherto discussed, are well understood and relatively simple matters. A bondholder is entitled to receive fixed interest and payment of principal on a definite date. The owner of a preferred stock is entitled to a fixed dividend and no more, which must be paid before any common dividend. His principal value does not come due on any specified date. The dividend may be cumulative or non-cumulative. He may or may not have a vote. This describes the standard provisions, and no doubt the majority of bond and preferred issues, but there are innumerable departures from these forms. The best-known types are convertible and similar issues and income bonds. In the latter type, interest does not have to be paid unless it is earned by the company. Unpaid interest may accumulate as a charge against future earnings, but the period is often limited to 3 years. Income bonds should be used by corporations much more extensively than they are. Their avoidance apparently arises from a mere accident of economic history, namely that they were first employed in quantity in connection with railroad reorganizations, and hence they have been associated from the start with financial weakness and poor investment status. But the form itself has several practical advantages, especially in comparison with and in substitution for the numerous convertible preferred stock issues of recent years. Chief of these is the deductibility of the interest paid from the company's taxable income, which in effect cuts the cost of that form of capital in half. From the investor's standpoint, it is probably best for him in most cases that he should have 1. An unconditional right to receive interest payments when they are earned by the company, and 2. A right to other forms of protection than bankruptcy proceedings if interest is not earned and paid. The terms of income bonds can be tailored to the advantage of both the borrower and the lender in the manner best suited to both. Conversion privileges can of course be included. The acceptance by everybody of the inherently weak preferred stock form and the rejection of the stronger income bond form is a fascinating illustration of the way in which traditional institutions and habits often tend to persist on Wall Street, despite new conditions calling for a fresh point of view. With every new wave of optimism or pessimism, we are ready to abandon history and time-tested principles, but we cling tenaciously and unquestioningly to our prejudices. Commentary on Chapter 4. When you leave it to chance, then all of a sudden you don't have any more luck. Basketball coach Pat Riley. How aggressive should your portfolio be? That, says Graham, depends less on what kinds of investments you own than on what kind of investor you are. There are 2 ways to be an intelligent investor. By continually researching, selecting, and monitoring a dynamic mix of stocks, bonds, or mutual funds. Or by creating a permanent portfolio that runs on autopilot and requires no further effort, but generates very little excitement. Graham calls the first approach active, or enterprising. It takes lots of time and loads of energy. The passive, or defensive strategy takes little time or effort, but requires an almost ascetic detachment from the alluring hullabaloo of the market. As the investment thinker Charles Ellis has explained, the enterprising approach is physically and intellectually taxing, while the defensive approach is emotionally demanding. If you have time to spare, are highly competitive, think like a sports fan, and relish a complicated intellectual challenge, then the active approach is up your alley. If you always feel rushed, crave simplicity, and don't relish thinking about money, then the passive approach is for you. Some people feel most comfortable combining both methods, creating a portfolio that is mainly active and partly passive, or vice versa. Both approaches are equally intelligent, and you can be successful with either, but only if you know yourself well enough to pick the right one. Stick with it over the course of your investing lifetime, and keep your costs and emotions under control. Graham's distinction between active and passive investors is another of his reminders that financial risk lies not only where most of us look for it, in the economy or in our investments, but also within ourselves. Can you be brave, or will you cave? How then should a defensive investor get started? The first and most basic decision is how much to put in stocks, and how much to put in bonds and cash. Note that Graham deliberately places this discussion after his chapter on inflation, forearming you with the knowledge that inflation is one of your worst enemies. The most striking thing about Graham's discussion of how to allocate your assets between stocks and bonds is that he never mentions the word age. That sets his advice firmly against the winds of conventional wisdom, which holds that how much investing risk you ought to take depends mainly on how old you are. A traditional rule of thumb was to subtract your age from 100 and invest that percentage of your assets in stocks, with the rest in bonds or cash. A 28-year-old would put 72% of her money in stocks. An 81-year-old would put only 19% there. Like everything else, these assumptions got overheated in the late 1990s. By 1999, a popular book argued that if you were younger than 30, you should put 95% of your money in stocks, even if you had only a moderate tolerance for risk. Unless you've allowed the proponents of this advice to subtract 100 from your IQ, you should be able to tell that something is wrong here. Why should your age determine how much risk you can take? An 89-year-old with $3 million, an ample pension, and a gaggle of grandchildren would be foolish to move most of her money into bonds. She already has plenty of income, and her grandchildren, who will eventually inherit her stocks, have decades of investing ahead of them. On the other hand, a 25-year-old who's saving for his wedding and a house down payment would be out of his mind to put all his money in stocks. If the stock market takes an Acapulco high dive, he will have no bond income to cover his downside, or his backside. What's more, no matter how young you are, you might suddenly need to yank your money out of stocks not 40 years from now, but 40 minutes from now. Without a whiff of warning, you could lose your job, get divorced, become disabled, or suffer who knows what other kind of surprise. The unexpected can strike anyone, at any age. Everyone must keep some assets in the riskless haven of cash. Finally, many people stop investing precisely because the stock market goes down. Psychologists have shown that most of us do a very poor job of predicting today how we will feel about an emotionally charged event in the future. When stocks are going up 15% or 20% a year, as they did in the 1980s and 1990s, it's easy to imagine that you and your stocks are married for life. But when you watch every dollar you invested getting bashed down to a dime, it's hard to resist bailing out into the safety of bonds and cash. Instead of buying and holding their stocks, many people end up buying high, selling low, and holding nothing but their own head in their hands. Because so few investors have the guts to cling to stocks in a falling market, Graham insists that everyone should keep a minimum of 25% in bonds. That cushion, he argues, will give you the courage to keep the rest of your money in stocks, even when stocks stink. To get a better feel for how much risk you can take, think about the fundamental circumstances of your life, when they will kick in, when they might change, and how they're likely to affect your need for cash. Are you single or married? What does your spouse or partner do for a living? Do you or will you have children? When will the tuition bills hit home? Will you inherit money, or will you end up financially responsible for aging, ailing parents? What factors might hurt your career? If you work for a bank or a home builder, a jump in interest rates could put you out of a job. If you work for a chemical manufacturer, soaring oil prices could be bad news. If you're self-employed, how long do businesses similar to yours tend to survive? Do you need your investments to supplement your cash income? In general, bonds will, stocks won't. Given your salary and your spending needs, how much money can you afford to lose on your investments? If, after considering these factors, you feel you can take the higher risks inherent in greater ownership of stocks, you belong around Graham's minimum of 25% in bonds or cash. If not, then steer mostly clear of stocks, edging toward Graham's maximum of 75% in bonds or cash. Once you set these target percentages, change them only as your life circumstances change. Do not buy more stocks because the stock market has gone up. Do not sell them because it has gone down. The very heart of Graham's approach is to replace guesswork with discipline. Fortunately, through your 401k, it's easy to put your portfolio on permanent autopilot. Let's say you're comfortable with a fairly high level of risk, say 70% of your assets in stocks and 30% in bonds. If the stock market rises 25%, but bonds stay steady, you will now have just under 75% in stocks and only 25% in bonds. Visit your 401k's website, or call its toll-free number, and sell enough of your stock funds to rebalance back to your 70-30 target. The key is to rebalance on a predictable, patient schedule. Not so often that you'll drive yourself crazy, and not so seldom that your targets will get out of whack. I suggest that you rebalance every 6 months, no more, no less, on easy-to-remember dates like New Year's and the 4th of July. The beauty of this periodic rebalancing is that it forces you to base your investing decisions on a simple, objective standard. Do I now own more of this asset than my plan calls for? Instead of the sheer guesswork of where interest rates are heading or whether you think the Dow is about to drop dead. Some mutual fund companies, including T. Rowe Price, may soon introduce services that will automatically rebalance your 401k portfolio to your preset targets, so you'll never need to make an active decision. Why not 100% stocks? Graham advises you never to have more than 75% of your total assets in stocks. But is putting all your money into the stock market inadvisable for everyone? For a tiny minority of investors, a 100% stock portfolio may make sense. You are one of them if you have set aside enough cash to support your family for at least 1 year, will be investing steadily for at least 20 years to come, survived the bear market that began in 2000, did not sell stocks during the bear market that began in 2000, bought more stocks during the bear market that began in 2000, have listened to Chapter 8 in this audiobook and implemented a formal plan to control your own investing behavior. Unless you can honestly pass all these tests, you have no business putting all your money in stocks. Anyone who panicked in the last bear market is going to panic in the next one, and will regret having no cushion of cash and bonds. The ins and outs of income investing. In Graham's day, bond investors faced 2 basic choices, taxable or tax-free, short-term or long-term. Today there's a third. Bonds or bond funds. Taxable or tax-free. Unless you're in the lowest tax bracket, you should buy only tax-free municipal bonds outside your retirement accounts. Otherwise, too much of your bond income will end up in the hands of the IRS. The only place to own taxable bonds is inside your 401k, or another sheltered account, where you will owe no current tax on their income, and where municipal bonds have no place, since their tax advantage goes to waste. Short-term or long-term. Bonds and interest rates teeter on opposite ends of a seesaw. If interest rates rise, bond prices fall, although a short-term bond falls far less than a long-term bond. On the other hand, if interest rates fall, bond prices rise, and a long-term bond will outperform shorter ones. You can split the difference simply by buying intermediate-term bonds, maturing in 5 to 10 years, which do not soar when their side of the seesaw rises, but do not slam into the ground either. For most investors, intermediate bonds are the simplest choice, since they enable you to get out of the game of guessing what interest rates will do. Bonds or bond funds. Since bonds are generally sold in $10,000 lots, and you need a bare minimum of 10 bonds to diversify away the risk that one of them might go bust, buying individual bonds makes no sense unless you have at least $100,000 to invest. The only exception is bonds issued by the U.S. Treasury, since they're protected against default by the full force of the American government. Bond funds offer cheap and easy diversification, along with the convenience of monthly income, which you can reinvest right back into the fund at current rates without paying a commission. For most investors, bond funds beat individual bonds hands down. The main exceptions are Treasury securities and some municipal bonds. Major firms like Vanguard, Fidelity, Schwab, and T. Rowe Price offer a broad menu of bond funds at low cost. The choices for bond investors have proliferated like rabbits, so let's update Graham's list of what's available. As of 2003, interest rates have fallen so low that investors are starved for yield, but there are ways of amplifying your interest income without taking on excessive risk. Figure 4.1 summarizes the pros and cons. You can see for yourself on the enhanced portion of this audiobook. Now let's take a look at a few types of bond investments that can fill special needs. Cash is not trash. How can you wring more income out of your cash? The intelligent investor should consider moving out of bank certificates of deposit or money market accounts, which have offered meager returns lately, into some of these cash alternatives. Treasury securities, as obligations of the U.S. government, carry virtually no credit risk, since instead of defaulting on his debts, Uncle Sam can just jack up taxes or print more money at will. Treasury bills mature in 4, 13, or 26 weeks. Because of their very short maturities, T-bills barely get dented when rising interest rates knock down the prices of other income investments. Longer-term Treasury debt, however, suffers severely when interest rates rise. The interest income on Treasury securities is generally free from state, but not federal income tax. And with $3.7 trillion in public hands, the market for Treasury debt is immense, so you can readily find a buyer if you need your money back before maturity. You can buy Treasury bills, short-term notes, and long-term bonds directly from the government with no brokerage fees at www.publicdebt.treas.gov. For more on inflation-protected tips, listen to the commentary on Chapter 2. Savings bonds, unlike Treasuries, are not marketable. You cannot sell them to another investor, and you'll forfeit 3 months of interest if you redeem them in less than 5 years. Thus, they are suitable mainly as set-aside money to meet a future spending need, a gift for a religious ceremony that's years away, or a jump-start on putting your newborn through Harvard. They come in denominations as low as $25, making them ideal as gifts to grandchildren. For investors who can confidently leave some cash untouched for years to come, inflation-protected I-bonds recently offered an attractive yield of around 4%. To learn more, see www.savingsbonds.gov. Moving beyond Uncle Sam. Mortgage securities. Pooled together from thousands of mortgages around the United States, these bonds are issued by agencies like the Federal National Mortgage Association, Fannie Mae, or the Government National Mortgage Association, Ginnie Mae. However, they are not backed by the U.S. Treasury, so they sell at higher yields to reflect their greater risk. Mortgage bonds generally underperform when interest rates fall, and bomb when rates rise. Over the long run, those swings tend to even out, and the higher average yields pay off. Good mortgage bond funds are available from Vanguard, Fidelity, and PIMCO. But if a broker ever tries to sell you an individual mortgage bond, or CMO, tell them you're late for an appointment with your proctologist. Annuities. These insurance-like investments enable you to defer current taxes and capture a stream of income after you retire. Fixed annuities offer a set rate of return. Variable ones provide a fluctuating return. But what the defensive investor really needs to defend against here are the hard-selling insurance agents, stockbrokers, and financial planners who peddle annuities at rapaciously high costs. In most cases, the high expenses of owning an annuity, including surrender charges that gnaw away at your early withdrawals, will overwhelm its advantages. The few good annuities are bought, not sold. If an annuity produces fat commissions for the seller, chances are it will produce meager results for the buyer. Consider only those you can buy directly from providers with rock-bottom costs, like Emeritus, TIAA CREF, and Vanguard. Preferred stock. Preferred shares are a worst of both worlds investment. They are less secure than bonds, since they have only a secondary claim on a company's assets if it goes bankrupt, and they offer less profit potential than common stocks do, since companies typically call or forcibly buy back their preferred shares when interest rates drop or their credit rating improves. Unlike the interest payments on most of its bonds, an issuing company cannot deduct preferred dividend payments from its corporate tax bill. Ask yourself, if this company is healthy enough to deserve my investment, why is it paying a fat dividend on its preferred stock, instead of issuing bonds and getting a tax break? The likely answer is that the company is not healthy. The market for its bonds is glutted, and you should approach its preferred shares as you would approach an unrefrigerated dead fish. Common stock. A visit to the stock screener at http://screen.yahoo.com/stocks.html in early 2003 showed that 115 of the stocks in the Standard & Poor's 500 index had dividend yields of 3% or greater. No intelligent investor, no matter how starved for yield, would ever buy a stock for its dividend income alone. The company and its businesses must be solid, and its stock price must be reasonable. But thanks to the bear market that began in 2000, some leading stocks are now out-yielding treasury bonds. So even the most defensive investor should realize that selectively adding stocks to an all-bond or mostly bond portfolio can increase its income yield and raise its potential return. Chapter 5. The Defensive Investor and Common Stocks. Investment Merits of Common Stocks. In our first edition, 1949, we found it necessary at this point to insert a long exposition of the case for including a substantial common stock component in all investment portfolios. Common stocks were generally viewed as highly speculative and therefore unsafe. They had declined fairly substantially from the high levels of 1946. But instead of attracting investors to them because of their reasonable prices, this fall had had the opposite effect of undermining confidence in equity securities. We have commented on the converse situation that has developed in the ensuing 20 years, whereby the big advance in stock prices made them appear safe and profitable investments at record high levels, which might actually carry with them a considerable degree of risk. The argument we made for common stocks in 1949 turned on two main points. The first was that they had offered a considerable degree of protection against the erosion of the investor's dollar caused by inflation, whereas bonds offered no protection at all. The second advantage of common stocks lay in their higher average return to investors over the years. This was produced both by an average dividend income exceeding the yield on good bonds, and by an underlying tendency for market value to increase over the years in consequence of the reinvestment of undistributed profits. While these two advantages have been of major importance and have given common stocks a far better record than bonds over the long-term past, we have consistently warned that these benefits could be lost by the stock buyer if he pays too high a price for his shares. This was clearly the case in 1929, and it took 25 years for the market level to climb back to the ledge from which it had abysmally fallen in 1929 through 1932. Since 1957, common stocks have once again, through their high prices, lost their traditional advantage in dividend yield over bond interest rates. It remains to be seen whether the inflation factor and the economic growth factor will make up in the future for this significantly adverse development. It should be evident to the listener that we have no enthusiasm for common stocks in general at the 900 DJIA level of late 1971. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable portion of common stocks in his portfolio, even if he must regard them as the lesser of two evils, the greater being the risks attached to an all-bond holding. Rules for the common stock component. The selection of common stocks for the portfolio of the defensive investor should be a relatively simple matter. Here we would suggest 4 rules to be followed. 1. There should be adequate, though not excessive, diversification. This might mean a minimum of 10 different issues and a maximum of about 30. 2. Each company selected should be large, prominent, and conservatively financed. Indefinite as these adjectives must be, their general sense is clear. Observations on this point are added at the end of the chapter. 3. Each company should have a long record of continuous dividend payments. All the issues in the Dow Jones Industrial Average met this dividend requirement in 1971. To be specific on this point, we would suggest the requirement of continuous dividend payments beginning at least in 1950. 4. The investor should impose some limit on the price he will pay for an issue in relation to its average earnings over, say, the past 7 years. We suggest that this limit be set at 25 times such average earnings, and not more than 20 times those of the last 12-month period. But such a restriction would eliminate nearly all of the strongest and most popular companies from the portfolio. In particular, it would ban virtually the entire category of growth stocks, which have for some years past been the favorites of both speculators and institutional investors. We must give our reasons for proposing so drastic an exclusion. Growth stocks and the defensive investor. The term growth stock is applied to one which has increased its per-share earnings in the past at well above the rate for common stocks generally, and is expected to continue to do so in the future. Some authorities would say that a true growth stock should be expected at least to double its per-share earnings in 10 years, for example, to increase them at a compounded annual rate of over 7.1%. Obviously, stocks of this kind are attractive to buy and to own, provided the price paid is not excessive. The problem lies there, of course, since growth stocks have long sold at high prices in relation to current earnings, and at much higher multiples of their average profits over a past period. This has introduced a speculative element of considerable weight in the growth stock picture, and has made successful operations in this field a far from simple matter. The leading growth issue has long been international business machines, and it has brought phenomenal rewards to those who bought it years ago and held on to it tenaciously. But we've already pointed out that this best of common stocks actually lost 50% of its market price in a 6-month decline during 1961 through 62, and nearly the same percentage in 1969 through 70. Other growth stocks have been even more vulnerable to adverse developments. In some cases, not only has the price fallen back, but the earnings as well, thus causing a double discomfiture to those who own them. A good second example for our purpose is Texas Instruments, which in 6 years rose from 5 to 256 without paying a dividend, while its earnings increased from 40 cents to $3.91 per share. Note that the price advanced 5 times as fast as the profits. This is characteristic of popular common stocks. But 2 years later, the earnings had dropped off by nearly 50%, and the price by 4/5 to 49. The listener will understand from these instances why we regard growth stocks as a whole as too uncertain and risky a vehicle for the defensive investor. Of course, wonders can be accomplished with the right individual selections, bought at the right levels, and later sold after a huge rise and before the probable decline. But the average investor can no more expect to accomplish this than to find money growing on trees. In contrast, we think that the group of large companies that are relatively unpopular, and therefore obtainable at reasonable earnings multipliers, offers a sound, if unspectacular, area of choice by the general public. We shall illustrate this idea in our chapter on portfolio selection. Portfolio changes. It is now standard practice to submit all security lists for periodic inspection in order to see whether their quality can be improved. This, of course, is a major part of the service provided for clients by investment counselors. Nearly all brokerage houses are ready to make corresponding suggestions, without special fee, in return for the commission business involved. Some brokerage houses maintain investment services on a fee basis. Presumably, our defensive investor should obtain, at least once a year, the same kind of advice regarding changes in his portfolio as he sought when his funds were first committed. Since he will have little expertness of his own on which to rely, it is essential that he entrust himself only to firms of the highest reputation. Otherwise, he may easily fall into incompetent or unscrupulous hands. It is important in any case that at every such consultation he make clear to his advisor that he wishes to adhere closely to the 4 rules of common stock selection given earlier in this chapter. Incidentally, if his list has been competently selected in the first instance, there should be no need for frequent or numerous changes. Dollar cost averaging. The New York Stock Exchange has put considerable effort into popularizing its monthly purchase plan, under which an investor devotes the same dollar amount each month to buying one or more common stocks. This is an application of a special type of formula investment, known as dollar cost averaging. During the predominantly rising market experience since 1949, the results from such a procedure were certain to be highly satisfactory, especially since they prevented the practitioner from concentrating his buying at the wrong times. In Lucille Tomlinson's comprehensive study of formula investment plans, the author presented a calculation of the results of dollar cost averaging in the group of stocks making up the Dow Jones Industrial Index. Tests were made covering 23 10-year purchase periods, the first ending in 1929, the last in 1952. Every test showed a profit either at the close of the purchase period or within 5 years thereafter. The average indicated profit at the end of the 23 buying periods was 21.5%. Exclusive of dividends received. Needless to say, in some instances, there was a substantial temporary depreciation at market value. Miss Tomlinson ends her discussion of this ultra-simple investment formula with the striking sentence, "No one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success, regardless of what may happen to security prices, as dollar cost averaging." It may be objected that dollar cost averaging, while sound in principle, is rather unrealistic in practice, because few people are so situated that they can have available for common stock investment the same amount of money each year for, say, 20 years. It seems to me that this apparent objection has lost much of its force in recent years. Common stocks are becoming generally accepted as a necessary component of a sound savings investment program. Thus, systematic and uniform purchases of common stocks may present no more psychological and financial difficulties than similar continuous payments for United States savings bonds and for life insurance, to which they should be complementary. The monthly amount may be small, but the results after 20 or more years can be impressive and important to the saver. The investor's personal situation. At the beginning of this chapter, we referred briefly to the position of the individual portfolio owner. Let us return to this matter, in the light of our subsequent discussion of general policy. To what extent should the type of securities selected by the investor vary with his circumstances? As concrete examples representing widely different conditions, we shall take 1. A widow left $200,000 with which to support herself and her children. 2. A successful doctor in mid-career with savings of $100,000 and yearly accretions of $10,000. And 3. A young man earning $200 per week and saving $1,000 a year. For the widow, the problem of living on her income is a very difficult one. On the other hand, the need for conservatism in her investments is paramount. A division of her fund about equally between United States bonds and first-grade common stocks is a compromise between these objectives and corresponds to our general prescription for the defensive investor. The stock component may be placed as high as 75% if the investor is psychologically prepared for this decision, and if she can be almost certain she's not buying at too high a level. Assuredly, this is not the case in early 1972. We do not preclude the possibility that the widow may qualify as an enterprising investor, in which case her objectives and methods will be quite different. The one thing the widow must not do is to take speculative chances in order to make some extra income. By this we mean trying for profits or high income without the necessary equipment to warrant full confidence in overall success. It would be far better for her to draw $2,000 per year out of her principal in order to make both ends meet than to risk half of it in poorly grounded and therefore speculative ventures. The prosperous doctor has none of the widow's pressures and compulsions, yet we believe that his choices are pretty much the same. Is he willing to take a serious interest in the business of investment? If he lacks the impulse or the flair, he will do best to accept the easy role of the defensive investor. The division of his portfolio should then be no different from that of the typical widow, and there would be the same area of personal choice in fixing the size of the stock component. The annual savings should be invested in about the same proportions as the total fund. The average doctor may be more likely than the average widow to elect to become an enterprising investor, and he is perhaps more likely to succeed in the undertaking. He has one important handicap, however, the fact that he has less time available to give to his investment education and to the administration of his funds. In fact, medical men have been notoriously unsuccessful in their security dealings. The reason for this is that they usually have an ample confidence in their own intelligence and a strong desire to make a good return on their money, without the realization that to do so successfully requires both considerable attention to the matter and something of a professional approach to security values. Finally, the young man who saves $1,000 a year and expects to do better gradually finds himself with the same choices, though for still different reasons. Some of his savings should go automatically into Series E bonds. The balance is so modest that it seems hardly worthwhile for him to undergo a tough educational and temperamental discipline in order to qualify as an aggressive investor. Thus, a simple resort to our standard program for the defensive investor would be at once the easiest and the most logical policy. Let us not ignore human nature at this point. Finance has a fascination for many bright young people with limited means. They would like to be both intelligent and enterprising in the placement of their savings, even though investment income is much less important to them than their salaries. This attitude is all to the good. There is a great advantage for the young capitalist to begin his financial education and experience early. If he is going to operate as an aggressive investor, he is certain to make some mistakes and to take some losses. Youth can stand these disappointments and profit by them. We urge the beginner in security buying not to waste his efforts and his money in trying to beat the market. Let him study security values and initially test out his judgment on price versus value with the smallest possible sums. Thus, we return to the statement made at the outset that the kind of securities to be purchased and the rate of return to be sought depend not on the investor's financial resources, but on his financial equipment in terms of knowledge, experience, and temperament. Note on the concept of risk. It is conventional to speak of good bonds as less risky than good preferred stocks, and of the latter as less risky than good common stocks. From this was derived the popular prejudice against common stocks because they are not safe, which was demonstrated in the Federal Reserve Board survey of 1948. We should like to point out that the words risk and safety are applied to securities in two different senses, with a resultant confusion in thought. A bond is clearly proved unsafe when it defaults its interest or principal payments. Similarly, if a preferred stock or even a common stock is bought with the expectation that a given rate of dividend will be continued, then a reduction or passing of the dividend means that it is proved unsafe. It is also true that an investment contains a risk if there is a fair possibility that the holder may have to sell at a time when the price is well below cost. Nevertheless, the idea of risk is often extended to apply to a possible decline in the price of a security, even though the decline may be of a cyclical and temporary nature, and even though the holder is unlikely to be forced to sell at such times. These chances are present in all securities, other than United States savings bonds, and to a greater extent in the general run of common stocks than in senior issues as a class. But we believe that what is here involved is not a true risk in the useful sense of the term. The man who holds a mortgage on a building might have to take a substantial loss if he were forced to sell it at an unfavorable time. That element is not taken into account in judging the safety or risk of ordinary real estate mortgages, the only criterion being the certainty of punctual payments. In the same way, the risk attached to an ordinary commercial business is measured by the chance of its losing money, not by what would happen if the owner were forced to sell. In Chapter 8, we shall set forth our conviction that the bona fide investor does not lose money merely because the market price of his holdings declines. Hence, the fact that a decline may occur does not mean that he is running a true risk of loss. If a group of well-selected common stock investments shows a satisfactory overall return, as measured through a fair number of years, then this group investment has proved to be safe. During that period, its market value is bound to fluctuate, and as likely as not, it will sell for a while under the buyer's cost. If that fact makes the investment risky, it would then have to be called both risky and safe at the same time. This confusion may be avoided if we apply the concept of risk solely to a loss of value which either is realized through actual sale or is caused by a significant deterioration in the company's position, or, more frequently perhaps, is the result of the payment of an excessive price in relation to the intrinsic worth of the security. Many common stocks do involve risks of such deterioration, but it is our thesis that a properly executed group investment in common stocks does not carry any substantial risk of this sort, and that therefore it should not be termed risky merely because of the element of price fluctuation. But such risk is present if there is danger that the price may prove to have been clearly too high by intrinsic value standards, even if any subsequent severe market decline may be recouped many years later. Note on the category of large, prominent, and conservatively financed corporations. The quoted phrase in our caption was used earlier in the chapter to describe the kind of common stocks to which defensive investors should limit their purchases, provided also that they had paid continuous dividends for a considerable number of years. A criterion based on adjectives is always ambiguous. Where is the dividing line for size, for prominence, and for conservatism of financial structure? On the last point, we can suggest a specific standard that, though arbitrary, is in line with accepted thinking. An industrial company's finances are not conservative unless the common stock, at book value, represents at least half of the total capitalization, including all bank debt. For a railroad or public utility, the figure should be at least 30%. The words large and prominent carry the notion of substantial size, combined with a leading position in the industry. Such companies are often referred to as primary. All other common stocks are then called secondary, except that growth stocks are ordinarily placed in a separate class by those who buy them as such. To supply an element of concreteness here, let us suggest that to be large in present-day terms, a company should have $50 million of assets, or do $50 million of business. Again, to be prominent, a company should rank among the first quarter or first third in size within its industry group. It would be foolish, however, to insist upon such arbitrary criteria. They are offered merely as guides to those who may ask for guidance. But any rule which the investor may set for himself, and which does no violence to the common-sense meanings of large and prominent, should be acceptable. By the very nature of the case, there must be a large group of companies that some will and others will not include among those suitable for defensive investment. There is no harm in such diversity of opinion and action. In fact, it has a salutary effect upon stock market conditions, because it permits a gradual differentiation or transition between the categories of primary and secondary stock issues. Commentary on Chapter 5. Human felicity is produced not so much by great pieces of good fortune that seldom happen, as by little advantages that occur every day. Benjamin Franklin. The best defense is a good offense. After the stock market bloodbath of the past few years, why would any defensive investor put a dime into stocks? First, remember Graham's insistence that how defensive you should be depends less on your tolerance for risk than on your willingness to put time and energy into your portfolio. And if you go about it the right way, investing in stocks is just as easy as parking your money in bonds and cash. As we'll see in Chapter 9, you can buy a stock market index fund with no more effort than it takes to get dressed in the morning. Amidst the bear market that began in 2000, it's understandable if you feel burned, and if in turn that feeling makes you determine never to buy another stock again. As an old Turkish proverb says, after you burn your mouth on hot milk, you blow on your yogurt. Because the crash of 2000 through 2002 was so terrible, many investors now view stocks as scaldingly risky. But paradoxically, the very act of crashing has taken much of the risk out of the stock market. It was hot milk before, but it is room temperature yogurt now. Viewed logically, the decision of whether to own stocks today has nothing to do with how much money you might have lost by owning them a few years ago. When stocks are priced reasonably enough to give you future growth, then you should own them, regardless of the losses they may have cost you in the recent past. That's all the more true when bond yields are low, reducing the future returns on income-producing investments. As we have heard in Chapter 3, stocks are, as of early 2003, only mildly overpriced by historical standards. Meanwhile, at recent prices, bonds offer such low yields that an investor who buys them for their supposed safety is like a smoker who thinks he can protect himself against lung cancer by smoking low-tar cigarettes. No matter how defensive an investor you are, in Graham's sense of low maintenance or in the contemporary sense of low risk, today's values mean that you must keep at least some of your money in stocks. Fortunately, it's never been easier for a defensive investor to buy stocks. And a permanent autopilot portfolio, which effortlessly puts a little bit of your money to work every month in predetermined investments, can defend you against the need to dedicate a large part of your life to stock picking. Should you buy what you know? But first, let's look at something the defensive investor must always defend against: the belief that you can pick stocks without doing any homework. In the 1980s and early 1990s, one of the most popular investing slogans was, "Buy what you know." Peter Lynch, who from 1977 through 1990 piloted Fidelity Magellan to the best track record ever compiled by a mutual fund, was the most charismatic preacher of this gospel. Lynch argued that amateur investors have an advantage that professional investors have forgotten how to use: the power of common knowledge. If you discover a great new restaurant, car, toothpaste, or jeans, or if you notice that the parking lot at a nearby business is always full, or that people are still working at a company's headquarters long after Jay Leno goes off the air, then you have a personal insight into a stock that a professional analyst or portfolio manager might never pick up on. As Lynch put it, during a lifetime of buying cars or cameras, you develop a sense of what's good and what's bad, what sells and what doesn't. And the most important part is, you know it before Wall Street knows it. Lynch's rule, you can outperform the experts if you use your edge by investing in companies or industries you already understand, isn't totally implausible, and thousands of investors have profited from it over the years. But Lynch's rule can work only if you follow its corollary as well. Finding the promising company is only the first step. The next step is doing the research. To his credit, Lynch insists that no one should ever invest in a company, no matter how great its products or how crowded its parking lot, without studying its financial statements and estimating its business value. Unfortunately, most stock buyers have ignored that part. Barbra Streisand, the day-trading diva, personified the way people abuse Lynch's teachings. In 1999, she burbled, "We go to Starbucks every day, so I buy Starbucks stock." But the funny girl forgot that no matter how much you love those tall, skinny lattes, you still have to analyze Starbucks' financial statements and make sure the stock isn't even more overpriced than the coffee. Countless stock buyers made the same mistake by loading up on shares of Amazon.com because they loved the website, or buying E-Trade stock because it was their own online broker. Experts gave the idea credence, too. In an interview televised on CNN in late 1999, portfolio manager Kevin Landis of the First Hand Funds was asked plaintively, "How do you do it? Why can't I do it, Kevin?" From 1995 through the end of 1999, the First Hand Technology Value Fund produced an outstanding 58.2% average annualized gain. "Well, you can do it," Landis chirped. "All you really need to do is focus on the things that you know, and stay close to an industry, and talk to people who work in it every day." The most painful perversion of Lynch's rule occurred in corporate retirement plans. If you're supposed to buy what you know, then what could possibly be a better investment for your 401k than your own company stock? After all, you work there. Don't you know more about the company than an outsider ever could? Sadly, the employees of Enron, Global Crossing, and WorldCom, many of whom put nearly all their retirement assets in their own company's stock, only to be wiped out, learned that insiders often possess only the illusion of knowledge, not the real thing. Psychologists led by Baruch Fishkoff of Carnegie Mellon University have documented a disturbing fact. Becoming more familiar with a subject does not significantly reduce people's tendency to exaggerate how much they actually know about it. That's why investing in what you know can be so dangerous. The more you know going in, the less likely you are to probe a stock for weaknesses. This pernicious form of overconfidence is called home bias, or the habit of sticking to what is already familiar. Individual investors own 3 times more shares in their local phone company than in all other phone companies combined. The typical mutual fund owns stocks whose headquarters are 115 miles closer to the fund's main office than the average U.S. company is. 401k investors keep between 25% and 30% of their retirement assets in the stock of their own company. In short, familiarity breeds complacency. On the TV news, isn't it always the neighbor or the best friend or the parent of the criminal who says in a shocked voice, "He was such a nice guy"? Well, that's because whenever we're too close to someone or something, we take our beliefs for granted, instead of questioning them as we do when we confront something more remote. The more familiar a stock is, the more likely it is to turn a defensive investor into a lazy one, who thinks there's no need to do any homework. Don't let that happen to you. Can you roll your own? Fortunately for a defensive investor who's willing to do the required homework for assembling a stock portfolio, this is the golden age. Never before in financial history has owning stocks been so cheap and convenient. Do it yourself. Through specialized online brokerages like www.sharebuilder.com, www.foliofn.com, and www.buyandhold.com, you can buy stocks automatically, even if you have very little cash to spare. These websites charge as little as $4 for each periodic purchase of any of the thousands of U.S. stocks they make available. You can invest every week or every month, reinvest the dividends, and even trickle your money into stocks through electronic withdrawals from your bank account or direct deposit from your paycheck. ShareBuilder charges more to sell than to buy, reminding you, like a little whack across the nose with a rolled-up newspaper, that rapid selling is an investing no-no, while Folio FN offers an excellent tax tracking tool. Unlike traditional brokers or mutual funds that won't let you in the door for less than $2,000 or $3,000, these online firms have no minimum account balances and are tailor-made for beginning investors who want to put fledgling portfolios on autopilot. To be sure, a transaction fee of $4 takes a monstrous 8% bite out of a $50 monthly investment, but if that's all the money you can spare, then these micro-investing sites are the only game in town for building a diversified portfolio. You can also buy individual stocks straight from the issuing companies. In 1994, the U.S. Securities and Exchange Commission loosened the handcuffs it had long ago clamped onto the direct sale of stocks to the public. Hundreds of companies responded by creating internet-based programs, allowing investors to buy shares without going through a broker. Some helpful online sources of information on buying stocks directly include www.dripcentral.com, www.netstockdirect.com, an affiliate of ShareBuilder, and www.stockpower.com. You may often incur a variety of nuisance fees that can exceed $25 per year. Even so, direct stock purchase programs are usually cheaper than stockbrokers. Be warned, however, that buying stocks in tiny increments for years on end can set off big tax headaches. If you're not prepared to keep a permanent and exhaustively detailed record of your purchases, do not buy in the first place. Finally, don't invest in only one stock, or even just a handful of different stocks. Unless you're not willing to spread your bets, you shouldn't bet at all. Graham's guideline of owning between 10 and 30 stocks remains a good starting point for investors who want to pick their own stocks. But you must make sure that you are not overexposed to one industry. For more on how to pick the individual stocks that will make up your portfolio, listen to chapters 11, 14, and 15. If, after you set up such an online autopilot portfolio, you find yourself trading more than twice a year, or spending more than an hour or two per month total on your investments, then something has gone badly wrong. Do not let the ease and up-to-the-minute feel of the internet seduce you into becoming a speculator. A defensive investor runs and wins the race by sitting still. Get some help. A defensive investor can also own stocks through a discount broker, a financial planner, or a full-service stockbroker. At a discount brokerage, you'll need to do most of the stock-picking work yourself. Graham's guidelines will help you create a core portfolio requiring minimal maintenance and offering maximal odds of a steady return. On the other hand, if you cannot spare the time or summon the interest to do it yourself, there's no reason to feel any shame in hiring someone to pick stocks or mutual funds for you. But there's one responsibility that you must never delegate. You, and no one but you, must investigate before you hand over your money whether an advisor is trustworthy and charges reasonable fees. For more pointers, listen to Chapter 10. Farm it out. Mutual funds are the ultimate way for a defensive investor to capture the upside of stock ownership without the downside of having to police your own portfolio. At relatively low cost, you can buy a high degree of diversification and convenience, letting a professional pick and watch the stocks for you. In their finest form, index portfolios, mutual funds can require virtually no monitoring or maintenance whatsoever. Index funds are a kind of Rip Van Winkle investment that is highly unlikely to cause any suffering or surprises, even if, like Washington Irving's lazy farmer, you fall asleep for 20 years. They are a defensive investor's dream come true. For more detail, listen to Chapter 9. Filling in the potholes. As the financial markets heave and crash their way up and down day after day, the defensive investor can take control of the chaos. Your very refusal to be active, your renunciation of any pretended ability to predict the future, can become your most powerful weapons. By putting every investment decision on autopilot, you drop any self-delusion that you know where stocks are headed, and you take away the market's power to upset you no matter how bizarrely it bounces. As Graham notes, dollar cost averaging enables you to put a fixed amount of money into an investment at regular intervals. Every week, month, or calendar quarter, you buy more, whether the markets have gone or are about to go up, down, or sideways. Any major mutual fund company or brokerage firm can automatically and safely transfer the money electronically for you, so you never have to write a check or feel the conscious pang of payment. It's all out of sight, out of mind. The ideal way to dollar cost average is into a portfolio of index funds, which own every stock or bond worth having. That way you renounce not only the guessing game of where the market is going, but which sectors of the market and which particular stocks or bonds within them will do the best. Let's say you can spare $500 a month by owning and dollar cost averaging into just 3 index funds, $300 into one that holds the total U.S. stock market, $100 into one that holds foreign stocks, and $100 into one that holds U.S. bonds. You can ensure that you own almost every investment on the planet that's worth owning. Every month, like clockwork, you buy more. If the market has dropped, your preset amount goes further, buying you more shares than the month before. If the market has gone up, then your money buys you fewer shares. By putting your portfolio on permanent autopilot this way, you prevent yourself from either flinging money at the market just when it seems most alluring, and is actually most dangerous, or refusing to buy more after a market crash has made investments truly cheaper, but seemingly more risky. According to Ibbotson Associates, the leading financial research firm, if you had invested $12,000 in the Standard & Poor's 500 stock index at the beginning of September 1929, 10 years later, you would have had only $7,223 left. But if you had started with a paltry $100 and simply invested another $100 every single month, then by August 1939, your money would have grown to $15,571. That's the power of disciplined buying, even in the face of the Great Depression and the worst bear market of all time. Figure 5.1 shows the magic of dollar cost averaging in a more recent bear market. Take a look at it on the enhancement. Best of all, once you build a permanent autopilot portfolio with index funds as its heart and core, you'll be able to answer every market question with the most powerful response a defensive investor could ever have. I don't know, and I don't care. If someone asks whether bonds will outperform stocks, just answer, I don't know, and I don't care. After all, you're automatically buying both. Will healthcare stocks make high-tech stocks look sick? I don't know, and I don't care. You're a permanent owner of both. What's the next Microsoft? I don't know, and I don't care. As soon as it's big enough to own, your index fund will have it, and you'll go along for the ride. Will foreign stocks beat U.S. stocks next year? I don't know, and I don't care. If they do, you'll capture that gain. If they don't, you'll get to buy more at lower prices. By enabling you to say, I don't know and I don't care, a permanent autopilot portfolio liberates you from the feeling that you need to forecast what the financial markets are about to do, and the illusion that anyone else can. The knowledge of how little you can know about the future, coupled with the acceptance of your ignorance, is a defensive investor's most powerful weapon. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. The aggressive investor should start from the same base as the defensive investor, namely, a division of his funds between high-grade bonds and high-grade common stocks, bought at reasonable prices. He will be prepared to branch out into other kinds of security commitments, but in each case he will want a well-reasoned justification for the departure. There is a difficulty in discussing this topic in orderly fashion, because there is no single or ideal pattern for aggressive operations. The field of choice is wide. The selection should depend not only on the individual's competence and equipment, but perhaps equally well upon his interests and preferences. The most useful generalizations for the enterprising investor are of a negative sort. Let him leave high-grade preferred stocks to corporate buyers. Let him also avoid inferior types of bonds and preferred stocks unless they can be bought at bargain levels, which means ordinarily at prices at least 30% under par for high coupon issues, and much less for the lower coupons. He will let someone else buy foreign government bond issues, even though the yield may be attractive. He will also be wary of all kinds of new issues, including convertible bonds and preferreds that seem quite tempting, and common stocks with excellent earnings confined to the recent past. For standard bond investments, the aggressive investor would do well to follow the pattern suggested to his defensive confrere. and make his choice between high-grade taxable issues, which can now be selected to yield about 7.25%, and good-quality tax-free bonds, which yield up to 5.3% on longer maturities. Second-grade bonds and preferred stocks. Since in late 1971 it is possible to find first-rate corporate bonds to yield 7.25%, and even more, it would not make much sense to buy second-grade issues merely for the higher return they offer. In fact, corporations with relatively poor credit standing have found it virtually impossible to sell straight bonds, for example, non-convertibles, to the public in the past 2 years. Hence, their debt financing has been done by the sale of convertible bonds, or bonds with warrants attached, which place them in a separate category. It follows that virtually all the non-convertible bonds of inferior rating represent older issues which are selling at a large discount. Thus, they offer the possibility of a substantial gain in principal value under favorable future conditions, which would mean here a combination of an improved credit rating for the company and lower general interest rates. But even in the matter of price discounts and resultant chance of principal gain, the second-grade bonds are in competition with better issues. Some of the well-entrenched obligations with old-style coupon rates, 2.5% to 4%, sold at about 50 cents on the dollar in 1970. Examples: American Telephone and Telegraph, 2 5/8, due 1986, sold at 51. Atchison, Topeka, and Santa Fe Railroad 4s, due 1995, sold at 51. McGraw-Hill, 3 7/8, due 1992, sold at 50 1/2. Hence, under conditions of late 1971, the enterprising investors can probably get from good-grade bonds selling at a large discount all that he should reasonably desire, in the form of both income and chance of appreciation. Throughout this audiobook, we refer to the possibility that any well-defined and protracted market situation of the past may return in the future. Hence, we should consider what policy the aggressive investor might have to choose in the bond field if prices and yields of high-grade issues should return to former normals. For this reason, we shall restate here our observations on that point made in the 1965 edition, when high-grade bonds yielded only 4.5%. Something should be said now about investing in second-grade issues, which can readily be found to yield any specified return up to 8% or more. The main difference between first and second-grade bonds is usually found in the number of times the interest charges have been covered by earnings. Example: in early 1964, Chicago, Milwaukee, St. Paul, and Pacific 5% income debenture bonds at 68 yielded 7.35%, but the total interest charges of the road before income taxes were earned only 1.5 times in 1963, against our requirement of 5 times for a well-protected railroad issue. Many investors buy securities of this kind because they need income and cannot get along with the meager return offered by top-grade issues. Experience clearly shows that it is unwise to buy a bond or a preferred which lacks adequate safety merely because the yield is attractive. Here the word merely implies that the issue is not selling at a large discount and thus does not offer an opportunity for a substantial gain in principal value. Where such securities are bought at full prices, that is, not many points under 100, the chances are very great that at some future time the holder will see much lower quotations. For when bad business comes, or just a bad market, issues of this kind prove highly susceptible to severe sinking spells. Often interest or dividends are suspended, or at least endangered, and frequently there is a pronounced price weakness, even though the operating results are not at all bad. As a specific illustration of this characteristic of second-quality senior issues, let us summarize the price behavior of a group of 10 railroad income bonds in 1946 through 47. These comprise all of those which sold at 96 or more in 1946, their high prices averaging 102.5. By the following year, the group had registered low prices averaging only 68, a loss of 1/3 of the market value in a very short time. Peculiarly enough, the railroads of the country were showing much better earnings in 1947 than in 1946. Hence, the drastic price decline ran counter to the business picture and was a reflection of the sell-off in the general market. But it should be pointed out that the shrinkage in these income bonds was proportionately larger than that in the common stocks in the Dow Jones Industrial List, about 23%. Obviously, the purchaser of these bonds at a cost above 100 could not have expected to participate to any extent in a further rise in the securities market. The only attractive feature was the income yield, averaging about 4.25%, against 2.5% for first-grade bonds, an advantage of 1.75% in annual income. Yet the sequel showed all too soon and too plainly that for the minor advantage in annual income, the buyer of these second-grade bonds was risking the loss of a substantial part of his principal. This example permits us to pay our respects to the popular fallacy that goes under the sobriquet of a businessman's investment. That involves the purchase of a security showing a larger yield than is obtainable on a high-grade issue, and carrying a correspondingly greater risk. It is bad business to accept an acknowledged possibility of a loss of principal in exchange for a mere 1 or 2% of additional yearly income. If you're willing to assume some risk, you should be certain that you can realize a really substantial gain in principal value if things go well. Hence, a second-grade 5.5 or 6% bond selling at par is almost always a bad purchase. The same issue at 70 might make more sense, and if you're patient, you'll probably be able to buy it at that level. Second-grade bonds and preferred stocks possess two contradictory attributes, which the intelligent investor must bear clearly in mind. Nearly all suffer severe sinking spells in bad markets. On the other hand, a large proportion recover their position when favorable conditions return, and these ultimately work out all right. This is true even of cumulative preferred stocks that fail to pay dividends for many years. There were a number of such issues in the early 1940s as a consequence of the long depression of the 1930s. During the post-war boom period of 1945 through 1947, many of these large accumulations were paid off either in cash or in new securities, and the principal was often discharged as well. As a result, large profits were made by people who, a few years previously, had bought these issues when they were friendless and sold at low prices. It may well be true that in an overall accounting, the higher yields obtainable on second-grade senior issues will prove to have offset those principal losses that were irrevocable. In other words, an investor who bought all such issues at their offering prices might conceivably fare as well in the long run as one who limited himself to first-quality securities, or even somewhat better. But for practical purposes, the question is largely irrelevant. Regardless of the outcome, the buyer of second-grade issues at full prices will be worried and discommoded when their price declines precipitately. Furthermore, he cannot buy enough issues to assure an average result, nor is he in a position to set aside a portion of his larger income to offset or amortize those principal losses which prove to be permanent. Finally, it is mere common sense to abstain from buying securities at around 100 if long experience indicates that they can probably be bought at 70 or less in the next weak market. Foreign government bonds. All investors with even small experience know that foreign bonds as a whole have had a bad investment history since 1914. This was inevitable in the light of 2 world wars and an intervening world depression of unexampled depth. Yet every few years, market conditions are sufficiently favorable to permit the sale of some new foreign issues at a price of about par. This phenomenon tells us a good deal about the working of the average investor's mind, and not only in the field of bonds. We have no concrete reason to be concerned about the future history of well-regarded foreign bonds, such as those of Australia or Norway. But we do know that if and when trouble should come, the owner of foreign obligations has no legal or other means of enforcing his claim. Those who bought Republic of Cuba 4.5s as high as 117 in 1953 saw them default their interest and then sell as low as 20 cents on the dollar in 1963. The New York Stock Exchange bond list in that year also included Belgian Congo 5 1/4 at 36, Greek 7s at 30, and various issues of Poland as low as 7. How many listeners have any idea of the repeated vicissitudes of the 8% bonds of Czechoslovakia, since they were first offered in this country in 1922 at 96.5? They advanced to 112 in 1928, declined to 67 3/4 in 1932, recovered to 106 in 1936, collapsed to 6 in 1939, recovered unbelievably to 117 in 1946, fell promptly to 35 in 1948, and sold as low as 8 in 1970. Years ago, an argument of sorts was made for the purchase of foreign bonds, here on the grounds that a rich creditor nation such as ours was under moral obligation to lend abroad. Time, which brings so many revenges, now finds us dealing with an intractable balance of payments problem of our own, part of which is ascribable to the large-scale purchase of foreign bonds by American investors seeking a small advantage in yield. For many years past, we have questioned the inherent attractiveness of such investments from the standpoint of the buyer. Perhaps we should add now that the latter would benefit both his country and himself if he declined these opportunities. New issues generally. It might seem ill-advised to attempt any broad statements about new issues as a class, since they cover the widest possible range of quality and attractiveness. Certainly, there will be exceptions to any suggested rule. Our one recommendation is that all investors should be wary of new issues, which means simply that these should be subjected to careful examination and unusually severe tests before they are purchased. There are 2 reasons for this double caveat. The first is that new issues have special salesmanship behind them, which calls therefore for a special degree of sales resistance. The second is that most new issues are sold under favorable market conditions, which means favorable for the seller, and consequently less favorable for the buyer. The effect of these considerations becomes steadily more important as we go down the scale from the highest quality bonds through second-grade senior issues to common stock flotations at the bottom. A tremendous amount of financing, consisting of the repayment of existing bonds at call price and their replacement by new issues with lower coupons, was done in the past. Most of this was in the category of high-grade bonds and preferred stocks. The buyers were largely financial institutions, amply qualified to protect their interests. Hence, these offerings were carefully priced to meet the going rate for comparable issues, and high-powered salesmanship had little effect on the outcome. As interest rates fell lower and lower, the buyers finally came to pay too high a price for these issues, and many of them later declined appreciably in the market. This is one aspect of the general tendency to sell new securities of all types when conditions are most favorable to the issuer, but in the case of first-quality issues, the ill effects to the purchaser are likely to be unpleasant rather than serious. The situation proves somewhat different when we study the lower-grade bonds and preferred stocks sold during the 1945 through 46 and 1960 through 61 periods. Here, the effect of the selling effort is more apparent, because most of these issues were probably placed with individual and inexpert investors. It was characteristic of these offerings that they did not make an adequate showing when judged by the performance of the companies over a sufficient number of years. They did look safe enough, for the most part, if it could be assumed that the recent earnings would continue without a serious setback. The investment bankers who brought out these issues presumably accepted this assumption, and their salesmen had little difficulty in persuading themselves and their customers to a like effect. Nevertheless, it was an unsound approach to investment, and one likely to prove costly. Bull market periods are usually characterized by the transformation of a large number of privately owned businesses into companies with quoted shares. This was the case in 1945 through 46, and again beginning in 1960. The process then reached extraordinary proportions until brought to a catastrophic close in May 1962. After the usual swearing-off period of several years, the whole tragic comedy was repeated, step by step, in 1967 through 1969. New common stock offerings. The following paragraphs are reproduced unchanged from the 1959 edition, with comment added. Common stock financing takes two different forms. In the case of companies already listed, additional shares are offered pro rata to the existing stockholders. The subscription price is set below the current market, and the rights to subscribe have an initial money value. The sale of the new shares is almost always underwritten by one or more investment banking houses. But it is the general hope and expectation that all new shares will be taken by the exercise of the subscription rights. Thus, the sale of additional common stock of listed companies does not ordinarily call for active selling effort on the part of distributing firms. The second type is the placement with the public of common stock of what were formerly privately owned enterprises. Most of this stock is sold for the account of the controlling interests, to enable them to cash in on a favorable market and to diversify their own finances. When new money is raised for the business, it comes often via the sale of preferred stock, as previously noted. This activity follows a well-defined pattern, which by the nature of the security markets must bring many losses and disappointments to the public. The dangers arise both from the character of the businesses that are thus financed and from the market conditions that make the financing possible. In the early part of the century, a large proportion of our leading companies were introduced to public trading. As time went on, the number of enterprises of first rank that remained closely held steadily diminished. Hence, original common stock flotations have tended to be concentrated more and more on relatively small concerns. By an unfortunate correlation, during the same period, the stock-buying public has been developing an ingrained preference for the major companies, and a similar prejudice against the minor ones. This prejudice, like many others, tends to become weaker as bull markets are built up. The large and quick profits shown by common stocks as a whole are sufficient to dull the public's critical faculty, just as they sharpen its acquisitive instinct. During these periods, also, quite a number of privately owned concerns can be found that are enjoying excellent results, although most of these would not present too impressive a record if the figures were carried back, say, 10 years or more. When these factors are put together, the following consequences emerge. Somewhere in the middle of the bull market, the first common stock flotations make their appearance. These are priced not unattractively, and some large profits are made by the buyers of the early issues. As the market rise continues, this brand of financing grows more frequent. The quality of the companies becomes steadily poorer. The prices asked and obtained verge on the exorbitant. One fairly dependable sign of the approaching end of a bull swing is the fact that new common stocks of small and nondescript companies are offered at prices somewhat higher than the current level for many medium-sized companies with a long market history. It should be added that very little of this common stock financing is ordinarily done by banking houses of prime size and reputation. The heedlessness of the public and the willingness of selling organizations to sell whatever may be profitably sold can have only one result: price collapse. In many cases, the new issues lose 75% and more of their offering price. The situation is worsened by the aforementioned fact that, at bottom, the public has a real aversion to the very kind of small issue that it bought so readily in its careless moments. Many of these issues fall proportionately as much below their true value as they formerly sold above it. An elementary requirement for the intelligent investor is an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Even if one or two can be found that can pass severe tests of quality and value, it is probably bad policy to get mixed up in this sort of business. Of course, the salesmen will point to many such issues which have had good-sized market advances, including some that go up spectacularly the very day they are sold. But all this is part of the speculative atmosphere. It is easy money. For every dollar you make in this way, you will be lucky if you end up by losing only 2. Some of these issues may prove excellent buys a few years later, when nobody wants them, and they can be had at a small fraction of their true worth. In the 1965 edition, we continued our discussion of this subject as follows. While the broader aspects of the stock market's behavior since 1949 have not lent themselves well to analysis based on long experience, the development of new common stock flotations proceeded exactly in accordance with ancient prescription. It is doubtful whether we ever before had so many new issues offered, of such low quality, and with such extreme price collapses, as we experienced in 1960 through 1962. The ability of the stock market as a whole to disengage itself rapidly from that disaster is indeed an extraordinary phenomenon, bringing back long-buried memories of the similar invulnerability it showed to the great Florida real estate collapse in 1925. Must there be a return of the new stock offering madness before the present bull market can come to its definitive close? Who knows? But we do know that an intelligent investor will not forget what happened in 1962, and will let others make the next batch of quick profits in this area, and experience the consequent harrowing losses. We followed these paragraphs in the 1965 edition by citing a horrible example, namely the sale of stock of Aetna Maintenance Company at $9 in November 1961. In typical fashion, the shares promptly advanced to $15. The next year, they fell to 2 3/8, and in 1964 to 7/8. The later history of this company was on the extraordinary side, and illustrates some of the strange metamorphoses that have taken place in American business, great and small, in recent years. The curious listener will find the older and newer history of this enterprise in Appendix 5. It is by no means difficult to provide even more harrowing examples taken from the more recent version of the same old story, which covered the years 1967 through 1970. Nothing could be more pat to our purpose than the case of AAA Enterprises, which happens to be the first company then listed in Standard & Poor's Stock Guide. The shares were sold to the public at $14 in 1968, promptly advanced to $28, but in early 1971 were quoted at a dismal 25 cents. Even this price represented a gross overvaluation of the enterprise, since it had just entered the bankruptcy court in a hopeless condition. There is so much to be learned, and such important warnings to be gleaned, from the story of this flotation, that we've reserved it for detailed treatment in Chapter 17. Commentary on Chapter 6. The punches you miss are the ones that wear you out. Boxing trainer Angelo Dundee. For the aggressive as well as the defensive investor, what you don't do is as important to your success as what you do. In this chapter, Graham lists his don'ts for aggressive investors. Here is a list for today. Junkyard dogs? High-yield bonds, which Graham calls second-grade or lower grade, and today are called junk bonds, get a brisk thumbs down from Graham. In his day, it was too costly and cumbersome for an individual investor to diversify away the risks of default. Today, however, more than 130 mutual funds specialize in junk bonds. These funds buy junk by the cartload. They hold dozens of different bonds. That mitigates Graham's complaints about the difficulty of diversifying. However, his bias against high-yield preferred stock remains valid, since there remains no cheap and widely available way to spread their risks. Since 1978, an annual average of 4.4% of the junk bond market has gone into default. But even after those defaults, junk bonds have still produced an annualized return of 10.5% versus 8.6% for 10-year U.S. Treasury bonds. Unfortunately, most junk bond funds charge high fees and do a poor job of preserving the original principal amount of your investment. A junk fund could be appropriate if you're retired, are looking for extra monthly income to supplement your pension, and can tolerate temporary tumbles in value. If you work at a bank or other financial company, a sharp rise in interest rates could limit your raise, or even threaten your job security. So a junk fund, which tends to outperform most other bond funds when interest rates rise, might make sense as a counterweight in your 401k. A junk bond fund, though, is only a minor option, not an obligation for the intelligent investor. A world of hurt for WorldCom bonds. Buying a bond only for its yield is like getting married only for the sex. If the thing that attracted you in the first place dries up, you'll find yourself asking, what else is there? And the answer is nothing. Spouses and bondholders alike end up with broken hearts. On May 9th, 2001, WorldCom Inc. sold the biggest offering of bonds in U.S. corporate history, $11.9 billion worth. Among the eager beavers attracted by the yields of up to 8.3% were the California Public Employees Retirement System, one of the world's largest pension funds. Retirement Systems of Alabama, whose managers later explained that the higher yields were very attractive to us at the time they were purchased. And the strong corporate bond fund, whose co-manager was so fond of WorldCom's fat yield that he boasted, "We're getting paid more than enough extra income for the risk." But even a 30-second glance at WorldCom's bond prospectus would have shown that these bonds had nothing to offer but their yield, and everything to lose. In 2 of the previous 5 years, WorldCom's pre-tax income, the company's profits before it paid its dues to the IRS, fell short of covering its fixed charges, the costs of paying interest to its bondholders, by a stupendous $4.1 billion. WorldCom could cover those bond payments only by borrowing more money from banks. And now, with this mountainous new helping of bonds, WorldCom was fattening its interest costs by another $900 million per year. Like Mr. Creosote in Monty Python's The Meaning of Life, WorldCom was gorging itself to the bursting point. No yield could ever be high enough to compensate an investor for risking that kind of explosion. The WorldCom bonds did produce fat yields of up to 8% for a few months. Then, as Graham would have predicted, the yield suddenly offered no shelter. WorldCom filed bankruptcy in July 2002. WorldCom admitted in August 2002 that it had overstated its earnings by more than $7 billion. WorldCom's bonds defaulted when the company could no longer cover their interest charges. The bonds lost more than 80% of their original value. The vodka and burrito portfolio. Graham considered foreign bonds no better a bet than junk bonds. Today, however, one variety of foreign bond may have some appeal for investors who can withstand plenty of risk. Roughly a dozen mutual funds specialize in bonds issued in emerging market nations, or what used to be called third world countries, like Brazil, Mexico, Nigeria, Russia, and Venezuela. No sane investor would put more than 10% of a total bond portfolio in spicy holdings like these. But emerging markets bond funds seldom move in sync with the U.S. stock market, so they are one of the rare investments that are unlikely to drop merely because the Dow is down. That can give you a small corner of comfort in your portfolio, just when you may need it most. Dying a trader's death. As we've already seen in Chapter 1, day trading, holding stocks for a few hours at a time, is one of the best weapons ever invented for committing financial suicide. Some of your trades might make money. Most of your trades will lose money. But your broker will always make money. And your own eagerness to buy or sell a stock can lower your return. Someone who is desperate to buy a stock can easily end up having to bid 10 cents higher than the most recent share price before any sellers will be willing to part with it. That extra cost, called market impact, never shows up on your brokerage statement, but it's real. If you're overeager to buy 1,000 shares of a stock and you drive its price up by just 5 cents, you've just cost yourself an invisible but very real $50. On the flip side, when panicky investors are frantic to sell a stock and they dump it for less than the most recent price, market impact hits home again. The costs of trading wear away your returns like so many swipes of sandpaper. Buying or selling a hot little stock can cost 2% to 4%, or 4% to 8% for our round-trip buy and sell transaction. If you put $1,000 into a stock, your trading costs could eat up roughly $40 before you even get started. Sell the stock and you could fork over another 4% in trading expenses. Oh yes, there's one other thing. When you trade instead of invest, you turn long-term gains, taxed at a maximum capital gains rate of 20%, into ordinary income, taxed at a maximum rate of 38.6%. Add it all up, and a stock trader needs to gain at least 10% just to break even on buying and selling a stock. Anyone can do that once, by luck alone. To do it often enough to justify the obsessive attention it requires, plus the nightmarish stress it generates, is impossible. Thousands of people have tried, and the evidence is clear. The more you trade, the less you keep. Finance professors Brad Barber and Terrence Odine of the University of California examined the trading records of more than 66,000 customers of a major discount brokerage firm. From 1991 through 1996, these clients made more than 1.9 million trades. Before the costs of trading sandpapered away at their returns, the people in the study actually outperformed the market by an average of at least half a percentage point per year. But after trading costs, the most active of these traders, who shifted more than 20% of their stock holdings per month, went from beating the market to underperforming it by an abysmal 6.4 percentage points per year. The most patient investors, however, who traded a minuscule 0.2% of their total holdings in an average month, managed to outperform the market by a whisker, even after their trading costs. Instead of giving a huge hunk of their gains away to their brokers and the IRS, they got to keep almost everything. For a look at these results, see Figure 6.1 on the enhancement. The lesson is clear. Don't just do something, stand there. It's time for everyone to acknowledge that the term long-term investor is redundant. A long-term investor is the only kind of investor there is. Someone who can't hold on to stocks for more than a few months at a time is doomed to end up not as a victor, but as a victim. The early bird gets wormed. Among the get-rich-quick toxins that poisoned the mind of the investing public in the 1990s, one of the most lethal was the idea that you could build wealth by buying IPOs. An IPO is an initial public offering, or the first sale of a company's stock to the public. At first blush, investing in IPOs sounds like a great idea. After all, if you'd bought 100 shares of Microsoft when it went public on March 13, 1986, your $2,100 investment would have grown to $720,000 by early 2003. And finance professors Jay Ritter and William Schwert have shown that if you had spread a total of only $1,000 across every IPO in January 1960 at its offering price, sold out at the end of that month, then invested anew in each successive month's crop of IPOs, your portfolio would have been worth more than $533 decillion by year-end 2001. On the printed page, that looks like this: 533 followed by 33 zeros. The faster you run, the behinder you get. Unfortunately, for every IPO like Microsoft that turns out to be a big winner, there are thousands of losers. The psychologists Daniel Kahneman and Amos Tversky have shown when humans estimate the likelihood or frequency of an event, we make that judgment based not on how often the event has actually occurred, but on how vivid the past examples are. We all want to buy the next Microsoft, precisely because we know we missed buying the first Microsoft. But we conveniently overlook the fact that most other IPOs were terrible investments. You could have earned that $533 decillion gain only if you never missed a single one of the IPO market's rare winners. A practical impossibility. Finally, most of the high returns on IPOs are captured by members of an exclusive private club, the big investment banks and fund houses that get shares at the initial or underwriting price before the stock begins public trading. The biggest run-ups often occur in stocks so small that even many big investors can't get any shares. There just aren't enough to go around. If, like nearly every investor, you can get access to IPOs only after their shares have rocketed above the exclusive initial price, your results will be terrible. From 1980 through 2001, if you had bought the average IPO at its first public closing price and held on for 3 years, you would have underperformed the market by more than 23 percentage points annually. Perhaps no stock personifies the pipe dream of getting rich from IPOs better than VA Linux. Linux, the next Microsoft, exulted an early owner. Buy now and retire in 5 years from now. On December 9, 1999, the stock was placed at an initial public offering price of $30. But demand for the shares was so ferocious that when NASDAQ opened that morning, none of the initial owners of VA Linux would let go of any shares until the price hit $299. The stock peaked at $320 and closed at $239.25, a gain of 697.5% in a single day. But that gain was earned by only a handful of institutional traders. Individual investors were almost entirely frozen out. More important, buying IPOs is a bad idea because it flagrantly violates one of Graham's most fundamental rules. No matter how many other people want to buy a stock, you should buy only if the stock is a cheap way to own a desirable business. At the peak price on day one, investors were valuing VA Linux's shares at a total of $12.7 billion. What was the company's business worth? Less than 5 years old, VA Linux had sold a cumulative total of $44 million worth of its software and services, but it lost $25 million in the process. In its most recent fiscal quarter, VA Linux had generated $15 million in sales, but had lost $10 million on them. This business then was losing almost 70 cents on every dollar it took in. VA Linux's accumulated deficit, the amount by which its total expenses had exceeded its income, was $30 million. If VA Linux were a private company owned by the guy who lives next door, and he leaned over the picket fence and asked you how much you would pay to take his struggling little business off his hands, would you answer, $12.7 billion sounds about right to me? Or would you instead smile politely, turn back to your barbecue grill, and wonder what on earth your neighbor had been smoking? Relying exclusively on our own judgment, none of us would be caught dead agreeing to pay nearly $13 billion for a money loser that was already $30 million in the hole. But when we're in public instead of in private, when valuation suddenly becomes a popularity contest, the price of a stock seems more important than the value of the business it represents. As long as someone else will pay even more than you did for a stock, why does it matter what the business is worth? This chart in Figure 6.2 on the enhancement shows why it matters. After going up like a bottle rocket on that first day of trading, VA Linux came down like a buttered brick. By December 9th, 2002, 3 years to the day after the stock was at $239.50, VA Linux closed at $1.19 per share. Weighing the evidence objectively, the intelligent investor should conclude that IPO does not stand only for initial public offering. More accurately, it is also shorthand for, it's probably overpriced. Imaginary profits only. Insider's private opportunity, or idiotic, preposterous, and outrageous. Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. The enterprising investor, by definition, will devote a fair amount of his attention and efforts toward obtaining a better than run-of-the-mill investment result. In our discussion of general investment policy, we've made some suggestions regarding bond investments that are addressed chiefly to the enterprising investor. He might be interested in special opportunities of the following kinds. 1. Tax-free new housing authority bonds, effectively guaranteed by the United States government. 2. Taxable but high-yielding new community bonds, also guaranteed by the United States government. 3. Tax-free industrial bonds issued by municipalities, but serviced by lease payments made by strong corporations. References have been made to these unusual types of bond issues in Chapter 4. At the other end of the spectrum, there may be lower quality bonds obtainable at such low prices as to constitute true bargain opportunities. But these would belong in this special situation area, where no true distinction exists between bonds and common stocks. Operations in common stocks. The activities specially characteristic of the enterprising investor in the common stock field may be classified under 4 heads. 1. Buying in low markets and selling in high markets. 2. Buying carefully chosen growth stocks. 3. Buying bargain issues of various types. 4. Buying into special situations. General market policy, formula timing. We reserve for the next chapter our discussion of the possibilities and limitations of a policy of entering the market when it is depressed and selling out in the advanced stages of a boom. For many years in the past, this bright idea appeared both simple and feasible, at least from first inspection of a market chart covering its periodic fluctuations. We have already admitted ruefully that the market's action in the past 20 years has not lent itself to operations of this sort on any mathematical basis. The fluctuations that have taken place, while not inconsiderable in extent, would have required a special talent, or feel, for trading, to take advantage of them. This is something quite different from the intelligence which we are assuming in our listeners, and we must exclude operations based on such skill from our terms of reference. The 50-50 plan, which we propose to the defensive investor and described on page 90, is about the best specific or automatic formula we can recommend to all investors under the conditions of 1972. But we've retained a broad leeway between the 25% minimum and the 75% maximum in common stocks, which we allow to those investors who have strong convictions about either the danger or the attractiveness of the general market level. Some 20 years ago, it was possible to discuss in great detail a number of clear-cut formulas for varying the percentage held in common stocks, with confidence that these plans had practical utility. The time seemed to have passed such approaches by, and there would be little point in trying to determine new levels for buying and selling out of the market patterns since 1949. That is too short a period to furnish any reliable guide to the future. Growth stock approach. Every investor would like to select the stocks of companies that will do better than the average over a period of years. A growth stock may be defined as one that has done this in the past and is expected to do so in the future. Thus, it seems only logical that the intelligent investor should concentrate upon the selection of growth stocks. Actually, the matter is more complicated, as we shall try to show. It is a mere statistical chore to identify companies that have outperformed the averages in the past. The investor can obtain a list of 50 or 100 such enterprises from his broker. Why then should he not merely pick out the 15 or 20 most likely-looking issues of this group, and lo, he has a guaranteed successful stock portfolio? There are 2 catches to this simple idea. The first is that common stocks with good records and apparently good prospects sell at correspondingly high prices. The investor may be right in this judgment of their prospects and still not fare particularly well, merely because he is paid in full, and perhaps overpaid, for the expected prosperity. The second is that his judgment as to the future may prove wrong. Usually, rapid growth cannot keep up forever. When a company has already registered a brilliant expansion, its very increase in size makes a repetition of its achievement more difficult. At some point, the growth curve flattens out, and in many cases, it turns downward. It is obvious that if one confines himself to a few chosen instances, based on hindsight, he could demonstrate that fortunes can readily be either made or lost in the growth stock field. How can one judge fairly of the overall results obtainable here? We think that reasonably sound conclusions can be drawn from a study of the results achieved by the investment funds specializing in the growth stock approach. The authoritative manual entitled Investment Companies, published annually by Arthur Weisenberger and Company, members of the New York Stock Exchange, computes the annual performance of some 120 such growth funds over a period of years. Of these, 45 have records covering 10 years or more. The average overall gain for these companies, unweighted for size of fund, works out at 108% for the decade 1961 through 1970, compared with 105% for the S&P Composite and 83% for the DJIA. In the 2 years 1969 and 1970, the majority of the 126 growth funds did worse than either index. Similar results were found in our earlier studies. The implication here is that no outstanding rewards came from diversified investment in growth companies, as compared with that in common stocks generally. There is no reason at all for thinking that the average intelligent investor, even with much devoted effort, can derive better results over the years from the purchase of growth stocks than the investment companies specializing in this area. Surely these organizations have more brains and better research facilities at their disposal than you do. Consequently, we should advise against the usual type of growth stock commitment for the enterprising investor. This is one in which the excellent prospects are fully recognized in the market and already reflected in a current price-earnings ratio of, say, higher than 20. For the defensive investor, we suggested an upper limit of purchase price at 25 times average earnings of the past 7 years. The two criteria would be about equivalent in most cases. The striking thing about growth stocks as a class is their tendency toward wide swings in market price. This is true of the largest and longest established companies, such as General Electric and International Business Machines, and even more so of newer and smaller successful companies. They illustrate our thesis that the main characteristic of the stock market since 1949 has been the injection of a highly speculative element into the shares of companies which have scored the most brilliant successes, and which themselves would be entitled to a high investment rating. Their credit standing is of the best, and they pay the lowest interest rates on their borrowings. The investment caliber of such a company may not change over a long span of years, but the risk characteristics of its stock will depend on what happens to it in the stock market. The more enthusiastic the public grows about it, and the faster its advance as compared with the actual growth in its earnings, the riskier a proposition it becomes. But it is not true, the listener may ask, that the really big fortunes from common stocks have been garnered by those who made a substantial commitment in the early years of a company in whose future they had great confidence, and who held their original shares unwaveringly while they increased 100-fold or more in value. The answer is yes. But the big fortunes from single company investments are almost always realized by persons who have a close relationship with the particular company, through employment, family, connection, etc., which justifies them in placing a large part of their resources in one medium and holding on to this commitment through all vicissitudes, despite numerous temptations to sell out at apparently high prices along the way. An investor without such close personal contact will constantly be faced with the question of whether too large a portion of his funds are in this one medium. Each decline, however temporary it proves in the sequel, will accentuate his problem, and internal and external pressures are likely to force him to take what seems to be a goodly profit, but one far less than the ultimate bonanza. 3 recommended fields for enterprising investment. To obtain better than average investment results over a long pull requires a policy of selection, or operation possessing a twofold merit. 1, it must meet objective or rational tests of underlying soundness, and 2, it must be different from the policy followed by most investors or speculators. Our experience and study leads us to recommend 3 investment approaches that meet these criteria. They differ rather widely from one another, and each may require a different type of knowledge and temperament on the part of those who assay it. The relatively unpopular large company. If we assume that it is the habit of the market to overvalue common stocks, which have been showing excellent growth or are glamorous for some other reason, it is logical to expect that it will undervalue, relatively at least, companies that are out of favor because of unsatisfactory developments of a temporary nature. This may be set down as a fundamental law of the stock market, and it suggests an investment approach that should prove both conservative and promising. The key requirement here is that the enterprising investor concentrate on the larger companies that are going through a period of unpopularity. While small companies may also be undervalued for similar reasons, and in many cases may later increase their earnings and share price, they entail the risk of a definitive loss of profitability, and also of protracted neglect by the market in spite of better earnings. The large companies thus have a double advantage over the others. First, they have the resources and capital and brainpower to carry them through adversity, and back to a satisfactory earnings base. Second, the market is likely to respond with reasonable speed to any improvement shown. A remarkable demonstration of the soundness of this thesis is found in studies of the price behavior of the unpopular issues in the Dow Jones Industrial Average. In these, it was assumed that an investment was made each year in either the 6 or the 10 issues in the DJIA, which were selling at the lowest multipliers of their current or previous year's earnings. These could be called the cheapest stocks in the list, and their cheapness was evidently the reflection of relative unpopularity with investors or traders. It was assumed further that these purchases were sold out at the end of holding periods, ranging from 1 to 5 years. The results of these investments were then compared with the results shown in either the DJIA as a whole, or in the highest multiplier, for example, the most popular group. The detailed material we have available covers the results of annual purchases assumed in each of the past 53 years. In the early period, 1917 through 1933, this approach proved unprofitable. But since 1933, the method has shown highly successful results. In 34 tests made by Drexel and Company, now Drexel Firestone, of 1-year holding from 1937 through 1969, the cheap stocks did definitely worse than the DJIA in only 3 instances. The results were about the same in 6 cases, and the cheap stocks clearly outperformed the average in 25 years. The consistently better performance of the low multiplier stocks is shown by the average results for successive 5-year periods, when compared with those of the DJIA and of the 10 high multipliers. See Table 7.2 on the enhancement for further illustration. The Drexel computation shows further that an original investment of $10,000 made in the low multiplier issues in 1936, and switched each year in accordance with the principle, would have grown to $66,900 by 1962. The same operations in high multiplier stocks would have ended with a value of only $25,300, while an operation in all 30 stocks would have increased the original fund to $44,000. The concept of buying unpopular, large companies and its execution on a group basis, as described before, are both quite simple. But in considering individual companies, a special factor of opposite import must sometimes be taken into account. Companies that are inherently speculative because of widely varying earnings tend to sell both at a relatively high price and a relatively low multiplier in their good years, and conversely at low prices and high multipliers in their bad years. These relationships are illustrated in Table 7.3 found on the enhancement, covering fluctuations of Chrysler Core Common. In these cases, the market has sufficient skepticism as to the continuation of the unusually high profits to value them conservatively, and conversely, when earnings are low or non-existent. Note that by the arithmetic, if a company earns next to nothing, its shares must sell at a high multiplier of these minuscule profits. As it happens, Chrysler has been quite exceptional in the DJIA list of leading companies, and hence it did not greatly affect the low multiplier calculations. It would be quite easy to avoid inclusion of such anomalous issues in a low multiplier list by requiring also that the price be low in relation to past average earnings, or by some similar test. While writing this revision, we tested the results of the DJIA low multiplier method, applied to a group assumed to be bought at the end of 1968 and revalued on June 30th, 1971. This time the figures proved quite disappointing, showing a sharp loss for the low multiplier 6 or 10, and a good profit for the high multiplier selections. This one bad instance should not vitiate conclusions based on 30-odd experiments, but its recent happening gives it a special adverse weight. Perhaps the aggressive investor should start with the low multiplier idea, but add other quantitative and qualitative requirements thereto in making up his portfolio. Purchase of bargain issues. We define a bargain issue as one which, on the basis of facts established by analysis, appears to be worth considerably more than it is selling for. The genus includes bonds and preferred stocks, selling well under par, as well as common stocks. To be as concrete as possible, let us suggest that an issue is not a true bargain unless the indicated value is at least 50% more than the price. What kind of facts would warrant the conclusion that so great a discrepancy exists? How do bargains come into existence, and how does the investor profit from them? There are two tests by which a bargain common stock is detected. The first is by the method of appraisal. This relies largely on estimating future earnings and then multiplying these by a factor appropriate to the particular issue. If the resultant value is sufficiently above the market price, and if the investor has confidence in the technique employed, he can tag the stock as a bargain. The second test is the value of the business to a private owner. This value also is often determined chiefly by expected future earnings, in which case the result may be identical with the first. But in the second test, more attention is likely to be paid to the realizable value of the assets, with particular emphasis on the net current assets or working capital. At low points in the general market, a large proportion of common stocks are bargain issues, as measured by these standards. A typical example was General Motors when it sold at less than 30 in 1941, equivalent to only 5 for the 1971 shares. It had been earning in excess of $4 and paying $3.50 or more in dividends. It is true that current earnings and the immediate prospects may both be poor, but a level-headed appraisal of average future conditions would indicate values far above ruling prices. Thus, the wisdom of having courage in depressed markets is vindicated not only by the voice of experience, but also by application of plausible techniques of value analysis. The same vagaries of the marketplace that recurrently establish a bargain condition in the general list account for the existence of many individual bargains at almost all market levels. The market is fond of making mountains out of molehills and exaggerating ordinary vicissitudes into major setbacks. Even a mere lack of interest or enthusiasm may impel a price decline to absurdly low levels. Thus, we have what appear to be two major sources of undervaluation. 1, currently disappointing results, and 2, protracted neglect or unpopularity. However, neither of these causes, if considered by itself alone, can be relied on as a guide to successful common stock investment. How can we be sure that the currently disappointing results are indeed going to be only temporary? True, we can supply excellent examples of that happening. The steel stocks used to be famous for their cyclical quality, and the shrewd buyer could acquire them at low prices when earnings were low and sell them out in boom years at a fine profit. A spectacular example is supplied by Chrysler Corporation, as shown by the data in Table 7.3 on the enhancement. If this were the standard behavior of stocks with fluctuating earnings, then making profits in the stock market would be an easy matter. Unfortunately, we could cite many examples of declines in earnings and price, which were not followed automatically by a handsome recovery of both. One such was Anaconda Wire and Cable, which had large earnings up to 1956, with a high price of $85 in that year. The earnings then declined irregularly for 6 years. The price fell to $23.5 in 1962, and the following year it was taken over by its parent enterprise, Anaconda Corporation, at the equivalent of only $33. The many experiences of this type suggest that the investor would need more than a mere falling off in both earnings and price to give him a sound basis for purchase. He should require an indication of at least reasonable stability of earnings over the past decade or more. For example, no year of earnings deficit, plus sufficient size and financial strength to meet possible setbacks in the future. The ideal combination here is thus that of a large and prominent company selling both well below its past average price and its past average price over earnings multiplier. This would no doubt have ruled out most of the profitable opportunities in companies such as Chrysler, since their low price years are generally accompanied by high price over earnings ratios. But let us assure the listener now, and no doubt we shall do it again, that there is a world of difference between hindsight profits and real money profits. We doubt seriously whether the Chrysler type of roller coaster is a suitable medium for operations by our enterprising investor. We have mentioned protracted neglect or unpopularity as a second cause of price declines to unduly low levels. A current case of this kind would appear to be National Presto Industries. In the bull market of 1968, it sold at a high of $45, which was only 8 times the $5.61 earning for that year. The per-share profits increased in both 1969 and 1970, but the price declined to only $21 in 1970. This was less than 4 times the record earnings in that year, and less than its net current asset value. In March 1972, it was selling at $34, still only 5.5 times the last reported earnings, and at about its enlarged net current asset value. Another example of this type is provided currently by Standard Oil of California, a concern of major importance. In early 1972, it was selling at about the same price as 13 years before, say 56. Its earnings had been remarkably steady, with relatively small growth, but with only one small decline over the entire period. Its book value was about equal to the market price. With this conservatively favorable 1958 through 71 record, the company has never shown an average annual price as high as 15 times its current earnings. In early 1972, the price over earnings ratio was only about 10. A third cause for an unduly low price for a common stock may be the market's failure to recognize its true earnings picture. Our classic example here is Northern Pacific Railway, which in 1946 through 47 declined from 36 to 13.5. The true earnings of the road in 1947 were close to $10 per share. The price of the stock was held down in great part by its $1 dividend. It was neglected also because much of its earnings power was concealed by accounting methods peculiar to railroads. The type of bargain issue that can be most readily identified is a common stock that sells for less than the company's net working capital alone, after deducting all prior obligations. This would mean that the buyer would pay nothing at all for the fixed assets, buildings, machinery, etc., or any goodwill items that might exist. Very few companies turn out to have an ultimate value less than the working capital alone, although scattered instances may be found. The surprising thing, rather, is that there have been so many enterprises obtainable which have been valued in the market on this bargain basis. A compilation made in 1957, when the market's level was by no means low, disclosed about 150 of such common stocks. In Table 7.4 found on the enhancement, we summarized the result of buying, on December 31st, 1957, one share of each of the 85 companies in that list for which data appeared in Standard & Poor's monthly stock guide, and holding them for 2 years. By something of a coincidence, each of the groups advanced in the 2 years to somewhere in the neighborhood of the aggregate net current asset value. The gain for the entire portfolio in that period was 75%, against 50% for Standard & Poor's 425 industrials. What is more remarkable is that none of the issues showed significant losses. 7 held about even, and 78 showed appreciable gains. Our experience with this type of investment selection, on a diversified basis, was uniformly good for many years prior to 1957. It can probably be affirmed without hesitation that it constitutes a safe and profitable method of determining and taking advantage of undervalued situations. However, during the general market advance after 1957, the number of such opportunities became extremely limited, and many of those available were showing small operating profits, or even losses. The market decline of 1969 through 70 produced a new crop of these sub-working capital stocks. We discussed this group in Chapter 15, on stock selection for the enterprising investor. Bargain issue pattern in secondary companies. We have defined a secondary company as one that is not a leader in a fairly important industry. Thus, it is usually one of the smaller concerns in its field, but it may equally well be the chief unit in an unimportant line. By way of exception, any company that has established itself as a growth stock is not ordinarily considered secondary. In the great bull market of the 1920s, relatively little distinction was drawn between industry leaders and other listed issues, provided the latter were of respectable size. The public felt that a middle-sized company was strong enough to weather storms, and that it had a better chance for really spectacular expansion than one that was already of major dimensions. The Depression years, 1931 through 32, however, had a particularly devastating impact on the companies below the first rank, either in size or in inherent stability. As a result of that experience, investors have since developed a pronounced preference for industry leaders, and a corresponding lack of interest, most of the time, in the ordinary company of secondary importance. This has meant that the latter group have usually sold at much lower prices in relation to earnings and assets than have the former. It has meant further that in many instances the price has fallen so low as to establish the issue in the bargain class. When investors rejected the stocks of secondary companies, even though these sold at relatively low prices, they were expressing a belief, or fear, that such companies faced a dismal future. In fact, at least subconsciously, they calculated that any price was too high for them, because they were heading for extinction. Just as in 1929, the companion theory for the blue chips was that no price was too high for them because their future possibilities were limitless. Both of these views were exaggerations and were productive of serious investment errors. Actually, the typical middle-sized listed company is a large one when compared with the average privately owned business. There is no sound reason why such companies should not continue indefinitely in operation, undergoing the vicissitudes characteristic of our economy, but earning on the whole a fair return on their invested capital. This brief review indicates that the stock market's attitude towards secondary companies tends to be unrealistic, and consequently to create in normal times innumerable instances of major undervaluation. As it happens, the World War II period and the post-war boom were more beneficial to the smaller concerns than to the larger ones, because then the normal competition for sales was suspended, and the former could expand sales and profit margins more spectacularly. Thus, by 1946, the market's pattern had completely reversed itself from that before the war. Whereas the leading stocks in the Dow Jones Industrial Average had advanced only 40% from the end of 1938 to the 1946 high, Standard & Poor's index of low-priced stocks had shot up no less than 280% in the same period. Speculators and many self-styled investors, with the proverbial short memories of people in the stock market, were eager to buy both old and new issues of unimportant companies at inflated levels. Thus, the pendulum had swung clear to the opposite extreme. The very class of secondary issues that had formerly supplied by far the largest proportion of bargain opportunities was now presenting the greatest number of examples of overenthusiasm and overvaluation. In a different way, this phenomenon was repeated in 1961 and 1968, the emphasis now being placed on new offerings of the shares of small companies of less than secondary character, and on nearly all companies in certain favored fields, such as electronics, computers, franchise concerns, and others. As was to be expected, the ensuing market declines fell most heavily on these overvaluations. In some cases, the pendulum swing may have gone as far as definite undervaluation. If most secondary issues tend normally to be undervalued, what reason has the investor to believe that he can profit from such a situation? For if it persists indefinitely, will he not always be in the same market position as when he bought the issue? The answer here is somewhat complicated. Substantial profits from the purchase of secondary companies at bargain prices arise in a variety of ways. First, the dividend return is relatively high. Second, the reinvested earnings are substantial in relation to the price paid and will ultimately affect the price. In a 5 to 7 year period, these advantages can bulk quite large in a well-selected list. Third, a bull market is ordinarily most generous to low-priced issues. Thus, it tends to raise the typical bargain issue to at least a reasonable level. Fourth, even during relatively featureless market periods, a continuous process of price adjustment goes on, under which secondary issues that were undervalued may rise at least to the normal level for their type of security. Fifth, the specific factors that in many cases made for a disappointing record of earnings may be corrected by the advent of new conditions, or the adoption of new policies, or by a change in management. An important new factor in recent years has been the acquisition of smaller companies by larger ones, usually as part of a diversification program. In these cases, the consideration paid has almost always been relatively generous, and much in excess of the bargain levels existing not long before. When interest rates were much lower than in 1970, the field of bargain issues extended to bonds and preferred stocks that sold at large discounts from the amount of their claim. Currently, we have a different situation, in which even well-secured issues sell at large discounts if carrying coupon rates of, say, 4.5% or less. Example, American Telephone and Telegraph, 2 5/8 due 1986, sold as low as 51 in 1970. Deere & Company, 4 1/2 due 1983, sold as low as 62. These may well turn out to have been bargain opportunities before very long, if ruling interest rates should decline substantially. For a bargain bond issue in the more traditional sense, perhaps we shall have to turn once more to the first mortgage bonds of railroads, now in financial difficulties, which sell in the 20s or 30s. Such situations are not for the inexpert investor. Lacking a real sense of values in this area, he may burn his fingers. But there is an underlying tendency for market decline in this field to be overdone. Consequently, the group as a whole offers an especially rewarding invitation to careful and courageous analysis. In the decade ending in 1948, the billion-dollar group of defaulted railroad bonds presented numerous and spectacular opportunities in this area. Such opportunities have been quite scarce since then, but they seem likely to return in the 1970s. Special situations, or workouts. Not so long ago, this was a field which could almost guarantee an attractive rate of return to those who knew their way around in it, and this was true under almost any sort of general market situation. It was not actually forbidden territory to members of the general public. Some who had a flair for this sort of thing could learn the ropes and become pretty capable practitioners without the necessity of long academic study or apprenticeship. Others have been keen enough to recognize the underlying soundness of this approach and to attach themselves to bright young men who handled funds devoted chiefly to these special situations. But in recent years, for reasons we shall develop later, the field of arbitrages and workouts became riskier and less profitable. It may be that in years to come, conditions in this field will become more propitious. In any case, it is worthwhile outlining the general nature and origin of these operations, with 1 or 2 illustrative examples. The typical special situation has grown out of the increasing number of acquisitions of smaller firms by large ones, as the gospel of diversification of products has been adopted by more and more managements. It often appears good business for such an enterprise to acquire an existing company in the field it wishes to enter, rather than to start a new venture from scratch. In order to make such acquisition possible, and to obtain acceptance of the deal by the required large majority of shareholders of the smaller company, it is almost always necessary to offer a price considerably above the current level. Such corporate moves have been producing interesting profit-making opportunities for those who've made a study of this field and have good judgment fortified by ample experience. A great deal of money was made by shrewd investors not so many years ago through the purchase of bonds of railroads in bankruptcy, bonds which they knew would be worth much more than their cost when the railroads were finally reorganized. After promulgation of the plans of reorganization, a when-issued market for the new securities appeared. These could almost always be sold for considerably more than the cost of the old issues which were to be exchanged therefore. There were risks of non-consummation of the plans, or of unexpected delays, but on the whole such arbitrage operations proved highly profitable. There were similar opportunities growing out of the breakup of public utility holding companies, pursuant to 1935 legislation. Nearly all these enterprises proved to be worth considerably more when changed from holding companies to a group of separate operating companies. The underlying factor here is the tendency of the security markets to undervalue issues that are involved in any sort of complicated legal proceedings. An old Wall Street motto has been, never buy into a lawsuit. This may be sound advice to the speculator seeking quick action on his holdings, but the adoption of this attitude by the general public is bound to create bargain opportunities in the securities affected by it, since the prejudice against them holds their prices down to unduly low levels. The exploitation of special situations is a technical branch of investment, which requires a somewhat unusual mentality and equipment. Probably only a small percentage of our enterprising investors are likely to engage in it, and this audiobook is not the appropriate medium for expounding its complications. Broader implications of our rules for investment. Investment policy, as it has been developed here, depends in the first place on a choice by the investor of either the defensive, passive, or aggressive enterprising role. The aggressive investor must have a considerable knowledge of security values, enough in fact to warrant viewing his security operations as equivalent to a business enterprise. There is no room in this philosophy for a middle ground, or a series of gradations between the passive and aggressive status. Many, perhaps most, investors seek to place themselves in such an intermediate category. In our opinion, that is a compromise that is more likely to produce disappointment than achievement. As an investor, you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits on your funds. It follows from this reasoning that the majority of security owners should elect the defensive classification. They do not have the time, or the determination, or the mental equipment to embark upon investing as a quasi-business. They should therefore be satisfied with the excellent return now obtainable from a defensive portfolio, and with even less. And they should stoutly resist the recurrent temptation to increase this return by deviating into other paths. The enterprising investor may properly embark upon any security operation for which his training and judgment are adequate, and which appears sufficiently promising when measured by established business standards. In our recommendations and caveats for this group of investors, we have attempted to apply such business standards. In those for the defensive investor, we've been guided largely by the three requirements of underlying safety, simplicity of choice, and promise of satisfactory results, in terms of psychology as well as arithmetic. The use of these criteria has led us to exclude from the field of recommended investment a number of security classes that are normally regarded as suitable for various kinds of investors. These prohibitions were listed in our first chapter. Let us consider a little more fully than before what is implied in these exclusions. We have advised against the purchase at full prices of three important categories of securities. 1. Foreign bonds. 2. Ordinary preferred stocks. And 3. Secondary common stocks, including, of course, original offerings of such issues. By full prices, we mean prices close to par for bonds or preferred stocks, and prices that represent about the fair business value of the enterprise in the case of common stocks. The greater number of defensive investors are to avoid these categories regardless of price. The enterprising investor is to buy them only when obtainable at bargain prices, which we define as prices not more than 2/3 of the appraisal value of the securities. What would happen if all investors were guided by our advice in these matters? That question was considered in regard to foreign bonds, and we have nothing to add at this point. Investment-grade preferred stocks would be bought solely by corporations, such as insurance companies, which would benefit from the special income tax status of stock issues owned by them. The most troublesome consequence of our policy of exclusion is in the field of secondary common stocks. If the majority of investors, being in the defensive class, are not to buy them at all, the field of possible buyers becomes seriously restricted. Furthermore, if aggressive investors are to buy them only at bargain levels, then these issues would be doomed to sell for less than their fair value, except to the extent that they were purchased unintelligently. This may sound severe and even vaguely unethical. Yet in truth, we're merely recognizing what has actually happened in this area for the greater part of the past 40 years. Secondary issues, for the most part, do fluctuate about a central level, which is well below their fair value. They reach and even surpass that value at times, but this occurs in the upper reaches of bull markets, when the lessons of practical experience would argue against the soundness of paying the prevailing prices for common stocks. Thus, we are suggesting only that the aggressive investor recognize the facts of life as it is lived by secondary issues, and that they accept the central market levels that are normal for that class as their guide in fixing their own levels for purchase. There is a paradox here, nevertheless. The average well-selected secondary company may be fully as promising as the average industrial leader. What the smaller concern lacks in inherent stability, it may readily make up in superior possibilities of growth. Consequently, it may appear illogical to many listeners to term unintelligent the purchase of such secondary issues at their full enterprise value. We think that the strongest logic is that of experience. Financial history says clearly that the investor may expect satisfactory results, on the average, from secondary common stocks, only if he buys them for less than their value to a private owner, that is, on a bargain basis. The last sentence indicates that this principle relates to the ordinary outside investor. Anyone who can control a secondary company, or who is part of a cohesive group with such control, is fully justified in buying the shares on the same basis as if he were investing in a closed corporation or otherwise private business. The distinction between the position and consequent investment policy of insiders and of outsiders becomes more important as the enterprise itself becomes less important. It is a basic characteristic of a primary or leading company that a single detached share is ordinarily worth as much as a share in a controlling block. In secondary companies, the average market value of a detached share is substantially less than its worth to a controlling owner. Because of this fact, the matter of shareholder-management relations, and of those between inside and outside shareholders, tends to be much more important and controversial in the case of secondary than in that of primary companies. At the end of Chapter 5, we commented on the difficulty of making any hard and fast distinction between primary and secondary companies. The many common stocks in the boundary area may properly exhibit an intermediate price behavior. It would not be illogical for an investor to buy such an issue at a small discount from its indicated or appraisal value, on the theory that it is only a small distance away from a primary classification, and that it may acquire such a rating unqualifiedly in the not-too-distant future. Thus, the distinction between primary and secondary issues need not be made too precise, for if it were, then a small difference in quality must produce a large differential in justified purchase price. In saying this, we are admitting a middle ground in the classification of common stocks, although we counseled against such a middle ground in the classification of investors. Our reason for this apparent inconsistency is as follows. No great harm comes from some uncertainty of viewpoint regarding a single security, because such cases are exceptional, and not a great deal is at stake in the matter. But the investor's choice as between the defensive or the aggressive status is of major consequence to him, and he should not allow himself to be confused or compromised in this basic decision. Commentary on Chapter 7. It requires a great deal of boldness and a great deal of caution to make a great fortune, and when you've got it, it requires 10 times as much wit to keep it. Nathan Mayer Rothschild. Timing is nothing. In an ideal world, the intelligent investor would hold stocks only when they are cheap and sell them when they become overpriced, then duck into the bunker of bonds and cash until stocks again become cheap enough to buy. From 1966 through late 2001, one study claimed $1 held continuously in stocks would have grown to $11.71. But if you'd gotten out of stocks right before the 5 worst days of each year, your original $1 would have grown to $987.12. Like most magical market ideas, this one is based on sleight of hand. How exactly would you or anyone figure out which days will be the worst days before they arrive? On January 7th, 1973, the New York Times featured an interview with one of the nation's top financial forecasters, who urged investors to buy stocks without hesitation. It's very rare that you can be as unqualifiedly bullish as you can now. That forecaster was named Alan Greenspan, and it's very rare that anyone has ever been so unqualifiedly wrong as the future Federal Reserve Chairman was that day. 1973 and 1974 turned out to be the worst years for economic growth and the stock market since the Great Depression. Can professionals time the market any better than Alan Greenspan? I see no reason not to think the majority of the decline is behind us, declared Kate Leary Lee, president of the market timing firm of R.M. Leary & Co., on December 3, 2001. This is when you want to be in the market, she added, predicting that stocks look good for the first quarter of 2002. Over the next 3 months, stocks earned a measly 0.28% return, underperforming cash by 1.5 percentage points. Leary's not alone. A study by 2 finance professors at Duke University found that if you had followed the recommendations of the best 10% of all market timing newsletters, you would have earned a 12.6% annualized return from 1991 through 1995. But if you had ignored them and kept your money in a stock index fund, you would have earned 16.4%. As the Danish philosopher Søren Kierkegaard noted, life can only be understood backwards, but it must be lived forwards. Looking back, you can always see exactly when you should have bought and sold your stocks. But don't let that fool you into thinking you can see in real time just when to get in and out. In the financial markets, hindsight is forever 20/20, but foresight is legally blind. And thus, for most investors, market timing is a practical and emotional impossibility. What goes up? Like spacecraft that pick up speed as they rise into the Earth's stratosphere, growth stocks often seem to defy gravity. Let's look at the trajectories of 3 of the hottest growth stocks of the 1990s: General Electric, Home Depot, and Sun Microsystems. See Figure 7.1 on the enhancement. In every year from 1995 through 1999, each grew bigger and more profitable. Revenues doubled at Sun, and more than doubled at Home Depot. According to Value Line, GE's revenues grew 29%. Its earnings rose 65%. At Home Depot and Sun, earnings per share roughly tripled. But something else was happening, and it wouldn't have surprised Graham one bit. The faster these companies grew, the more expensive their stocks became. And when stocks grow faster than companies, investors always end up sorry. As Figure 7.2 shows, a great company is not a great investment if you pay too much for the stock. Take a look for yourself on the enhancement. The more a stock has gone up, the more it seems likely to keep going up. But that instinctive belief is flatly contradicted by a fundamental law of financial physics. The bigger they get, the slower they grow. A $1 billion company can double its sales fairly easily, but where can a $50 billion company turn to find another $50 billion in business? Growth stocks are worth buying when their prices are reasonable, but when their price over earnings ratios go much above 25 or 30, the odds get ugly. Journalist Carol Loomis found that from 1960 through 1999, only 8 of the largest 150 companies on the Fortune 500 list managed to raise their earnings by an annual average of at least 15% for 2 decades. Looking at 5 decades of data, the research firm of Sanford C. Bernstein & Company showed that only 10% of large U.S. companies had increased their earnings by 20% for at least 5 consecutive years. Only 3% had grown by 20% for at least 10 years straight, and not a single one had done it for 15 years in a row. An academic study of thousands of U.S. stocks from 1951 through 1998 found that over all 10-year periods, net earnings grew by an average of 9.7% annually. But for the biggest 20% of companies, earnings grew by an annual average of just 9.3%. Even many corporate leaders fail to understand these odds. The intelligent investor, however, gets interested in big growth stocks not when they're at their most popular, but when something goes wrong. In July 2002, Johnson & Johnson announced that federal regulators were investigating accusations of false record-keeping at one of its drug factories, and the stock lost 16% in a single day. That took J&J's share price down from 24 times the previous 12 months' earning to just 20 times. At that lower level, Johnson & Johnson might once again have become a growth stock with room to grow, making it an example of what Graham calls the relatively unpopular large company. This kind of temporary unpopularity can create lasting wealth by enabling you to buy a great company at a good price. High potential for hype potential. Investors aren't the only people who fall prey to the delusion that hyper-growth can go on forever. In February 2000, Chief Executive John Roth of Nortel Networks was asked how much bigger his giant fiber optics company could get. "The industry is growing 14% to 15% a year," Roth replied. "And we're going to grow 6 points faster than that. For a company our size, that's pretty heady stuff." Nortel's stock, up nearly 51% annually over the previous 6 years, was then trading at 87 times what Wall Street was guessing it might earn in 2000. Was the stock overpriced? "It's getting up there," shrugged Roth. "But there's still plenty of room to grow our valuation as we execute on the wireless strategy. After all," he added, Cisco Systems was trading at 121 times its projected earnings. As for Cisco, in November 2000, its chief executive, John Chambers, insisted that his company could keep growing at least 50% annually. "Logic," he declared, "would indicate this is a breakaway." Cisco's stock had come way down. It was then trading at a mere 98 times its earnings over the previous year. And Chambers urged investors to buy. "So who are you going to bet on?" he asked. "Now may be the opportunity." Instead, these growth companies shrank, and their overpriced stocks shriveled. Nortel's revenues fell by 37% in 2001, and the company lost more than $26 billion that year. Cisco's revenues did rise by 18% in 2001, but the company ended up with a net loss of more than $1 billion. Nortel's stock, at $113.50 when Roth spoke, finished 2002 at $1.65. Cisco's shares, at $52 when Chambers called his company a breakaway, crumbled to $13. Both companies have since become more circumspect about forecasting the future. Should you put all your eggs in one basket? Put all your eggs into one basket, and then watch that basket, proclaimed Andrew Carnegie a century ago. Do not scatter your shot. The great successes of life are made by concentration. As Graham points out, the really big fortunes from common stocks have been made by people who packed all their money into one investment they knew supremely well. Nearly all the richest people in America trace their wealth to a concentrated investment in a single industry, or even a single company. Think Bill Gates and Microsoft, Sam Walton and Walmart, or the Rockefellers and Standard Oil. The Forbes 400 list of the richest Americans, for example, has been dominated by undiversified fortunes ever since it was first compiled in 1982. However, almost no small fortunes have been made this way, and not many big fortunes have been kept this way. What Carnegie neglected to mention is that concentration also makes most of the great failures of life. Look again at the Forbes rich list. Back in 1982, the average net worth of a Forbes 400 member was $230 million. To make it onto the 2002 Forbes 400, the average 1982 member needed to earn only a 4.5% average annual return on his wealth. During a period when even bank accounts yielded far more than that, and the stock market gained an annual average of 13.2%. So how many of the Forbes 400 fortunes from 1982 remained on the list 20 years later? Only 64 of the original members, a measly 16%, were still on the list in 2002. By keeping all their eggs in the one basket that had gotten them onto the list in the first place, once booming industries like oil and gas, or computer hardware, or basic manufacturing, all the other original members fell away. When hard times hit, none of these people, despite all the huge advantages that great wealth can bring, were properly prepared. They could only stand by and wince at the sickening crunch, as the constantly changing economy crushed their only basket and all their eggs. The bargain bin. You might think that in our endlessly networked world, it would be a cinch to build and buy a list of stocks that meet Graham's criteria for bargains. Although the internet is a help, you'll still have to do much of the work by hand. Grab a copy of today's Wall Street Journal, turn to the Money and Investing section, and take a look at the NYSE and NASDAQ scorecards to find the day's lists of stocks that have hit new lows for the past year, a quick and easy way to search for companies that might pass Graham's net working capital tests. Online, try http://quote.morningstar.com/high-low.html M section equals capital H, lowercase I, lowercase g, lowercase h, capital L, lowercase o, lowercase w. To see whether a stock is selling for less than the value of net working capital, what Graham's followers call net nets, download or request the most recent quarterly or annual report from the company's website, or from the Edgar database at www.sec.gov. From the company's current assets, subtract its total liabilities, including any preferred stock and long-term debt, or consult your local public library's copy of the Value Line Investment Survey, saving yourself a costly annual subscription. Each issue carries a list of bargain basement stocks that come close to Graham's definition. Most of these stocks lately have been in bombed-out areas like high-tech and telecommunications. As of October 31st, 2002, for instance, Comverse Technology had $2.4 billion in current assets and $1 billion in total liabilities, giving it $1.4 billion in net working capital. With fewer than 190 million shares of stock and a stock price under $8 per share, Comverse had a total market capitalization of just under $1.4 billion. With the stock priced at no more than the value of Comverse's cash and inventories, the company's ongoing business was essentially selling for nothing. As Graham knew, you can still lose money on a stock like Comverse, which is why you should buy them only if you can find a couple dozen at a time and hold them patiently. But on the very rare occasions when Mr. Market generates that many true bargains, you're all but certain to make money. What's your foreign policy? Investing in foreign stocks may not be mandatory for the intelligent investor, but it is definitely advisable. Why? Let's try a little thought experiment. It's the end of 1989, and you're Japanese. Here are the facts. Over the past 10 years, your stock market has gained an annual average of 21.2%, well ahead of the 17.5% annual gains in the United States. Japanese companies are buying up everything in the United States, from the Pebble Beach Golf Course to Rockefeller Center. Meanwhile, American firms like Drexel Burnham Lambert, Financial Corp of America, and Texaco are going bankrupt. The U.S. high-tech industry is dying. Japan's is booming. In 1989, in the land of the rising sun, you can only conclude that investing outside of Japan is the dumbest idea since sushi vending machines. Naturally, you put all your money in Japanese stocks. The result? Over the next decade, you lose roughly 2/3 of your money. The lesson: it's not that you should never invest in foreign markets like Japan. It's that the Japanese should never have kept all their money at home, and neither should you. If you live in the United States, work in the United States, and get paid in U.S. dollars, you are already making a multi-layered bet on the U.S. economy. To be prudent, you should put some of your investment portfolio elsewhere, simply because no one anywhere can ever know what the future will bring at home or abroad. Putting up to 1/3 of your stock money in mutual funds that hold foreign stocks, including those in emerging markets, helps insure against the risk that our own backyard may not always be the best place in the world to invest. Chapter 8. The Investor and Market Fluctuations. To the extent that the investor's funds are placed in high-grade bonds of relatively short maturity, say of 7 years or less, he will not be affected significantly by changes in market prices and need not take them into account. This applies also to his holdings of U.S. savings bonds, which he can always turn in at his cost price or more. His longer-term bonds may have relatively wide price swings during their lifetimes, and his common stock portfolio is almost certain to fluctuate in value over any period of several years. The investor should know about these possibilities and should be prepared for them both financially and psychologically. He will want to benefit from changes in market levels, certainly through an advance in the value of his stock holdings as time goes on, and perhaps also by making purchases and sales at advantageous prices. This interest on his part is inevitable and legitimate enough, but it involves the very real danger that it will lead him into speculative attitudes and activities. It is easy for us to tell you not to speculate. The hard thing will be for you to follow this advice. Let us repeat what we said at the outset. If you want to speculate, do so with your eyes open, knowing that you will probably lose money in the end. Be sure to limit the amount at risk and to separate it completely from your investment program. We shall deal first with the more important subject of price changes in common stocks, and pass later to the area of bonds. In Chapter 3, we supplied a historical survey of the stock market's action over the past 100 years. In this section, we shall return to that material from time to time in order to see what the past record promises the investor, in either the form of long-term appreciation of a portfolio held relatively unchanged through successive rises and declines, or in the possibilities of buying near bear market lows and selling not too far below bull market highs. Market fluctuations as a guide to investment decisions. Since common stocks, even of investment grade, are subject to recurrent and wide fluctuations in their prices, the intelligent investor should be interested in the possibilities of profiting from these pendulum swings. There are two possible ways by which you may try to do this: the way of timing and the way of pricing. By timing, we mean the endeavor to anticipate the action of the stock market, to buy or hold when the future course is deemed to be upward, to sell or refrain from buying when the course is downward. By pricing, we mean the endeavor to buy stocks when they are quoted below their fair value and to sell them when they rise above such value. A less ambitious form of pricing is the simple effort to make sure that when you buy, you do not pay too much for your stocks. This may suffice for the defensive investor, whose emphasis is on long pull holding, but as such it represents an essential minimum of attention to market levels. We are convinced that the intelligent investor can derive satisfactory results from pricing of either type. We are equally sure that if he places his emphasis on timing, in the sense of forecasting, he will end up as a speculator, and with a speculator's financial results. This distinction may seem rather tenuous to the layman, and it is not commonly accepted on Wall Street. As a matter of business practice, or perhaps of thoroughgoing conviction, the stockbrokers and the investment services seem wedded to the principle that both investors and speculators in common stocks should devote careful attention to market forecasts. The farther one gets from Wall Street, the more skepticism one will find, we believe, as to the pretensions of stock market forecasting or timing. The investor can scarcely take seriously the innumerable predictions which appear almost daily and are his for the asking. Yet in many cases he pays attention to them and even acts upon them. Why? Because he has been persuaded that it is important for him to form some opinion of the future course of the stock market, and because he feels that the brokerage or service forecast is at least more dependable than his own. We lack space here to discuss in detail the pros and cons of market forecasting. A great deal of brainpower goes into this field, and undoubtedly some people can make money by being good stock market analysts. But it is absurd to think that the general public can ever make money out of market forecasts. For who will buy when the general public, at a given signal, rushes to sell out at a profit? If you, the listener, expect to get rich over the years by following some system or leadership in market forecasting, you must be expecting to try to do what countless others are aiming at, and to be able to do it better than your numerous competitors in the market. There is no basis, either in logic or in experience, for assuming that any typical or average investor can anticipate market movements more successfully than the general public, of which he is himself a part. There is one aspect of the timing philosophy which seems to have escaped everyone's notice. Timing is of great psychological importance to the speculator, because he wants to make his profit in a hurry. The idea of waiting a year before his stock moves up is repugnant to him. But a waiting period, as such, is of no consequence to the investor. What advantage is there to him in having his money uninvested until he receives some presumably trustworthy signal that the time has come to buy? He enjoys an advantage only if by waiting he succeeds in buying later at a sufficiently lower price to offset his loss of dividend income. What this means is that timing is of no real value to the investor unless it coincides with pricing. That is, unless it enables him to repurchase his shares at substantially under his previous selling price. In this respect, the famous Dow theory for timing purchases and sales has had an unusual history. Briefly, this technique takes its signal to buy from a special kind of breakthrough of the stock averages on the upside, and its selling signal from a similar breakthrough on the downside. The calculated, not necessarily actual, results of using this method showed an almost unbroken series of profits in operations from 1897 to the early 1960s. On the basis of this presentation, the practical value of the Dow theory would have appeared firmly established. The doubt, if any, would apply to the dependability of this published record as a picture of what a Dow theorist would actually have done in the market. A closer study of the figures indicates that the quality of the results shown by the Dow theory changed radically after 1938, a few years after the theory had begun to be taken seriously on Wall Street. Its spectacular achievement had been in giving a sell signal at 306, about a month before the 1929 crash, and in keeping its followers out of the long bear market until things had pretty well righted themselves at 84 in 1933. But from 1938 on, the Dow theory operated mainly by taking its practitioners out at a pretty good price, but then putting them back in again at a higher price. For nearly 30 years thereafter, one would have done appreciably better by just buying and holding the DJIA. In our view, based on much study of this problem, the change in the Dow theory results is not accidental. It demonstrates an inherent characteristic of forecasting and trading formulas in the fields of business and finance. Those formulas that gain adherence and importance do so because they've worked well over a period, or sometimes merely because they've been plausibly adapted to the statistical record of the past. But as their acceptance increases, their reliability tends to diminish. This happens for two reasons. First, the passage of time brings new conditions which the old formula no longer fits. Second, in stock market affairs, the popularity of a trading theory has itself an influence on the market's behavior, which detracts in the long run from its profit-making possibilities. The popularity of something like the Dow theory may seem to create its own vindication, since it would make the market advance or decline by the very action of its followers when a buying or selling signal is given. A stampede of this kind is, of course, much more of a danger than an advantage to the public trader. Buy low, sell high approach. We are convinced that the average investor cannot deal successfully with price movements by endeavoring to forecast them. Can he benefit from them after they have taken place? For example, by buying after each major decline and selling out after each major advance. The fluctuations of the market over a period of many years prior to 1950 lent considerable encouragement to that idea. In fact, a classic definition of a shrewd investor was one who bought in a bear market when everyone else was selling, and sold out in a bull market when everyone else was buying. If we examine our Chart 1, covering the fluctuations of the Standard & Poor's Composite Index between 1900 and 1970, and the supporting figures in Table 3.1, we can readily see why this viewpoint appeared valid until fairly recent years. Between 1897 and 1949, there were 10 complete market cycles, running from bear market low to bull market high and back to bear market low. 6 of these took no longer than 4 years. 4 ran for 6 or 7 years, and 1, the famous New Era cycle of 1921 through 1932, lasted 11 years. The percentage of advance from the lows to highs ranged from 44% to 500%, with most between about 50% and 100%. The percentage of subsequent declines ranged from 24% to 89%, with most found between 40% and 50%. It should be remembered that a decline of 50% fully offsets a preceding advance of 100%. Nearly all the bull markets had a number of well-defined characteristics in common, such as 1. A historically high price level, 2. High price over earnings ratios, 3. Low dividend yields as against bond yields, 4. Much speculation on margin, and 5. Many offerings of new common stock issues of poor quality. Thus, to the student of stock market history, it appeared that the intelligent investor should have been able to identify the recurrent bear and bull markets, to buy in the former and sell in the latter, and to do so for the most part at reasonably short intervals of time. Various methods were developed for determining buying and selling levels of the general market, based on either value factors or percentage movements of prices, or both. But we must point out that even prior to the unprecedented bull market that began in 1949, there were sufficient variations in the successive market cycles to complicate and sometimes frustrate the desirable process of buying low and selling high. The most notable of these departures, of course, was the great bull market of the late 1920s, which threw all calculations badly out of gear. Even in 1949, therefore, it was by no means a certainty that the investor could base his financial policies and procedures mainly on the endeavor to buy at low levels in bear markets and to sell out at high levels in bull markets. It turned out in the sequel that the opposite was true. The market's behavior in the past 20 years has not followed the former pattern, nor obeyed what once were well-established danger signals, nor permitted its successful exploitation by applying old rules for buying low and selling high. Whether the old, fairly regular bull and bear market pattern will eventually return, we do not know, but it seems unrealistic to us for the investor to endeavor to base his present policy on the classic formula. For example, to wait for demonstrable bear market levels before buying any common stocks. Our recommended policy has, however, made provision for changes in the proportion of common stocks to bonds in the portfolio, if the investor chooses to do so, according as the level of stock prices appears less or more attractive by value standards. Formula plans. In the early years of the stock market rise that began in 1949 through 50, considerable interest was attracted to various methods of taking advantage of the stock market cycles. These have been known as formula investment plans. The essence of all such plans, except the simple case of dollar averaging, is that the investor automatically does some selling of common stocks when the market advances substantially. In many of them, a very large rise in the market level would result in the sale of all common stock holdings. Others provided for retention of a minor proportion of equities under all circumstances. This approach had the double appeal of sounding logical and conservative, and of showing excellent results when applied retrospectively to the stock market over many years in the past. Unfortunately, its vogue grew greatest at the very time when it was destined to work least well. Many of the formula planners found themselves entirely or nearly out of the stock market at some level in the middle 1950s. True, they had realized excellent profits, but in a broad sense, the market ran away from them thereafter, and their formulas gave them little opportunity to buy back a common stock position. There is a similarity between the experience of those adopting the formula investing approach in the early 1950s and those who embraced the purely mechanical version of the Dow theory some 20 years earlier. In both cases, the advent of popularity marked almost the exact moment when the system ceased to work well. We have had a like discomforting experience with our own central value method of determining indicated buying and selling levels of the Dow Jones Industrial Average. The moral seems to be that any approach to money-making in the stock market, which can be easily described and followed by a lot of people, is by its terms too simple and too easy to last. Spinoza's concluding remark applies to Wall Street as well as to philosophy. All things excellent are as difficult as they are rare. Market fluctuations of the investor's portfolio. Every investor who owns common stocks must expect to see them fluctuate in value over the years. The behavior of the DJIA since our last edition was written in 1964 probably reflects pretty well what has happened to the stock portfolio of a conservative investor who limited his stock holdings to those of large, prominent, and conservatively financed corporations. The overall value advanced from an average level of about 890 to a high of 995 in 1966, and 985 again in 1968, fell to 631 in 1970, and made an almost full recovery to 940 in early 1971. Since the individual issues set their high and low marks at different times, the fluctuations in the Dow Jones Group as a whole are less severe than those in the separate components. We have traced through the price fluctuations of other types of diversified and conservative common stock portfolios, and we find that the overall results are not likely to be markedly different from what's stated before. In general, the shares of second-line companies fluctuate more widely than the major ones, but this does not necessarily mean that a group of well-established but smaller companies will make a poorer showing over a fairly long period. In any case, the investor may as well resign himself in advance to the probability, rather than the mere possibility, that most of his holdings will advance, say, 50% or more from their low point, and decline the equivalent 1/3 or more from their high point at various periods in the next 5 years. A serious investor is not likely to believe that the day-to-day or even month-to-month fluctuations of the stock market make him richer or poorer. But what about the longer-term and wider changes? Here, practical questions present themselves, and the psychological problems are likely to grow complicated. A substantial rise in the market is at once a legitimate reason for satisfaction and a cause for prudent concern, but it may also bring a strong temptation toward imprudent action. Your shares have advanced. Good. You are richer than you were. Good. But has the price risen too high? And should you think of selling? Or should you kick yourself for not having bought more shares when the level was lower? Or, worst thought of all, should you now give way to the bull market atmosphere, become infected with the enthusiasm, the overconfidence, and the greed of the great public, of which, after all, you are a part, and make larger and dangerous commitments? Presented thus, the answer to that last question is a self-evident no. But even the intelligent investor is likely to need considerable willpower to keep from following the crowd. It is for these reasons of human nature, even more than by calculation of financial gain or loss, that we favor some kind of mechanical method for varying the proportion of bonds to stocks in the investor's portfolio. The chief advantage, perhaps, is that such a formula will give him something to do. As the market advances, he will from time to time make sales out of his stock holdings, putting the proceeds into bonds. As it declines, he will reverse the procedure. These activities will provide some outlet for his otherwise too pent-up energies. If he is the right kind of investor, he will take added satisfaction from the thought that his operations are exactly opposite from those of the crowd. Business valuations versus stock market valuations. The impact of market fluctuations upon the investor's true situation may be considered also from the standpoint of the shareholder as the part owner of various businesses. The holder of marketable shares actually has a double status, and with it the privilege of taking advantage of either at his choice. On the one hand, his position is analogous to that of a minority shareholder or silent partner in a private business. Here his results are entirely dependent on the profits of the enterprise, or on a change in the underlying value of its assets. You would usually determine the value of such a private business interest by calculating his share of the net worth, as shown in the most recent balance sheet. On the other hand, the common stock investor holds a piece of paper, an engraved stock certificate, which can be sold in a matter of minutes at a price which varies from moment to moment, when the market is open, that is, and often is far removed from the balance sheet value. The development of the stock market in recent decades has made the typical investor more dependent on the course of price quotations and less free than formerly to consider himself merely a business owner. The reason is that the successful enterprises in which he is likely to concentrate his holdings sell almost constantly at prices well above their net asset value, or book value, or balance sheet value. In paying these market premiums, the investor gives precious hostages to fortune, for he must depend on the stock market itself to validate his commitments. This is a factor of prime importance in present-day investing, and it has received less attention than it deserves. The whole structure of stock market quotations contains a built-in contradiction. The better a company's record and prospects, the less relationship the price of its shares will have to their book value. But the greater the premium above book value, the less certain the basis of determining its intrinsic value. For example, the more this value will depend on the changing moods and measurements of the stock market. Thus we reach the final paradox, that the more successful the company, the greater are likely to be the fluctuations in the price of its shares. This really means that, in a very real sense, the better quality of a common stock, the more speculative it is likely to be, at least as compared with the unspectacular middle-grade issues. What we've said applies to a comparison of the leading growth companies with the bulk of well-established concerns. We exclude from our purview here those issues which are highly speculative because the business themselves are speculative. The argument just made should explain the often erratic price behavior of our most successful and impressive enterprises. Our favorite example is the monarch of them all, International Business Machines. The price of its shares fell from 607 to 300 in 7 months in 1962 through 63. After 2 splits, its price fell from 387 to 219 in 1970. Similarly, Xerox, an even more impressive earnings gainer in recent decades, fell from 171 to 87 in 1962 through 63, and from 116 to 65 in 1970. These striking losses did not indicate any doubt about the future long-term growth of IBM or Xerox. They reflected instead a lack of confidence in the premium valuation that the stock market itself had placed on these excellent prospects. The previous discussion leads us to a conclusion of practical importance to the conservative investor in common stocks. If he is to pay some special attention to the selection of his portfolio, it might be best for him to concentrate on issues selling at a reasonably close approximation to their tangible asset value, say at not more than 1/3 above that figure. Purchases made at such levels, or lower, may, with logic, be regarded as related to the company's balance sheet, and as having a justification or support independent of the fluctuating market prices. The premium over book value that may be involved can be considered as a kind of extra fee paid for the advantage of stock exchange listing and the marketability that goes with it. A caution is needed here. A stock does not become a sound investment merely because it can be bought at close to its asset value. The investor should demand, in addition, a satisfactory ratio of earnings to price, a sufficiently strong financial position, and the prospect that its earnings will at least be maintained over the years. This may appear like demanding a lot from a modestly priced stock, but the prescription is not hard to fill under all but dangerously high market conditions. Once the investor is willing to forego brilliant prospects, for example, better than average expected growth, he will have no difficulty in finding a wide selection of issues meeting these criteria. In our chapters on the selection of common stocks, chapters 14 and 15, we shall give data showing that more than half of the DJIA issues met our asset value criterion at the end of 1970. The most widely held investment of all, American Tel & Tel, actually sells below its tangible asset value as we write. Most of the light and power shares, in addition to their other advantages, are now, early 1972, available at prices reasonably close to their asset values. The investor with a stock portfolio having such book values behind it can take a much more independent and detached view of stock market fluctuations than those who have paid high multipliers of both earnings and tangible assets. As long as the earning power of his holdings remains satisfactory, he can give as little attention as he pleases to the vagaries of the stock market. More than that, at times he can use these vagaries to play the master game of buying low and selling high. The A&P example. At this point, we shall introduce one of our original examples, which dates back many years, but which has a certain fascination for us, because it combines so many aspects of corporate and investment experience. It involves the Great Atlantic and Pacific Tea Company. Here is the story. A&P shares were introduced to trading on the Curb market, now the American Stock Exchange, in 1929, and sold as high as 494. By 1932, they had declined to 104, although the company's earnings were nearly as large in that generally catastrophic year as previously. In 1936, the range was between 111 and 131. Then, in the business recession and bear market of 1938, the shares fell to a new low of 36. That price was extraordinary. It meant that the preferred and common were together selling for $126 million, although the company had just reported that it held $85 million in cash alone and a working capital or net current assets of $134 million. A&P was the largest retail enterprise in America, if not in the world, with a continuous and impressive record of large earnings for many years. Yet in 1938, this outstanding business was considered on Wall Street to be worth less than its current assets alone, which means less as a going concern than if it were liquidated. Why? First, because there were threats of special taxes on chain stores. Second, because net profits had fallen off in the previous year. And third, because the general market was depressed. The first of these reasons was an exaggerated and eventually groundless fear. The other two were typical of temporary influences. Let us assume that the investor had bought A&P common in 1937 at, say, 12 times its 5-year average earnings, or about 80. We are far from asserting that the ensuing decline to 36 was of no importance to him. He would have been well advised to scrutinize the picture with some care, to see whether he had made any miscalculations. But if the results of his study were reassuring, as they should have been, he was entitled then to disregard the market decline as a temporary vagary of finance, unless he had the funds and the courage to take advantage of it by buying more on the bargain basis offered. Sequel and reflections. The following year, 1939, A&P shares advanced to 117.5, or 3 times the low price of 1938, and well above the average of 1937. Such a turnabout in the behavior of common stocks is by no means uncommon, but in the case of A&P, it was more striking than most. In the years after 1949, the grocery chain shares rose with the general market, until in 1961, the split-up stock, 10 for 1, reached a high of 70.5, which was equivalent to 705 for the 1938 shares. This price of 70.5 was remarkable for the fact that it was 30 times the earnings of 1961. Such a price-over-earnings ratio, which compares with 23 times for the DJIA in that year, must have implied expectations of a brilliant growth in earnings. This optimism had no justification in the company's earnings record in the preceding years, and it proved completely wrong. Instead of advancing rapidly, the course of earnings in the ensuing period was generally downward. The year after the 70.5 high, the price fell by more than half to 34. But this time the shares did not have the bargain quality that they showed at the low quotation in 1938. After varying sorts of fluctuations, the price fell to another low of 21.5 in 1970 and 18 in 1972, having reported the first quarterly deficit in its history. We see in this history how wide can be the vicissitudes of a major American enterprise in little more than a single generation, and also with what miscalculations and excesses of optimism and pessimism the public has valued its shares. In 1938, the business was really being given away, with no takers. In 1961, the public was clamoring for the shares at a ridiculously high price. After that came a quick loss of half the market value, and some years later a substantial further decline. In the meantime, the company was to turn from an outstanding to a mediocre earnings performer. Its profit in the boom year 1968 was to be less than in 1958. It had paid a series of confusing small stock dividends, not warranted by the current additions to surplus, and so forth. A&P was a larger company in 1961 and 1972 than in 1938, but not as well run, not as profitable, and not as attractive. There are two chief morals to this story. The first is that the stock market often goes far wrong, and sometimes an alert and courageous investor can take advantage of its patent errors. The other is that most businesses change in character and quality over the years, sometimes for the better, perhaps more often for the worse. The investor need not watch his company's performance like a hawk, but he should give it a good hard look from time to time. Let us return to our comparison between the holder of marketable shares and the man with an interest in a private business. We have said that the former has the option of considering himself merely as the part owner of the various businesses he has invested in, or as the holder of shares which are saleable at any time he wishes, at their quoted market price. But note this important fact. The true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. Incidentally, a widespread situation of this kind actually existed during the Dark Depression days of 1931 through 1933. There was then a psychological advantage in owning business interests that had no quoted market. For example, people who owned first mortgages on real estate that continued to pay interest were able to tell themselves that their investments had kept their full value, there being no market quotations to indicate otherwise. On the other hand, many listed corporation bonds of even better quality and greater underlying strength suffered severe shrinkages in their market quotations, thus making their owners believe they were growing distinctly poorer. In reality, the owners were better off with the listed securities, despite the low prices of these. For if they had wanted to, or were compelled to, they could at least have sold the issues, possibly to exchange them for even better bargains. Or they could just as logically have ignored the market's action as temporary and basically meaningless. But it is self-deception to tell yourself that you have suffered no shrinkage in value merely because your securities have no quoted market at all. Returning to our A&P shareholder in 1938, we assert that as long as he held on to his shares, he suffered no loss in their price decline, beyond what his own judgment may have told him was occasioned by a shrinkage in their underlying or intrinsic value. If no such shrinkage had occurred, he had a right to expect that in due course the market quotation would return to the 1937 level, or better, as in fact it did the following year. In this respect, his position was at least as good as if he had owned an interest in a private business with no quoted market for its shares. For in that case, too, he might or might not have been justified in mentally lopping off part of the cost of his holdings because of the impact of the 1938 recession, depending on what had happened to his company. Critics of the value approach to stock investment argue that listed common stocks cannot properly be regarded or appraised in the same way as interest in similar private enterprise, because the presence of an organized security market injects into equity ownership the new and extremely important attribute of liquidity. But what this liquidity really means is, first, that the investor has the benefit of the stock market's daily and changing appraisal of his holdings, for whatever that appraisal may be worth. And second, that the investor is able to increase or decrease his investment at the market's daily figure, if he chooses. Thus, the existence of a quoted market gives the investor certain options that he does not have if his security is unquoted. But it does not impose the current quotation on an investor who prefers to take his idea of value from some other source. Let us close this section with something in the nature of a parable. Imagine that in some private business you own a small share that cost you $1,000. One of your partners, named Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly. If you are a prudent investor or a sensible businessman, will you let Mr. Market's daily communication determine your view of the value of a $1,000 interest in the enterprise? Only in case you agree with him, or in case you want to trade with him. You may be happy to sell out to him when he quotes you a ridiculously high price, and equally happy to buy from him when his price is low. But the rest of the time, you will be wiser to form your own ideas of the value of your holdings, based on full reports from the company about its operations and financial position. The true investor is in that very position when he owns a listed common stock. He can take advantage of the daily market price, or leave it alone, as dictated by his own judgment and inclination. He must take cognizance of important price movements, for otherwise his judgment will have nothing to work on. Conceivably, they may give him a warning signal, which he will do well to heed. This, in plain English, means that he is to sell his shares because the price has gone down, foreboding worse things to come. In our view, such signals are misleading, at least as often as they are helpful. Basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply, and to sell wisely when they advance a great deal. At other times, he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Summary. The most realistic distinction between the investor and the speculator is found in their attitude toward stock market movements. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. Market movements are important to him in a practical sense because they alternately create low price levels at which he would be wise to buy, and high price levels at which he certainly should refrain from buying and probably would be wise to sell. It is far from certain that the typical investor should regularly hold off buying until low market levels appear, because this may involve a long wait, very likely the loss of income, and the possible missing of investment opportunities. On the whole, it may be better for the investor to do his stock buying whenever he has money to put in stocks, except when the general market level is much higher than can be justified by well-established standards of value. If he wants to be shrewd, he can look for the ever-present bargain opportunities in individual securities. Aside from forecasting the movements of the general market, much effort and ability are directed on Wall Street towards selecting stocks or industrial groups that in matter of price will do better than the rest over a fairly short period in the future. Logical as this endeavor may seem, we do not believe it is suited to the needs or temperament of the true investor, particularly since he would be competing with a large number of stock market traders and first-class financial analysts who are trying to do the same thing. As in all other activities that emphasize price movements first and underlying values second, the work of many intelligent minds constantly engaged in this field tends to be self-neutralizing and self-defeating over the years. The investor with a portfolio of sound stocks should expect their prices to fluctuate, and should neither be concerned by sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convenience, either to be taken advantage of or to be ignored. He should never buy a stock because it has gone up, or sell one because it has gone down. He would not be far wrong if this motto read more simply, never buy a stock immediately after a substantial rise, or sell one immediately after a substantial drop. An added consideration. Something should be said about the significance of average market prices as a measure of managerial competence. The shareholder judges whether his own investment has been successful in terms both of dividends received and of the long-range trend of the average market value. The same criteria should logically be applied in testing the effectiveness of a company's management and the soundness of its attitude toward the owners of the business. This statement may sound like a truism, but it needs to be emphasized, for as yet there is no accepted technique or approach by which management is brought to the bar of market opinion. On the contrary, managements have always insisted that they have no responsibility of any kind for what happens to the market value of their shares. It is true, of course, that they are not accountable for those fluctuations in price, which, as we have been insisting, bear no relationship to underlying conditions and values. But it is only the lack of alertness and intelligence among the rank and file of shareholders that permits this immunity to extend to the entire realm of market quotations, including the permanent establishment of a depreciated and unsatisfactory price level. Good managements produce a good average market price, and bad managements produce bad market prices. Fluctuations in bond prices. The investor should be aware that even though safety of its principal and interest may be unquestioned, a long-term bond could vary widely in market price in response to changes in interest rates. If you take a look at Table 8.1 on the enhancement, we give data for various years back to 1902, covering yields for high-grade corporate and tax-free issues. As individual illustrations, we add the price fluctuations of two representative railroad issues for a similar period. These are the Atchison, Topeka, and Santa Fe General Mortgage 4S, due 1995, for generations one of our premier non-callable bond issues, and the Northern Pacific Railroad 3s, due 2047, originally a 150-year maturity, long a typical BAA-rated bond. Because of their inverse relationship, the low yields correspond to the high prices and vice versa. The decline in the Northern Pacific 3s in 1940 represented mainly doubts as to the safety of the issue. It is extraordinary that the price recovered to an all-time high in the next few years, and then lost two-thirds of its price chiefly because of the rise in general interest rates. There have been startling variations as well in the price of even the highest-grade bonds in the past 40 years. Note that bond prices do not fluctuate in the same inverse proportion as the calculated yields, because their fixed maturity value of 100% exerts a moderating influence. However, for very long maturities, as in our Northern Pacific example, prices and yields change at close to the same rate. Since 1964, record movements in both directions have taken place in the high-grade bond market. Taking prime municipals, tax-free, as an example, their yield more than doubled from 3.2% in January 1965 to 7% in June 1970. Their price index declined correspondingly from 110.8 to 67.5. In mid-1970, the yields on high-grade long-term bonds were higher than at any time in the nearly 200 years of this country's economic history. 25 years earlier, just before our protracted bull market began, bond yields were at their lowest point in history. Long-term municipals returned as little as 1%, and industrials gave 2.4%, compared with the 4.5% to 5% formerly considered normal. Those of us with a long experience on Wall Street had seen Newton's law of action and reaction, equal and opposite, work itself out repeatedly in the stock market. The most noteworthy example being the rise in the DJIA from 64 in 1921 to 381 in 1929, followed by a record collapse to 41 in 1932. But this time the widest pendulum swings took place in the usually staid and slow-moving array of high-grade bond prices and yields. Moral? Nothing important on Wall Street can be counted on to occur exactly in the same way as it happened before. This represents the first half of our favorite dictum. The more it changes, the more it's the same thing. If it is virtually impossible to make worthwhile predictions about the price movements of stocks, it is completely impossible to do so for bonds. In the old days, at least, one could often find a useful clue to the coming end of a bull or bear market by studying the prior action of bonds. But no similar clues were given to a coming change in interest rates and bond prices. Hence, the investor must choose between long-term and short-term bond investments on the basis chiefly of his personal preferences. If he wants to be certain that the market values will not decrease, his best choices are probably U.S. savings bonds, Series E or H, which were described before. Either issue will give him a 5% yield after the first year. The Series E for up to 5 5/6 years, the Series H for up to 10 years, with a guaranteed resale value of cost or better. If the investor wants the 7.5% now available on good long-term corporate bonds, or the 5.3% on tax-free municipals, he must be prepared to see them fluctuate in price. Banks and insurance companies have the privilege of valuing high-rated bonds of this type on the mathematical basis of amortized cost, which disregards market prices. It would not be a bad idea for the individual investor to do something similar. The price fluctuations of convertible bonds and preferred stocks are the resultant of three different factors. 1. Variations in the price of the related common stock. 2. Variations in the credit standing of the company. And 3. Variations in general interest rates. A good many of the convertible issues have been sold by companies that have credit ratings well below the best. Some of these were badly affected by the financial squeeze in 1970. As a result, convertible issues as a whole have been subjected to triply unsettling influences in recent years. The price variations have been unusually wide. In the typical case, therefore, the investor would delude himself if he expected to find in convertible issues that ideal combination of the safety of a high-grade bond and price protection, plus a chance to benefit from an advance in the price of the common. This may be a good place to make a suggestion about the long-term bond of the future. Why should not the effects of changing interest rates be divided on some practical and equitable basis between the borrower and the lender? One possibility would be to sell long-term bonds with interest payments that vary with an appropriate index of the going rate. The main results of such an arrangement would be 1. The investor's bond would always have a principal value of about 100 if the company maintains its credit rating, but the interest received will vary, say, with the rate offered on conventional new issues. 2. The corporation would have the advantages of long-term debt, being spared problems and costs of frequent renewals of refinancing, but its interest costs would change from year to year. Over the past decade, the bond investor has been confronted by an increasingly serious dilemma. Shall he choose complete stability of principal value, but with varying and usually low short-term interest rates? Or shall he choose a fixed interest income with considerable variations, usually downward, it seems, in his principal value? It would be good for most investors if they could compromise between these extremes and be assured that neither their interest return nor their principal value will fall below a stated minimum over, say, a 20-year period. This could be arranged without great difficulty in an appropriate bond contract of a new form. Important note, in effect, the U.S. government has done a similar thing in its combination of the original savings bonds contracts with their extensions at higher interest rates. The suggestion we make here would cover a longer fixed investment period than the savings bonds, and would introduce more flexibility in the interest rate provisions. It is hardly worthwhile to talk about non-convertible preferred stocks, since their special tax status makes the safe ones much more desirable holdings by corporations, for example insurance companies, than by individuals. The poorer quality ones almost always fluctuate over a wide range, percentage-wise, not too differently from common stocks. We can offer no other useful remark about them. Table 16.2 on the enhancement gives some information on the price changes of lower-grade non-convertible preferreds between December 1968 and December 1970. The average decline was 17%, against 11.3% for the S&P Composite Index of common stocks. Commentary on Chapter 8. The happiness of those who want to be popular depends on others.